Hello and welcome to the course. I'm so glad you're with us. Hi, I'm Steve Ballinger. I'm the creator and instructor for the course, and we're going to learn all about technical trading and using technical analysis for trading, how to look at things like charts and patterns and how to be successful with that. So you're going to learn all these different types of indicators to help you be a better investor. But the other big goal that we're going to do here is to help you give you the confidence so you can apply this and use this yourself, and particularly use it right away. So we got a lot to cover, so let's do a quick course overview so you can kind of see what's upcoming with your upcoming lessons. So this is a list of the different sections we have in the course. Now, each of these sections has many lessons underneath it. So there's a lot of lessons. It's a real complete course. Self-paced, so take it the pace that you want to take it. We start off with an introduction and some things to set you up for success, like paper trading and all that. We do some core concepts around technical analysis, a building block there. Price bars as a foundation and understanding how to read a price bar. Trading gaps, like when prices go way up or way down, how to trade that big opportunity when there's a big gap in prices all of a sudden, maybe based on some unexpected news that might be happening in a stock. Candlesticks, you might have seen these candlesticks, price bars, where they look like a candle with a wick on the top and on the bottom. So we're going to learn all about how to read those, how to trade those, different patterns they can be. Trend lines, so important. The trend is your friend you'll be hearing about, and how to draw and trade on trend lines. Chart pattern recognition and trading success by looking how charts start to, kind of have a pattern, and then you can anticipate what's going to come next. So by looking at chart patterns. Moving averages, great for especially newer investors or getting started with, because they're really easy to understand, and you can tell whether to buy or sell based on what's happening with the moving average in relation to the price, for example. Momentum trading indicators, how fast is something accelerating as far as momentum? There's indicators around that. Volatility, how wide a range of prices up and down is happening, how we can use that to our advantage, and indicators and tools around that. And then also some strategy stuff like how to get better results using multiple trading tools and how to put that together, how to create a trading strategy, really your trading strategy, how to create what works for you, how to manage your trades, the different types of orders that are out there, and when is the best time to use different types of orders. And then we have a great section of live trading, and we're going to demonstrate platforms too as well, where you can actually see what we've learned in the course in action, and you'll see me walk right through these different trades with this live trading and kind of hear my thought process behind it too, as we reinforce everything that you learned in the course. And we wrap up with top 5 action steps, bonus steps, and some final thoughts as well. So great course, real complete course. So really glad you joined us here. A couple other kind of process things real briefly is sometimes I get excited talking about trading. It's fun. Trading is fun. So if you find I'm talking too fast, under your Udemy controls, you'll see to the left there where it says like 1x. Now you may change at any time, but right now how that would look, you just click that and you can lower my speed of talking, for example. We have many students from over 200 countries, so I admire everybody who speaks like a second language, and so if English second language for you, I admire that greatly. And if I'm talking a little too fast for you, just slow me down. That's perfectly okay. Look at that deep breath I'm taking, by the way. I must be having something really good to say coming up. Also, let's say your resolution will automatically be streamed at the appropriate resolution so it plays smoothly in terms of streaming from Udemy. Udemy controls all that automatically for you, but you can manually change that too. Everything is actually filmed in 1080p high definition, but you can lower that down if you find the videos at times might be choppy or anything. That's more likely due to your internet connection, maybe something on Udemy's end, but you can always adjust that so you have a nice smooth experience. And lastly, in terms of getting the most out of the course, one thing I find very helpful is to take notes as you go along. It doesn't have to be long, detailed notes, but maybe you hear something that you see something like around a moving average, and you say, oh, that seems interesting. I want to maybe look at a favorite stock of mine, and being yours, and you say, okay, I'm going to make a note to look at that. I want to look at the weighted moving average on my favorite stock and see where we're at today. And I want to look at it from 20 days and 50 days. Just a quick little note you might make with that. So that can help you as far as reinforcing your learning, and actually studies show that even the aspect of taking notes helps with better learning and better recall, even if you never look at your notes ever again. So I'm always a big believer in taking notes, but it's up to you too. All right, so let's get started and dive into the course and learn some of these key concepts and key ways to set ourselves up for success by using technical analysis in trading stocks. I know you have some stocks that you're probably very interested in and would love to start applying some of these things we're going to learn right away. So I'm going to give you kind of a practice activity or something that you can learn and use that you could look at your own stocks right now. So we're going to learn a real quick lesson, and I'm going to show you how to find it on the in the real world, on the internet and all that, so you can look up a stock and how you would apply this indicator or this concept. And the concept we're going to use is an easy one to get started with. It's called the moving average crossover indicator, or moving average crossover rule. And what it is you have your prices on a chart here. We have a red for down days and blue or green or black or whatever for up days. And you can see where the prices are kind of going up and down. And through them is this orange line. That's our moving average. And a moving average is just simply an average of the prices going back over a period of time. It could be 5 days, it could be 10 days, it could be 200 days, it could be minutes or hours. Either way, it's looking at the average of the prices going back over time. And simply how the indicator would work is if the price goes below the moving average, that's a sell signal. And if it goes above the moving average, that's a buy signal. And you can see where we have different sell and buy signals here on this particular chart. And you also might notice in the middle there's a lot of frequent kind of buy and sell signals. That's called whipsaws. And we have a whole section on that, how to filter those out and how to deal with those, because they can get very frustrating. As you can see where we have a lot of buy and sell all happening at the same time. We're looking for more, maybe a little bit more established trends. So we'll talk about whipsaws and a whole bunch of lessons around moving averages and the different types of moving averages. But now that you understand this concept, let's look at a couple of websites as far as how to look up a stock and how you can apply it to maybe your favorite stock. Okay, we're over here at finance at yahoo.com. I'm going to show you a couple other screeners here as well, but on ways to look up stocks. But I'm going to simply show you how you can look it up and how you can apply that moving average. So let's say we're finance at yahoo.com, and let's say we're interested in Johnson & Johnson, a big vaccine, drug maker. And you can type in the full name there as you see, or you could just put in the ticker symbol if you already know that. And you can see it'll come up on these different exchanges, and we're going to choose this one here. And we'll look up Johnson & Johnson, right? So it's going to give our pricing and everything. And what we're going to do is we're just going to quickly go on down to chart here. So we'll start chart, all sorts of information there. But we're going to go to a full screen on the chart, because that's going to give us some more things. Here you can see a whole long history of Johnson & Johnson. There's all different things you can change it from looking like a candle to a line, all sorts of stuff we're going to learn about, by the way. So don't worry about that yet. And the different intervals. This is like a week interval, but it could be, let's say, like a day interval, for example, right? So you got your different prices here. So we want to apply this moving average indicator here. And over on Yahoo Finance, and I'll show you in a couple other ones too, you just go to indicators. And they actually have this one right at the top here because it's a very popular one. We're going to learn about all sorts of other ones like Bollinger Bands, RSI, MACD, all that. So we're just going to choose moving average, right? Just simply, and you can choose the period, 50 days, let's say, or you could change it to, let's say we're going to look at 20 days, just to have a simple thing. Looks like it'll be a little purple. We'll click it. And you can see we've got our 20-day moving average, and you can see whether it's crossing above and below the line there. And as we see, we're on a long kind of uptrend here with these guys. It hasn't gone below the line for a while until we get right here where it went below the line. So this would be like a sell signal in here. So that would be our sell signal on that one. If we go back in time, you can see there's a sell signal here, then it goes underneath and it goes down and it goes above. So that's a buy signal. Sell signal above the line, nice jump up there. That's a buy signal. You can see how it goes above and below the line. So that's using in Yahoo Finance, a real common way to look up a stock. Real simple, real easy to use. Now, a more powerful thing for us that we're going to use actually quite a bit in some of the demonstrations later at the end is called TradingView. So let's go here to tradingview.com. It's going to have a lot more information. It's going to seem a little more complex. So if you get a little overwhelmed by this one, don't be yet. You're going to learn all about different ways you can do this. But let's look up a stock here. Let's say we're interested in, let's try a different one. Let's say Unilever, right? So let's say we're in Unilever. And this one you can see there's a whole bunch of information and a lot of stock exchanges it's listed on. Here's Hindustan Unilever on the NSE over in India here. And we got New York. And let's say we're looking for, United Kingdom. Here we are. Right? This is where they're based out of. So this also put into the currency that's there. That should be in British pounds. You can see Unilever, oh boy, they're down 6% today. So whatever's going on with them, something interesting is going on. Interesting to see what our moving average looks like. And then from here, you'll see that there's a chart there, but it's a real basic chart. You want to go to something that looks like, and again, you'll look wherever it'll say tick at the top. Your screen might look a little different than mine at this point because I'm a registered user, where you can use TradingView for free with ads. So I'm going to go down to full featured chart, and you want to find that. And then you'll find this chart here, and it gives you a lot of different things you can do. We're just going to do this one thing with the moving average. So we're going to go over to here where it kind of says indicators and strategies. See how that's got that formula sign there? I'm going to click on that. I can type in, I'm interested in moving average. And this is our simple regular moving average. We're going to learn about exponential moving averages, weighted moving averages, all sorts of stuff. But let's keep it simple. So you can do this with your own stock. And I'm going to click moving average. And you can see now I have my line on here. And if we go back here a little bit in time, you can see where it's gone above the line. So that was a buy signal, but then came back down. Here's a little whipsaw. See this whipsaw here where it's above and below the line? But then we have a nice jump up here. This is actually called a gap. We have a whole big section on gaps. Gaps can be trading opportunities. Sometimes not, but sometimes they can be. Here's a gap, what's called a gap up, went above the price line. So that's a strong, both of those are strong buy indicators, by the way. So as you can see, it stayed up there for a while, peaked up here, went below the line, and now we have a sell signal, right? Buy, sell. And so here we are in the current day, and it went sell signal here, and then it started approaching. Maybe we were watching it. This is the day before. It said, "Ooh, I wonder if it'll get above that line. That'd be a nice sell, nice buy signal." Maybe we've got a nice uptrend forming here. You know, we'll learn how to draw these trend lines, and you could say, "Ooh, maybe this is coming. This is good. I'm going to watch for it to go above this line. This might be an opportunity." Be watching it, and then all of a sudden, it looks like here with this E here, that's an earnings announcement. So that means they must have had something in their earnings announcement, because all of a sudden, boom, what happened? Big, long red candle, went way down. And so right now it's trading down about, what do we say, about 6.2% for the day. So too bad, our thing didn't work out. But that's the idea of how you can start reading these things. And I want to show you all this too. So don't worry about understanding it too much right now. Just right now, use your favorite stock, above the line, buy, below the line, sell. For my friends in India here, I have a lot of students from India. There's screener.in. That's also a real popular screener for specifically for India stocks. So let's put in an India stock. Let's say we're going to go Tata. If you drive around in India, you'll see Tata Motors, Tata cars. And when you get here, you can see some basic information around Tata. You scroll on down to your chart here, and you can see we've got it's basically got our prices in a line type chart. See how this line is actually the prices here, you know, as far as the chart itself. And we refresh that. So you can have prices like either like candles or like a line. But they give you a default of where you have a 50-day moving average, DMA day moving average, or 200-day moving average. So if I click 50, this would now put a little orange over here. See how it's now got an orange line here, and it's crossing below the line here, approaches, goes above the line, a little whipsaw here, and then stays below. So that's the 50-day moving average. If you did a 200-day moving average, you can see we have a new line here, this blue line. It's a longer time period, and you can see where it goes above and below the line there as well. So as you can see, not as much choices here. You only got these two, where with something like, let's say, the TradingView, you can actually input all sorts of specific days, times, hours. It's much more powerful. But in terms of like just, you know, once again, doing something fun for what you're used to, use Yahoo, use this one, use whatever you're used to using, and then put those moving averages on there and look for those times when it goes above and below the line. Again, goes below the line, sell, is a sell indicator, goes above the line is a buy indicator. Now, use your favorite stock and put that in and see what you find here. Let's talk about some things that I think you'll find very interesting, but also really set you up for success in the course. And this lesson, we're going to talk about the universal language of technical analysis, how it can apply in many different contexts. I'm going to show you some free practice tools or explain how those work with paper trading and back testing that you're going to end up using a lot once you get through the course. And then also talk a little bit about trading platforms. So you get a lot of questions like, what's a good platform, or where can I find a platform that works for me so I can actually do this trading? We're going to talk about that at the end of this lesson. So great lesson to get started with. So let's get started. So first off, the universal language of technical analysis. And what that means is we can kind of speak the same language by using these same tools and indicators no matter where you're at or what type of security you're looking at. for example. So if we talk about language, of course, there's many different languages out there. Here's different ways that you can say hello. But in technical analysis, if we're going to talk about, let's say, a trend line forming, that's the same no matter what the language, which is very interesting and terrific, actually. So that's why on a quick note on terminology, I'll use the term security because I'll refer to really any financial instrument that holds some type of monetary value and is traded on an exchange. So examples of securities under this definition are like stocks, cryptocurrency like Bitcoin and others like Ethereum, or foreign exchange currency trading or the Forex market, because these concepts are universally applicable no matter what you're looking at. Now governments may debate, like especially around things like Bitcoin, is that a security or whatever, but for our purposes, all these things definitely are. Is it worth some money? Can you trade it, and can you trade it publicly in an exchange? And all these things fit, and then all the tools that we're going to talk about apply not only to the stock market, but as you learn them, you can actually, if you want to trade other types of securities, you can apply what you learned into those other securities as well. And isn't that really kind of great or terrific? So if we look at, let's say, an example of something from the course, this is a candlestick. It's a price bar, represents price. Came from Japan, so a lot of times you might hear them referred to as Japanese candlesticks. But if you look at this is the exact same candlestick, the same way it would be represented in different countries like India, Australia, Mexico, USA, wherever, UK, Eurozone, no matter where you are, a candlestick is going to be the same as far as look and how you interpret it and how you would apply it. That's the same thing as we talked about earlier, where not only can you apply these concepts to the stock market, but you can apply in things like Bitcoin, Forex, gold, or precious metals that are traded, or commodities like pork bellies or something like that, or rice that might be traded. So concepts are universal. It's a universal language. So you only need to learn one language. So if we look at an example, here's a stock chart, and don't worry about this yet as far as understanding how to read it. The concept you want to take away is you don't know whether this chart is reflecting stocks or Bitcoin as an example, but the concepts of when to buy and when to sell will work no matter what. And once you learn how to read this type of chart, which you will in the course, you'll be able to apply that. So that's really terrific, isn't it? And the concepts will work on the securities also no matter what time frame they are as well. So in this example, this is from the same security, but it's different time frames. And because I'm like, one is a day time frame, one is a week, one is a month, one is more like 3 months, you can't tell which one is which without labeling the time frame, because the concepts, again, are universal. You don't have a special type of indicator or special look of a candlestick price bar, for example, in one time frame versus another. So again, very universally applicable. And if you look at the bottom left there, you can see something where I've drawn a blue trend line. We'll learn about drawing trend lines. And there's a concept called a shaven top, right? Where the top of that little candle isn't have a real tall wick. That's called a shaven top, and you'll learn about that too. Again, universally applicable. On the far right, same thing. You have a shaven bottom. It's just the bottom that's missing the wick. And then you have these things where they're very narrow kind of bodies of the candle, which are called dojis. Again, we're going to learn all about this stuff in the course. The key takeaway is it's very, very applicable no matter what you're looking to do. Okay, so that's great. But now you might be thinking too, like you're probably thinking early on, at some point you're going to say, as I go through the course, I'd like to try some of these ideas without risking any money. Can I do that? I really like to try it, but I don't want to risk money, especially when I'm on a learning curve and I want to learn and apply things before I risk a lot of my hard-earned money. Can I do that? And the great answer is yes, most definitely. There's two ways to do that, and that's called paper trading and back testing. So let's take a look at each of those and how they work. So paper trading is where you can basically trade for free. Almost all, I think, online broker sites will offer this for free with, in effect, fake money, whatever your currency is, whether it's dollars or euros or rupees. But an online broker site will offer this type of thing for free. So you want to look for if they're offering paper trading. And all it is you basically get the practice for free. It's with fake money. It's a safe space where you can learn the mechanics of placing trades and building a portfolio and trying different things that you might learn through the course. And you can kind of get real comfortable with it before you start actually testing with money. So you're test driving these new investment indicators or tools that we're going to learn about, strategies and order types, whether it's a market order or a limit order or a stop order, all these things you're going to learn in the course. You can try it all without risking any money. So really look forward to paper trading. In addition is back testing. Also, you can find a lot of them for free on online broker sites. And again, you're using fake money. And what that is it's looking backward. Let's say through the course, I'm going to teach you how to develop strategies and you're going to learn the tools. And you're going to use these things and you want to test it to see what the results would have been in the past. Would it have succeeded in the past? No guarantee that it succeed in the future, but if it succeeds in the past, there's a very good chance it will succeed in the future. And you can kind of see your results there as well too. So basically you can build it, you can then input into the backtesting program or algorithm as part of the online broker, and then you pull real data from the past, from the broker side automatically, and you can see results. You can say, well, if I invested X number of rupees or dollars, and I put that in, and I used this strategy, and this would have occurred, let's say, at a certain period in the past with a certain security, what would have been my results? Would I have made money? Would I have lost money? So back testing gives you a chance to, again, try your strategies and things before you start actually implementing them with real money. You see how these kind of go together? Paper trading is kind of letting you get practice the mechanics and trying different things, and back testing is kind of proving your ideas and thoughts that you learned through the course. So they work good in concert together. And they're very similar, and they're designed to, basically practice what you learn in the course. Backtest is looking at historical stuff. Paper trading is looking at the current type of market and how things would have looked at. And then the next step after you do backtesting and paper trading would be live trading, which is really where you're now investing real money. Now you're an active trader, doing investments. So, and you might ask yourself, well, why would an online broker offer this type of powerful mechanisms for free? Why don't they charge for that? And some may, but the reason they do is they want you to be successful. I certainly want you to be successful, but they really want you to be successful because they want you to learn and use their system. They want you to trade real money eventually, and then they can charge fees against that trading. When you make a trade, some are no fee trades, and some trades, which might be a little bit more complex, again, we'll learn about them, they might charge you a small fee to conduct that trade. Either way, that's how the platform makes money. And the platform can't make money if you're not comfortable or happy with the platform. So it's like test driving a car, right? If you can test drive the platform through paper trading and back testing. So that's their incentive there. It's always good to sometimes see what everyone's incentive is. My only incentive is thank you for investing in the course, and all I care about is helping you become great at trading. That's all I'm focused on. Another thing is well, how do we choose these different types of online platforms to use? Is there some you could recommend or something of that nature? And really the first thing you want to do is make sure that the platform is governed by the laws of where you live and that uses the currency that you want. I mean, if you're in India, you want to be able to trade in rupees, for example, than as opposed to if you're in somewhere else where you're trading in yen or euros or whatever it might be. Easy way to do that, it's going to seem super easy, simple, I guess, is to do an internet search and just put in stock chart tools for, and then whatever country you want, or something like that, and you'll start seeing things to come up. So if we put in, for example, here, India, you could put USA, you could put anything. It would come up with the top things. You're going to usually find these two towards the top. You can see stockcharts.com and TradingView. There's indie versions of both of those. Those are the two real leaders out there, by the way. And they TradingView trades multiple types of securities. I think StockCharts does too, but they're mostly stocks. But TradingView, you can trade cryptocurrency as well as stocks and different things. So those are ways you want to find and then start your research based on that. You'll usually, when you do that too, start finding articles like the 18 best technical analysis software for stock trading in India, right? So you can then look at these articles and at least get lists of things that you can start evaluating. And as you go through the course and learn the tools, then you can kind of see, okay, what are they offering? What can they do? How does it look? How comfortable do I feel? So the same thing you could put in online stockbrokers, for example, to find an actual broker in the different, wherever you live, UK, USA, wherever, and they'll usually come up with different articles best UK trading platforms or NerdWallet's best online brokers for stock trading in the United States. This happens to be USA. I'm not recommending any of them. It's up to you to kind of go dig a little deeper after you start learning stuff in the course and see what might be interesting to you. So if you're in, let's say, Thailand or Indonesia or wherever, you want to make sure that it supports what you're doing in your country, in your currency. So these are some great ways to set you up for success. So as you go through the course, then you can kind of start to have this in the back of your mind, I'm learning stuff and I feel comfortable, and I can always say paper trade it or back test it if I really want to start applying many of the things that we're going to learn. So a great way to set yourself up for success. In the stock market world, there's different types of stocks out there. Some are big companies, some are small companies, some are technology or high growth companies, some are less growth, but maybe they pay you some income or dividend. There's different types of companies out there, But when it comes to analyzing companies, decide what to invest in or trade in, there's really two big schools of thought, and that is fundamentals or fundamental investing and technical analysis. So it's good to have a good understanding what's the difference between the two and where do you apply them in which situation. So if we think about fundamentals, that's where you're really looking at less frequent trading, and you're more looking at business fundamentals, right? You're looking at the company itself, the markets they're in, what competitive advantages they may have versus their competitors, what are they good at? A lot of times with fundamentals, you're going to look at ratios. If you've heard things like the price to earnings or PE ratio, or price to book, value investors look at that, price to book value, or PEG ratio, or dividend payout ratio, all these different ratios that are out there. That's fundamental analysis, really looking at, ratios of business performance, basically. And so it's fundamental analysis. Think about it, it's all about evaluating the business. And this is typically used by, let's say, longer term traders or longer term investors, where they're trying to look at a business and see how they might do over a longer period of time. And maybe they might be a less frequent in and out of a stock, typically, not exclusively, but typically. If we look at technical analysis, we're looking at organizations, we're looking at stocks, but we're really looking at, from more of a supply and demand standpoint, as far as what's happening with prices. Are prices going up and down, and what's impacting that? What's the market sentiment around that? What's driving this moves in the price? And we're looking at things like trends. Is there a certain trend? Is the price stock trending up, or is it trending down? That's where we use a lot of things like charts and all that, because we're trying to visually represent some of these things so we can see when should we buy, but also a very important technical analysis, when should we sell? So that in and out, that enter and exit strategy is very, very important for traders in order to make a profit. And so it's all about recognizing indicators and patterns. Think of indicators as like the tools. If this happens, then most likely this price is going to go, let's say, up, for example. So because I see this indicator, I'm going to invest here. Price goes up, I'm going to sell up here because my indicator might tell me to sell too. And then I make the profit between the two. Or I'm looking at a certain chart patterns, and I see, like when we're looking at like candlesticks and things, I see certain things happening. I know I'm going to take action, either buy or sell action, or maybe I won't do anything based on this technical analysis. And that's, as far as looking at indicators and things along those nature. So if we look at an example how two people might look at this differently, one who's a very fundamental person, you can combine the two, but let's say someone who's very focused on fundamentals and somebody's focused on technical trading. Let's look at one stock as far as how somebody might approach it or talk about that stock. So let's say we have two investors, and the one stock we're going to talk about, let's say example Tesla, right? Electronic vehicles. So a person in fundamental investing would say why they might want to invest in it. They'd say Tesla is the dominant market leader in the super growing area for the future, which is EV or electric vehicles. Even though their stock price is relatively high to their price earnings ratio, I think the future looks very bright, and I want to buy now before the price goes up even further. A technical person, both also interested in buying the stock, might say Tesla's price just went above its 50-day moving average. Plus, Tesla is still near the channel bottom, so trends look good, and I'm going to buy. So if you kind of break that down a little bit, you can see some of the words popping out. Let's look at this here, where the fundamental person is looking at growth, super growing area. They're going to use a ratio, more feelings, like I think the future looks bright. Where a technical person's not about feelings. They're about technical. They're about math and charts and market sentiment, those things. So the price is above its 50-day moving average, the average prices over the last 50 days. We're going to learn all about moving averages. Don't worry yet. And it's near the channel bottom, so it's near a bottom price, so they think the trend looks good, that it's going to rebound and go back up. So they're talking not about the business at all. They're talking about it as an individual stock opportunity to invest in and get in, and then maybe later get out when they change their mind. So a question might be, can you combine the two? Usually people who are fundamentals, they stay that way. Some people who are really technical stay that way. You can combine the two. I actually do combine the two too at times. And one way I would do that, or people do, is they might use fundamentals to narrow their choices of stocks. They might use some of these things as a screener, like a stock screener, to narrow down their choices. Or they narrow their universe down by, I'm looking at growth stocks, or I'm looking at stocks in the electric vehicle sector only, because I believe in that sector, that's more of a feeling or a belief. I believe in the sector of electric vehicles. And then they'll use technical type information to determine if now is the optimum time to buy, or maybe when to sell. So it's really a matter of a style and strategy too, and also what type of investor or trader you want to be. For example, a day trader would never really consider fundamentals. They're trying to get in and out of stocks in the same day. So they're not looking at long-term prospects. They're looking at short-term price movements to make a profit on. So the good news is with stocks, you can make money and be successful, whether it's with fundamentals or technical type of trading. Either way can be successful and might be more about your type of style and all that. And you can combine the two as well. Both have been proven to be very, very successful. Let's talk about why technical analysis works, and it works very, very well most of the time, but not every time. And so we'll get into that a little bit and kind of the underlying concepts around technical analysis when you're looking at a security. And a lot of it gets back to that whole idea of supply and demand, right? It's, if you have a lot of demand for something, the prices will rise up. You know, if somebody really wants, a whole bunch of people are buying a certain product, for example, you know, the person who sells that product could raise the price. Same thing with trading of a security. If there's a lot of demand for a security, the price will rise. And so what this leads with the supply and demand, it leads to predictable behaviors. If we start seeing certain patterns or certain things happening, we can anticipate that there's going to be changes or things that are going to happen that are as a result of that supply and demand. And it's been around a long time. I mean, it's been around since like the first time it was ever talked about in a book I read was in 1948. So it's not something that's like just brand new that's never been really proven or tested. It's been used for a very long time. In fact, some things like candlestick price patterns and all that have gone way back, hundreds and hundreds of years back in Japan. But certainly the term technical analysis, certainly since 1948, and many different things around that and proving why that works. But not all the time. So let's talk about what's the idea behind this. And one way to think about it is how people will travel together, or people will invest together, or traders will get an idea and they'll kind of start moving together, right? And that's kind of what we think about as trends, right? Think we're all kind of moving in the same direction. It's almost like a herd mentality, right? Okay, so I'm not going to say that people are like sheep. Okay, people are not sheep. Okay, but it's the idea of a number of people or animals traveling together, going in the same direction. So like if you look at this picture, for example, you could see that the sheep are traveling in a certain direction, right? They're headed downhill on a road, and it's nice and easy for them to walk down the road, and they're all kind of headed in that same direction for the most part. You can even consider that momentum investing, right? And we'll talk about momentum indicators, where they're all kind of headed in this easy trend going down the road. But you might also notice something that's going on that's a little different in the upper left. Do you see the little grass there on the left? And there's a few sheep who went on the grass that, hey, this looks pretty good over here. Let's go over here and have some grass. Now, they're not following the trend. Like if we were investors, we might say that this is a definite downward trend, right? Look at how everything's kind of moving down the hill, and it's easy to move down the hill. But we'd want to watch what's going on that hill over there, because that might be what we would call in technical analysis a breakout or a changing of the trend. And is it going to be a real breakout? Is it going to change the trend? Are the sheep going to change their direction and now go to the hill? So if we think of this as terms of a security, let's say prices have been falling, going down the hill, but now something's happening, something in the news or people are just for whatever reason are changing that supply and demand, and they're going to now go on the hill and the prices are going to start to rise. So if we have an indicator that says, oh, when certain things happen, people are going to start changing, the prices are going to start rising, kind of the idea of just like we see enough sheep that go up on the hill, the sheep will change direction too. So maybe it's a breakout, maybe a trend is forming, maybe it's just a retracement, which is another term for just a temporary move where it kind of goes up for a little bit and then comes back right away. It's a temporary move. So we're going to learn all about that. So that's the underlying idea of why it works, because it's looking at these big kind of macro type trends. Now, it doesn't work every time because, one, nothing's 100% perfect, of course. And then there's unexpected random events that can occur. And these random events could come at a company level. Let's say the CEO unexpectedly dies or gets fired or something happens. There's something that could happen at a company level, or they miss an earnings announcement unexpectedly, can drive prices up and down. But there are things that can happen at real big country or global levels too that are really beyond our control and even beyond our analysis, because something really unexpected happens. I mean, if we think about something that was really a big unexpected thing, or that had a certain shock to all the security markets for a time being, was like COVID-19. Remember back 2020, we had COVID-19, and if we look at this chart here, if you go on the left, this represents prices. Amazon's in the blue for Amazon as a stock, And then we've got on here Norwegian Cruise Lines, right? So cruise ship, and we've got the S&P 500, like 500 large USA stocks to just compare them. And if you look to the left, you can see how the lines are together and how this represents prices. And so they're all kind of trending together as far as the prices. And then in February and March, it becomes known that COVID is really going to be a problem, it becomes a global pandemic and gets announced that way, and governments start talking about it in that way. So it sends all the prices down, no matter how good a stock is or how good a security is, it sends everything down because there's this big unexpected event. Now, once the event happens, then things change or can change. You can see where people look at Amazon and say, whoa, wait a minute, in a pandemic where we can't get out and we're locked down and we need goods supplied to us to our home, maybe right directly to our door, where are you going to buy it from? Amazon. This is good for Amazon. And as you can see, Amazon's price took off for the rest of the year from that. S&P 500 rebounded a little bit too, and actually finished the year up a little bit. But if you look at Norwegian Cruise Line, they went way down and hadn't recovered at least during the year of 2020. A little bit of recovery, but not a lot. Because again, this unexpected event had a bigger impact on them. I mean, who wants to be on a cruise line when you got a pandemic? And you remember the early stories about COVID-19, it was people trapped on cruise ships and they couldn't get home, and COVID was raging. So you can see the impact that this unexpected event happens. So sometimes that happens, and you're going to learn about how we're going to put in built-in protections and things like that to limit our losses, like with stop loss orders and things we're going to learn about, and how we can recognize these trends so we can get out quickly to its technical analysis about buying at the right time, but also selling at the right time and avoiding big losses like that. So again, nothing is 100% foolproof, but having an exit strategy really helps. If you had no exit strategy with Norwegian Cruise Lines, you rode that way down, like I think it was down 70% or something like that. And if you're, like, say, a buy and hold investor, which is different than trading and certainly different than technical trading, you can suffer through that, and then you just don't get out. You don't get out soon. You try to ride out the storm. Now you see Norwegian go down so far, it's going to take a longer time to ride out that storm than, let's say, Amazon would. So, but with technical trading, the idea is that I'm actually an active trader around that. So another thing with technical analysis too is it doesn't tell you how much to invest. It tells you with indicators and things whether you should invest and how, but it doesn't tell you how much. We'll talk a little bit about some money investment strategies at the very end of the course too to help you with that. But the actual indicators and things don't tell you like, oh, if I see this price bar or I see this moving average go like this, I should invest X number of whatever of my money. It doesn't tell you that. It just tells you what's happening, and then you decide what action you want to take on that. So technical analysis is terrific, been around a long time, works, but not perfect. Nothing's perfect, right? Let's continue to lay down some of these key foundational concepts. Now, if you've got a good handle on it and you understand how to read a chart, those kind of things, and you just want to jump ahead to a certain section, feel free. That's okay. That's no problem at all. But let's talk about some more of the real key foundational things. And I like to think about that there's these different tools and things that you can use. And a lot of them are free out there too, are these platforms you can actually use for free. And we demonstrate through the course, everything I'm using is something that you can do and replicate yourself for free, by the way. But if we think about it, you can almost think of like an artist, for example, like the chart of the canvas that they paint on. Well, that's a chart, right? That's where you're looking at the prices and some of the charts and things we saw. So that's the overall chart. And then how you interpret or read that chart is where you'd use tools. Just like an artist might, paint with a paintbrush to kind of, in fact, make it come alive. We use tools like that in technical analysis. Price bars, candlesticks, lines and trend lines, indicators like moving averages, volatility indicators, momentum indicators, all sorts of different types of things we're going to learn about in the course. But think of it that way of like, I've got my canvas and then I'm going to apply my tools, and that's going to help me decide, what to do. So let's start by looking at the chart and understanding what a chart is. Think of it as that blank canvas, and you pull up a security and then it fills in your chart, and now you can start interpreting. But you have to be able to read a chart too. So let's walk through how to read a chart. Again, if you're familiar with how to read a chart, skip ahead. But I think it's a good foundational exercise. So let's look at a chart here. This happens to be for a company called Excel Energy. But it could be a chart for Bitcoin or anything. It could be any kind of chart, but I happen to use this one for demonstration purposes. Now, first you might look at this and say, ah! You might scream and say, that's a lot of information. I have no idea what's going on. Seems pretty complex to me. Don't worry about it. We're going to walk right through all the different components, and as we go through the course, I'm going to give you lots and lots of examples. And you'll say to yourself at the end of the course, boy, I am an expert at reading charts in so many different ways. So no worries, you'll be able to understand. So let's walk through the different parts of a chart here so you can kind of get a feel for, for how that works in the different parts. So first off, if you see at the top here, that's just the name of the symbol. Again, it could be a stock, it could be a currency, it could be Bitcoin, Ethereum, whatever. It's basically the name of the security that you're looking at. Usually it's in like a shortened form, but if you put in the full thing, the program will automatically pull up. If I put in Excel Energy, it would automatically pull up, and I wouldn't have to memorize the symbol, but it does that too. And then the period, this is looking at daily prices. So when you look down at the chart, it's going to be daily, and you can see there's a little bit about information about Excel, what its open price was, what its high was, that kind of stuff. So that's the kind of basics to get it started on there. Then if you look down at the chart itself, I put some letters around as we walk through these different areas. So what you'll see on a chart is on the right-hand side, sometimes on the left, but typically on the right-hand side, you're going to see where the letter A there, you're going to see the price, right? So this represents a range of prices that this security has ranged over this period of time, and some highs and lows above that too as well. But you can look across, horizontally and look at a certain price point and see, well, how much, when was it trading at this price point? So that's the right-hand side, or the vertical axis would be the price. On the bottom, on the horizontal, and you can see the letter B there to the left, would be the time frame. And time would go from left to right. So farther back in time would be, like to the left, and more near time would be to the right. So I'm not sure how many days this was, but let's say it's, 50 days. 50 days back would be to the far left, and yesterday would be to the bar to the most recent far right there. So it gives you an idea of time as far as when they intersect, as far as time and price, what the security was trading for at that particular time. So if you look at, let's say, letter C, you can see that's like around, it ranged somewhere around the $66, $67 mark there. You can see, we'll learn about candlesticks, but it represents the high price and low price of the day. But that individual bar there, that long kind of empty bar there with the white in it, that's a price bar. That would show you the price for the day. You can probably see to the right there where some of the bars are turning red. That just means that those prices are at those levels, but they were down. They were going down from their opening. They opened higher and then they closed lower. Don't worry, we're going to learn all about that. But the idea is each of those little individual bars represent price. And then if you look at, let's say, letter D, you can see this is basically representing the whole chart, but basically you can see from left to right how prices move up and down over this period, right? That's, think of the whole chart as a whole, looking at it from left to right, and you see all the kind of ups and downs, peaks and valleys. If you look at letter E, what that'll usually represent on the bottom there is volume. How much are people trading? How many active people are trading the stock, both buying and selling? And it tells you if some days they're trading more frequently than others. You'd look to the right, for example, of these little bars. You see where they're taller in some cases towards the right. That means there's more trading volume than on other days where the bars are shorter. As technical analysis go, that actually tells us things, that when there's a lot of volume, that means something's happening. And we'll talk about that as we go through the course. But that's something to note as far as with volume, and you'll see that on a chart. A lot of times on a chart, you'll see, like with the letter F, you'll see things that are overlaid over it. Typically, you would just see the price bar, the price peaks and valleys, but you can overlay things over the top of that to give you an idea of something. Like in this case, we've overlaid these lines that represent a 50-day moving average is the blue one, or kind of purplish, and the pink one, or reddish, is a 200-day moving average. Got a whole section on moving averages. It's a great indicator. But basically, you're looking at what's the price been, averaging over the last 50 days or the last 200 days. That's why the lines have different looks to them. And when a price bar crosses over, the line crosses over your individual prices, that can tell you something, whether to buy or sell. Or if the two bars or the two lines cross each other, that can tell you something too. For now, all you need to know is that there's things that you can overlay over your chart that you're going to learn all about that you can use to help as far as deciding whether to buy or sell. And then G is kind of like where you can add things on the top or bottom of charts depending on your software or the platform you use. This one just happens to be an RSI, a relative strength indicator. Have a lesson on that, no worries. And it just gives you some additional level of indication whether you should buy or sell. If you look to the left there of that kind of that long plain line there, you might see where it peaks above the 70 number. And that's not the price, by the way. That's a different kind of representation that we'll learn about. But you can see where it peaks above that 70 number and it's kind of grayed in there. That's where it's telling us that this might be a time to sell. And if we look down, straight down from that that gray part, we can see it really, our prices started to really peak there, right kind of where the letter D is there, and then started to turn and go down, right? So if we look to use this relative strength indicator, we could kind of confirm or look and say, you know what? We've had a nice run up in prices all the way from the left to the right, getting a little high now. This relative strength indicator, which is an indicator we can use that's based on math and technical analysis, is telling us, hey, we might want to watch this. We might even want to sell because we could be running out of steam and time to sell. And you can see how they kind of match up, together, and they actually went down. In fact, if you keep going down further, you see that little spike in volume there. That can be an indicator saying, a lot of people are thinking the same thing and maybe looking to, start thinking about getting out of this particular security. So this is where they can kind of all work together. So the idea of a chart, if it still seems a little confusing to you, no worries. When we go through the course, I'm going to show you charts. I'm going to show you things. I'm going to walk right through, and it'll become even more easy to understand as we go through. For kind of an extra credit or whatever, we can say, if you look at this example chart, what might it be telling you? And let's just concentrate on the right-hand side there, like where these big, long red bars are more towards the right there. What is it kind of telling you? Do you have a feel for what it might be telling you? What's happening with the price? Is it going down? Is it going up? Is it going up sharply? Is there a period where it might be going down sharply? And if you look closer to it, and as you learn to read about charts, and don't worry if you don't get it yet, no worries at all. But just look at it and say, okay, here, if I look at this period, boy, that really went down, right? It started, okay, pretty high, around 74, and then went real steeply down, those long red lines, and then kept going down, down, down. Look at all those red days in a row, a lot of volume in the bottom, so a lot of people were selling. Then it kind of, went sideways a little bit and then kept going down again, right? So you can kind of learn from that as far as what's going on we'll learn about trends and things, but we'll learn why is that happening, how can we anticipate it, and how can we, in fact, either avoid it or take advantage of it. If you look to the right of where I've kind of highlighted there, you can kind of see where it's kind of stayed in a narrow trading range, we would call, where it's not gone up a lot, not gone down a lot. It just keeps bouncing up and down. So the range looks to be around 64, let's say, dollars and $66.50. And the current price there on the right, that'll highlight in black when you look at a price chart, by the way. It'll say 66.02 is the current trading price. Now, do you buy? Do you sell? Do you do nothing? Well, that's what we'll learn about in the course. But if you think about it, just kind of, common sense wise, you could say, well, if I'm in this trading range of $64 to $66.50, and right now I'm at 66.02, there's not a lot of room to go up. In fact, there might be more downside risk than upside gain. So that might be one way you can certainly look at it as well. So reading charts or admiring the artist's canvas, and you're the artist, not a hard thing. And as we go through the course again, you'll learn it, you'll be comfortable with it, and you'll love it because you're going to be looking at charts all the time and making great decisions using those charts and the tools and indicators that we're going to learn throughout the course. For a lot of people, what's a kind of a hang-up is like, well, what time frame should I use? How far back should I look when I'm trying to evaluate my charts? And what kind of trader am I? How frequently do I trade? And does the time frame impact that? And that it does. The length of the time that you consider for your technical analysis can change the way you look at things for sure. You can look at things based on minutes, real quick changes, or hours, or days, or weeks, even months or years. And while the concept, the universal language will be the same, how the chart looks and how you interpret it might be different if you're looking at, let's say, hours in a day versus, many days in a month. And there's kind of things where you hear about, there's certain types of traders, like day traders, that have terminology around that, or a swing trader, an active trader, different things. For right now, I don't want you to worry about any of that. You don't have to worry about your time frame. You might already have a feel like, oh, I want to be a day trader. I just want to trade every once in a while. All that's okay. You don't have to pick your time frame right now. In fact, your time frame will kind of pick you as you go through things and you start paper trading and practicing and backtesting. You might find that you actually like or gravitate towards another one as you get through the course. Again, the tools and indicators will apply no matter what the time frame. So, for example, a day trader would constantly buy and sell during the day, right? They're constantly buying and selling. They're doing that. And at the end of the day, the whole idea of day trading is you're going to close out all these positions, or basically things that you bought, and then you're going to sell them at the end of the day. So you don't carry anything forward, no stock or security or anything that you're going to carry forward in the next day. So for a day trader, their time frame, because it's all going to happen a day, they're looking at minutes and hours, right? They're not going to be concerned about, months, because it's not happening in a month. It's happening over this shorter time frame. Again, no right or wrong answer, just that if you want to do that, you're going to adjust your time frame. And at the end of the course, we'll talk about this in more detail as we now apply those concepts as far as trading. So a day trader might think, oh, it's my job. I look at minutes and hours. An active trader might say, oh, I love it. And they might look at days and weeks and months. They don't trade as much. And certainly a buy and hold investor might look at, when they maybe get into a security, but they don't really trade much, getting in and out. They get in more, but they get out sometimes. So it'd be looking at more weeks or months, maybe even years as time goes by. So picking a time frame, once again, you do not need to decide now. That's very important. Don't worry about that. Concepts work the same, no matter the length of time. And however long the time, one thing to take away is the more established the trend is. A trend that's been going on or a certain direction, for months is going to be a very strong trend versus something that's going for minutes or hours that might change quickly. And thus you're getting in and out of positions quicker if you're a day trader than, let's say, if you're more just every once in a while trader. Both are perfectly fine. One thing for technical analysis and technical analysis traders, we're really concerned about breakouts and retracements and understanding the difference between the two. And so if we look at that in this lesson, normally you have a trading range or a price range where you have a low price range or low price, and you have a high price, and the security will trade within that range over a period of time. And again, that period of time could be hours, days, months, whatever that period of time. But price will tend to stay in that range. And you might have some general trends within that range where it might be flat or kind of going sideways, or you might have a general uptrend, or you might have a general, let's say, downtrend kind of within that range as stocks or securities constantly changed, throughout that time frame. But then things can happen, where it can break those general trends and start, reversing or going into a different trend. And is it truly happening, or is it more kind of like a fake and it's not really happening? And that's very important for us as technical traders to know when to help us when to buy and when to sell. So if we think about that, and conceptually, trends will continue until the pattern breaks, right? So something's got to break the pattern. And a lot of times what happens with breaking the pattern is something happens. There's some type of thing in the news, for example, an earnings announcement, something on a global scale, whatever it might be, or even just a rumor might, break the pattern. And that's what might be a breakout, right? It's going to break the pattern. Or it might be a retracement where it's really not a true breakout. And that's the idea, is something happens, there's some news or a rumor, and then something's going to happen, right? So traders are either going to do nothing, but they might, let's say, start to really panic based on that news and sell real quickly and really panic. So, oh my gosh, this is terrible news. I got to get out fast. And so they kind of selling maybe quickly. The same thing if the news is great and there's some great announcements, they might have that fear of missing out, right? FOMO, right? They're like, wow, this is really taking off. I always thought it was really good security, but now it's really going. I got to get in fast and buy, right? So you have sellers and you have buyers, right? So that disruption is actually called a breakout, right? So that means something has changed and you've broken out of the new pattern. And there's either going to be a new uptrend, going up, or there's maybe going to be a new downtrend. And you might also have like a false breakout where it breaks out, but it's not really due to supply and demand or market sentiment or anything. There's something that's, causing a short-term disruption into it. And that could be something like which relate to like position squaring by big players, right? Real big holders of things that might be adjusting their holdings in a particular security that's causing some disruption in the market versus some more legitimate news. So like if you think about what's some examples of this, kind of like big players doing a disruption that might be a false thing, not a true breakout. Now let me share a couple examples of things that are like that. So let's say you're a fund manager, a mutual fund manager, you own all the stuff in this mutual fund, millions and millions and tens, hundreds of millions of stuff. Let's say for an S&P 500 fund, and it's an index fund, and you have to buy more Tesla because they were just added to the index, which that happened not too long ago. So they're added to the index. They weren't in the index before. So now you just have to buy the stock because they were just added to the index. It's not because you think they're great. It's just you have to do it. So that's going to cause an unusual amount of buying, and that's going to, change that breakout because all of a sudden there's a buying for a reason beyond just, let's say, market sentiment. Or let's say Apple announces that it's going to buy its own stock back in a big purchase as part of a company stock buyback program. They're going to, buy their own stock back. So that means they're coming in and they're actually buying stock on the open market. So if you think Apple's coming in to buy a whole bunch of stock, that's going to drive the price up, right? So that has, again, nothing to do with individual traders. It's a big player coming in being disruptive. Or let's say a fund manager of a big technology mutual fund wants to lock in gains before the end of the year because that's how they're evaluated. Maybe that's how they get their bonus, right? So they want to lock in a nice bonus. And they just had a big run up in Zoom stock, for example. So they want to sell a ton of their Zoom stock so they can lock in their gains for their annual performance and get a nice bonus. Does it say having to do whether Zoom is a good company or a bad company, or whether technical analysis says that we should buy or sell it? No, it's a fund manager has a big player who wants to get a bonus. So sometimes those things can happen. It's not often, by the way. It's not something you have to really worry about, but just understand that it's out there. And sometimes when you see movement and you see something like there's a big announcement that might be related to it, you want to say, okay, is this really happening? Or is this just going to be a short-term type thing and it's going to come back and pull back? In fact, we call that pullback retracements. And that's the breakout is where it breaks out and now is forming a new type of trend. Retracement is where it breaks out a little bit, but it's a minor move that's going against the trend and then it's going to come back, like that big player repositioning. So if traders think a current move has gone too far, they might have a little course correction or a little pullback, but then the trend might come back up again. As we learn through the indicators, we're going to learn how to spot breakouts and retracements and how to kind of use confirming things to see whether we're seeing a breakout or a retracement. Is it a true move or is it kind of a temporary type of false move? And sometimes you might see retracements, for example, where everyone has either bought or sold, right? There's an overbought situation where, everybody wanted to buy has already bought, so it's extended, so it's kind of have a natural kind of come back. Same thing if something's oversold. And we have these tools that can help us with that. One is the stochastic oscillator, which is a fun thing to say, and also will help us to identify things. And there's other tools and things we're going to be learning about that'll do us too. And a lot of times, another good way to look at it too, just early on, if you see volume rising, that bottom part of the chart, and you see volume rising where there's a lot of trading activity, but there's hardly any price movement, hardly any price increase, then the move is, whichever is happening, is probably ending. It's starting to stall out. So we think something's been rising, uptrend, for example, it's been going great, but now there's hardly anybody doing it now. It's really starting to slow down, stall out. Might be a time either for a temporary pullback or retracement, or maybe we might even have a breakout in the opposite direction, where it might go, backwards. So retracements, they can turn out to be actual trend reversals. I mean, it looks like a retracement, but really it actually is a breakout and you have a new trend, or it might be truly an actual retracement where it's just temporary and then it'll kind of go back to the way it was trending again too. All this very normal. And with the technical analysis that we're going to be using our indicators, we're going to be able to handle and deal with both breakouts and retracements and identify great opportunities to purchase and also identify times when we might need to sell and get out as well. It works both ways. Well, breakouts and retracements are actually very normal, as we mentioned. Normal continuation of a trend or just a temporary change. That's all normal, but oh my gosh, some people behave badly and try to manipulate situations, manipulate the system, and really try to manipulate us as honest people and manipulate others. And how they do this, one way that you can behave badly as a trader is they make up their own news, or they spread rumors, or they do some dastardly recommendations, or they talk, they try to do some unfair trade practices like insider trading, whatever it might be. They're trying to do something that's not ethical, to try to influence the price and try to get others to kind of be tricked into that. So just be aware of, sometimes some traders can behave badly. Now the governments, are out there with regulations and things to help protect us, particularly things against like insider trading if you're looking at stocks or things that might be, manipulation of currency or whatever, these types of things they have on there. So let's say, for example, on the stock market world, if a CEO, makes a statement that will try to raise the company's stock that is a false statement, then there's laws against that and that person can be punished for it. If they're a drug company CEO, for example, and they say, we have the cure for cancer. Well, if somebody says they got the cure for cancer, the stock is going to go skyrocketing. And they said, oh, I guess I didn't mean it. Then their stock's going to fall. But meanwhile, the CEO and others who he's friends with could raise that stock up, sell it, get out, and then let it fall back down because they lied and manipulated the market, behaving badly, and is illegal. Or they can post false things to try to raise the stock price automatically, or not automatically, artificially, and then try to sell for a quick profit. And that can be just regular traders putting out rumors or theories or ideas that they really have no basis of fact on. They're just trying to manipulate the price is what they're doing. In fact, there's a term for that where it's called pump and dump. This graphic's a nice graphic that kind of explains that. You look at our price and time there on the horizontal vertical axis. And so let's say if you're back there at the the 10-cent level, right? And you want to pump up that price, right? So they're usually going to talk about things like the next hot tip or next big thing or whatever. You might see people posting blog posts or things on forums or saying things like, there's definitely a breakout coming. It's going to go up high. Oh, you got to get in before it goes up too high. And they'll promote it on a forum or blog or YouTube or wherever they can promote it in social media. And they're going to promote this. This is all great. And they have no basis of fact in it. They're trying to basically trick you to get people to buy and raise that price. You see a lot of it, by the way, if you later on, if you decide you start applying this and you want to trade very inexpensive stocks, very, very inexpensive stocks like what are termed penny stocks, or a lot of cryptocurrency, especially in the altcoin world, not so much Bitcoin, but some of the altcoins that are newer, less understood, maybe lower, things that are lower priced is the idea, is that can be manipulated easier. There's less traders in those areas, and the price moves can be more dramatic because going from 10 cents to 15 cents is a big move, versus trading, let's say, a security that's trading for hundreds or thousands of dollars. And always consider the source when you start seeing these things, a hot tip or whatever. But the idea is that they take something that's, let's say today trading for 10 cents or 0.10, and they're going to keep promoting, and try to drive that up to, let's say, 0.90. That's the pump part. But they have no basis for fact, right? And then what they do is they dump it, they sell it, they get out, right? They get out at 0.9. And then maybe after it starts falling a little bit, they say, oh, it's maybe not that great a thing. It's not so good. And then it goes down in price, right? But meanwhile, they've made their profit. So that's pumping and dumping. Just be aware of it, especially on things that are more narrowly traded, like penny stocks and alternate coins in things like cryptocurrency. But it can occur basically anywhere. Even though we're trading individual securities, it's good to always be aware of what is the general broader market sentiment. What is generally happening in the markets? Are they moving up? Are they moving down? Are they sideways? What's going on in the bigger market? Because the individual securities will tend, not exclusively, but will tend to follow the overall market trends. They not necessarily will go up higher or down lower. Those things happen or don't happen, but they'll tend to follow along. Think of it like a rising tide lifts all boats, and the same thing when the tide falls, all the boats go down, right? So it's a similar thing with prices and securities. And there can be headwinds and tailwinds that you're fighting against too, maybe with an individual security that's either helping it, a tailwind, or hurting it, like a headwind, no matter what it might be as far as what you're looking at. So understanding that broader market sentiment can be very, very important. Again, if we look at just this chart from the COVID years, you can see where even though you have these very different things, Amazon, which ended up doing very well, and Norwegian Cruise Line that did not, you can kind of see to the broader market in the green where I've circled where they've kind of stayed together. You can see where, like, let's say versus the green line, the broader market of 500 stocks in the middle there by the picture of the COVID, I guess. And you can see how the Amazon stock went up faster, but it still went up higher along with the market and then flattened out around the same time too. It doesn't match up necessarily exactly, but it's pretty close most of the time. So understand that broader market sentiment can be impactful too on how you might want to trade. So sentiment indicators, and we have some coming up later in the course, like Bollinger Bands and other ones, can help strengthen your decision making as far as what you want to do. And if, in general, if the individual security is going, let's say, with the market sentiment, that's a good thing, that helps you. But if it's going against the market sentiment, that would be something to be aware of as well. Doesn't mean you can't. That's part of contrarian investing and all that too. In fact, that's where sometimes the best opportunities lie, is going against it. But just understand that you have this broader market sentiment out there. And there's some indicators out there too, like in stocks, there's a thing called the bull and bear ratio. It primarily looks at USA stocks, but you might have a similar thing as far as with other markets too. And it's basically just tracking or serving professional financial advisors or finance professionals. And weekly they publish data by a firm called Investors Intelligence that tells you whether there's more people who think the market's going to go down, or bears, or the market's going to go up, or bulls. People think the market's going to go up, or prices are going up, or bulls. Prices go down, market's going to go down, or bears. And so they have a flat line of 0, and if there's more bulls than bears, then the number's higher, and by what percentage. So you can see here on this example at the far right, the bulls were exceeding the bears by about 19.28%, but it fluctuates around there. It's not a super great gauge, but it gives you an idea. Maybe another one is the advanced decline ratio, or A or D, where you're literally looking at the number of stocks in a particular exchange, trading exchange, whether they closed higher for that day or they closed lower, and you kind of do the math as far as what's the ratio on that. Here was an example of 1,881 were above and 1,268 were below. So the advanced decline ratio was 1.48, the 1,800 over the 1,200. A bullish sign would be anything that's greater than 1.0, right? Less than that would be bearish. So you're kind of comparing that to the previous trends and numbers and things as far as getting an idea of overall market sentiment. But we have some actual indicators coming up that I think will be even more impactful. But these are just some things you're going to see in the broader market. One thing that is very impactful and really to look at closely whenever you're looking at individual securities to trade and be aware of is volume. How much, are there a lot of people trading something, or is it really kind of low volume in a particular time? And you're looking at that volume over a period of time. And a high volume can help confirm a price move. They'll kind of go together where whether up or down, there's a lot of trading that's driving that action. And sometimes the volume can lead the price where something is coming. There's a lot of people trading because they think something's coming, an earnings announcement, an announcement of some sort, or there's just something going on that's, an indicator showing something so people are getting in or getting out. And so volume can help precede that sometimes. Sometimes it trails, but a lot of times it may precede it. And certainly when the event happens, that's where you might see a spike in volume too. Like if we look at this example here, I like to use it from Norwegian Cruise Line because it was during that COVID period, it was just so reliant on COVID-19 news, especially if it was positive. And you can kind of see these where it has these big spikes up. And if you look at the bottom, you can kind of see the volume go with it. I mean, that first spike was a big spike, and the volume did go up. The bars did get higher on the bottom, but it wasn't a real big confirming, a thing of that. And it kind of quickly turned back around and went way back down. And then the same thing where, volume kind of goes up, and that big tall one in the middle there, or the third one to the right, you can see there's a whole series of bars below, before and after, kind of around all that COVID-19 news. Maybe that was around like vaccines and things. That's looking like, mid-June here in 2020. So you can kind of get a feel for that too. That would really dramatically impact a particular cruise line stock, because until COVID is under control, people aren't taking cruises. So does that impact anything as far as other stocks? It could. But, particularly for this one, you can see how volume can be a good indicator around that. And as we go through some other indicators, might see volume tied to it as well. All right, so we've got some foundational concepts here, but now let's get into some really the detailed stuff, and that's the indicators. This is the tools, the things we're going to actually use to help us, make decisions around securities to buy or sell, for example. And indicators are really at the heart of technical analysis, and it's really our technical tools we're going to use to help us be successful. And indicators are all based on things like math and data and trends and all that. It's very focused on trends, of course. You want to anticipate trends and then make your decisions based on where things are headed or where the trend is headed. And technical analysis and using indicators is also all about eliminating emotion. You're not tied into, well, I love that stock, or I love that last movie from Disney, so I'm going to buy Disney stock, or whatever. I heard a great thing about Bitcoin, or whatever it might be. It takes emotion out of it, and you're really looking at these indicators from a real unemotional way. What is the indicator telling me versus my likes or dislikes about something? And that makes them very, very good to use in that manner, very way that takes emotion out. Now, they're not perfect, because nothing's perfect. If there was, I would have one lesson, and it would be about what's the perfect indicator to use, and that would be it. But they have different applications and different ways you can use them, and some work better than others, or in certain situations or with certain types of securities. And we'll go through that as we go through the course. But just be understanding that nothing, of course, is perfect. In fact, really beware of anybody who says, I've got the perfect system or the perfect set of indicators or things of that nature. They don't. They might be able to share some good stuff and might be helpful, but just beware of anybody who's trying to sell you something for money that is the perfect answer that's probably or it is fraudulent because there hasn't been a perfect indicator out there yet. So indicators at their heart, what they do is they're technical tools that help distinguish between noise and an actual event. Okay, so what is that? So an actual event is something that's real, something that's happened either with a company or an organization or a currency or globally, whatever it might be, something has happened in a broader sense or specific to that security. And it's a real live event that's going to make a change that's going to happen with trends, whether they're going up or down or sideways. Something is a real change versus noise. Noise is things that are not dramatic and it does not change the overall trend. It might cause it to blip up and down a little bit, but it's not going to actually dramatically change the event or change the trend, where an event definitely is dramatic and changes the trend, or it might strengthen the trend to have it continue in a strong manner, whichever way it is, but it's not a temporary thing like noise might cause. It's a real thing. So that's the difference between noise and events, and indicators help us to separate that out so we can kind of tell what's true and what's false and what might be really the core things that we want to focus on as far as making our buying and selling decisions using indicators when events happen. So let's look at an example of these noise and events, for example. So let's say you have a drug company and they say that the new drug that they've been working on launch will be delayed 60 days. All right, so that will cause, let's say, the stock price and things to go down for that particular company. It is legitimate, or it might go down temporarily, but it's more noise as in, they're going to be fine in 60 days or just delayed 60 days versus something that's a significant event where, let's say, the same thing with this new drug fails a government approval trial. That's a bad thing for drug companies. That means they might have to start all over. They might just have to pull all their research and development around that drug. Something wrong has happened, and it's going to cause a significant change in the trend. In this case, it would probably cause a significant downtrend based on that event. So you get a feel for these events and noise, and the indicators, again, help separate out the noise. So we think about what is actually an indicator, defining it, so to speak. An indicator is a line or a set of lines or some type of mark you put on a chart to identify events and clarify and enhance the investor's perception of the price move and are looking for things like, is the stock price trending? Is it going a certain direction? How strong is that trend? What's the degree of strength? And is a trend turnaround point, about to be reached, right? So that's what our indicators are telling us. Which way is the trend? How strong is that trend? And is that trend going to change or go maybe in a different direction? If we know those things, then we can make buy or sell decisions based around that indicator or maybe a set of indicators to help confirm between primary and secondary indicators. Another way to look at this is, what do indicators specifically kind of try and identify? They're going to try to identify, is a trend beginning? Is a new trend beginning? How strong or weak is that trend? Is it kind of going to be weak, or is it going to be really strong and we want to get in that trend? Whichever way it's going, up or down. Is the trend retracing? Is it got a temporary pullback, but it's likely to resume, let's say, for example? Is the trend ending and may it, change or reverse or go the opposite way, basically? And also we can use indicators to indicate a trading range, high to low. What is the range that's going on with a particular security as far as the pricing in there? And that'll help us decide. Again, all these things are designed to help us as far as whether we want to invest or not, or when we want to buy or when we might want to sell. And if you look at each of these things, and all these different sections we have coming up are going to start identifying these things. And we'll apply concepts like these different indicators, like for identifying beginnings of trends, we might use a moving average crossover, momentum for strength of the trend, relative strength index for looking about, is it going to retrace but then likely resume the trend? How can we identify that? We could use the RSI, or relative strength. We can use multiple types of indicators for things like, for example, is a trend ending and may reverse? Well, we got patterns and breakouts and momentums and crossovers. And what's the trading range? That's things we can use too with that, like Bollinger Bands or ATR, average true range. So as you can see, we've got different ways that we can use these different indicators to help us decide what we want to do. And ultimately, what all this stuff that we're going to learn is, indicators are designed to provide us buy and sell signals, or at least a warning that something might be happening, to help us to be better traders, to be better investors, to make better decision makings. And really, if you look at these different types of indicators or signals on buy and sell signals, a warning signal or a buy or sell signal. There's really kind of three broad things that they're going to talk about, or three broad ways you can kind of look at these signal types. And those are crossovers, meeting a range limit, or are things converging or diverging. So just to give a couple highlights on that, and I'll highlight some of the things you're going to learn in great detail coming up. Basically a crossover is when one line is crossing another, and it's going to show things like a breakout. So you can kind of see in this quick little example, you can see there's a trading range there with these two bars on the top and right, and everything's kind of narrowly constrained. But the top right, you can see where it broke through that range, broke through that kind of artificial line we put there. That's showing that it's crossing another line, that's showing it's breaking out and that a new trend is forming. But we're going to learn all about that as we come up, as far as that. But that's the idea of crossing lines. Also, we have range limits, things like, funny names like oscillators and momentum indicators, where we're going to look at what are the trading ranges and how do things fluctuate, within an upper and lower band of a trading range. And as they approach them, how are they going to, are they going to indicate things like is something overbought or oversold? Or can you combine these different types of range limit type trading and looking at things like movement and moving average indicators to signal trend breakouts and reversals? So there's kind of big, broad aspects of that. And then you have these ideas of convergence and divergence, where two things are coming together. Prices are narrowing. They're starting to get closer together within a trading range. And sometimes they're diverging or getting further apart. You can see, time on the left going left to right in this example, and price going up and down as far as height. And you can see convergence where prices are starting to get closer together. Divergence where prices start to, go further apart is the idea behind that. So these indicators are these broad concepts, indicators. We're going to put all this together. We're going to learn a whole bunch of different indicators and different ways that we can kind of analyze investments and analyze securities so we can make the best decisions by using these indicators, by using these tools. And that's what we're going to start learning at and start building that up from the foundation up. One of the most important things to learn is understanding price bars. How is price represented graphically, visually? So you can chart, so you can start identifying and you can start using it and start using indicators to make decisions. And you think of that concept of a picture is worth 1,000 words. Well, that's the idea where price bars are going to represent things as far as what's happening with an individual security. And there's several different types of price bars. We're going to learn about them all, but they're the key building block, and some are real powerful, like a candlestick bar. We have a whole section just for candlesticks because they're such a powerful way of representing things in a price bar. But as basic foundational, price bar, to represent price at the basic core level, and the key one to kind of start with and then kind of grow from there are what are called OHLC price bars, or they stand for open, high, low, and close. Pretty simple. So if we look at, let's say, this price bar on this graphic here, you can see on the left is the prices going up and down, and time going from left to right. Farther back in time is left, more recent time is to the right as prices go across. You'd see that represented on a chart. But if we think of price just in the price bar aspect, you can see this like straight line up and down, and it's got two tick marks, one on the left and one on the right. Not sure how that visually came across to the camera, but you can kind of see on the idea that there's one on the left and one on the right and one in the middle here. And basically, if we were looking at this particular price bar, or any price bar, you can see that it has a high and a low. That's its trading range. So let's say if this was a daily price bar, or a daily OH, open, high, low, close. So for the day, we can see that the prices fluctuate between a low and a high. Now we can also see from this price bar, it tells us even more information. We can see what the price was at opening. When the markets opened and they rang the bell and the markets opened, people could start trading. This was the first or opening price. You can see where that tick mark bar is on the left there. And you can see that this, it might be a little bit closer to the low. In this example, it doesn't have to be, but in this example it is. And then it trades through the day in the high and the low, and then on the right you see another tick bar. That's the closing price. That's what it ended up at the end of the day. So that was the last price that was traded at in that trading day. We can look at that high and low. The difference between the high and the low, by the way, is the trading range. The range of prices. So prices didn't go above the high. Prices didn't go below the low. They're within that trading range there. So that you can see with the name of it, open, high, low, close, pretty simple, right? So if we look a little bit closer at that, if we see, an opening, it's above the previous day's close, that might be an indicator that maybe a price increase is coming, that we want our security prices to rise, right? If we're buying, we want them to rise. So if they are opening, before, above a previous day's close, that can be an indicator that prices might be rising. The opposite of that would be if it goes below, the previous day close, that maybe a price decrease is coming. Now, I wouldn't trade just on that. We want to have a lot more than that, but that's the general idea as far as, looking at an opening versus a closing. But a lot of people don't put a lot of stock in openings. I will tell you, whether you put more emphasis on the closing price, that's more important. That's the most important. It's really kind of a summary of the trader sentiment for the day, right? It could open at anything, but at the end of the day, after we had this highs and lows in this whole trading range, at some point there was trader sentiment and it closed. The last price of the day was the closing price, and that was where the trader sentiment had. And that's where a lot of people will buy and sell right towards the end of the day to close positions or kind of lock in where they want to be. And they're deciding, do I want to hold this security overnight? Or which might be yes, which might be a good positive sign, or am I selling it more and driving that closing price down? Because no, I don't want to hold it overnight because I don't believe in it as much or whatever. So that it's in a real microcosm of just a day, you can kind of get this feel for what sentiment might be within that daily thing. And then whatever it opens up the next day, well, that's an opening at that point, but you can get a good feel for the closing prices. And that's why when a lot of people are looking at prices and trends, they're really looking at closing prices as far as using mathematics or some of the things we'll learn about when we're looking at averages and stuff. They'll typically use a closing number versus, let's say, an opening number. If the close is, let's say, now we want to see, well, how can we use this in a simple price bar? If the close is higher than yesterday's close, so it closed here yesterday, and today it closed at this, and then what might be happening for tomorrow? If they're closing higher day after day, that means there's more demand for that particular security, and people are willing to pay higher prices for it. So that's pushing the security up, and that would indicate really kind of a good buying trend, right? Because the closes keep going high. So it's a strong buying signal as the close is the high of the day. If the actual peak of the day is the actual close, it comes real close to that high of the day in the trading range. That means that people are really buying at the peak right up to the last minute and they want to carry it overnight. So they're really like, I want to get in and I want to buy up there. So that can be a real strong indicator when you have your close near the high of the day in that trading range. If the close is lower than yesterday's close, kind of the same thing, but the opposite, day after day, less demand and people are willing to sell, and they're willing to sell at lower prices. You have more of a selling trend versus a buying trend. So you can look at those closes as far as looking at trends, and we'll be learning how to draw chart lines and trend lines and all sorts of stuff so we can kind of graphically represent this. But that concept of higher highs is good as far as buying, and lower lows might indicate selling. And that can be, represented here with like different sentiments. Like, if you have, let's say, the price bar on the left, that might be considered a bearish or a downward type of sentiment where we have our normal high-low range. But you can see how the opening opened up pretty high, but then the closing was way down more towards the low part of the range, and the close was below the opening. That would be a bearish or a sales sign in a single day price, looking at price. But if you look at the one on the right, you can see where it opened lower and it closed up higher, right? So that could be more of a bullish thing. And actually, if you were looking at more tick bars, it'd probably be represent bullish would be more of a black line or green line versus red line. But you get the idea here where it opens lower and closes higher is the idea of something that would be bullish looking at opening and closes. Now, the daily open, high, lows, close, you also want to consider the high and the low too. What was the highest trade of the day? What was the highest price of that trade, in effect? And the relationship to the previous day's close and high is important as well when you're looking at a series of prices over, let's say, a chart. Same thing, the lowest trade is the lowest trade, or the low is the lowest trade of the day, and you're looking at that relationship to other bar parts like the opening in particular, or a lower open may mean that they may be factoring in new stuff, or trending lower. So you're looking at that range of price bars. So the pricing, price bar can tell you quite a bit, and that trading range can tell you quite a bit too. How big is the difference between that high and low bars? Is it a real short, difference between the high and low, or is it a really long, vertical line going up? And there's a wide range of prices that things are being told at. So you want to compare that in relation to maybe other price bars that are preceding it. And you can start seeing that if there's a small range in the sea of larger ranges, where all of a sudden the price bar you're looking at for the most current day or most recent day or time period, whatever that is, you can see that, well, it would be a day, you can see that, maybe the ranges are getting smaller, then there might be some indecisiveness happening. They're trying to figure out, do we go higher, do we go lower, looking at that trading range. Same thing if the range is large in the sea of smaller ranges, all of a sudden everything's going small, 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 as far as a high and low range, all of a sudden it starts to get really big, that, a big wide range, that might tell us that an event or something is happening. People are trading more actively. There's a lot more interest in this particular security. So something might be changing. It could be going up higher, it could be going up lower, but it's an indication with trading range that something might be happening. And you can also link that to the volume, how much trading is going on too, because trading range is just looking at the price, where volume's looking at the actual number of actual trades happening, and then together they can give you some good indications. Let's look at some classic trend formations with these price bars and a series of price bars that you'll be seeing all the time when you're trading and looking at things. And if you're taking notes, I think that's very helpful, very good. There's going to be two things in here that I'm going to mention that it might be worth a note on, and I'll tell you when I share them with you, so you don't have to try to guess at that. I'll tell you this might be a good thing to take a note on. But there's two big overriding concepts that are coming up that I think are very important. So if we look at classic trend formation with price bar series, so we're looking at price bars, open, high, low, close, and all that, and they have a series of price bars over a period of time, right? So if we look at this series, or if you're looking at a series, and they tend to be, let's say, uptrending. So the highs are higher. You have higher highs. So each day, the high is getting higher than the day before. And that gives you some additional confirmation that it might be, basically, an uptrend, or an additional confirmation if the lows are also higher too. So your highs are higher and your lows are higher, everything's higher and prices are going higher. That can give you a signal of a strong uptrend. And if you feel that trend's going to continue, you might want to buy in and enjoy, that uptrend and ride that uptrend until it's time to sell. And you can enjoy a price increase and profit from that. By the same token, a downtrend would be lower lows, right? You're looking at the lows and are they going lower? So is the low today lower than yesterday, or lower over the past few days, and looking at that trend? And again, if the highs are actually lower, the high of the day keeps trending lower, then that's a stronger confirmation indication too that everything's going lower. It's rarely that perfect. Sometimes you have ups and downs and all that and pullbacks and things, but you're going to be looking for this overall trend, where things are happening. And one of the key things, and this would be the first thing that maybe take a note on, is you want to wait for the trend to develop. Where people really struggle is they might think, oh, I think a trend's developing, but they haven't really proven it yet, or they haven't really shown that from a technical analysis standpoint. You need to let the trend develop a little bit, and so that it's a real trend and not just kind of a fake where it's going to go the opposite way you want. The way to lose money in technical analysis is to kind of guess at things before they've actually developed. You want to let things develop. You want to have trends develop. So that's a key note to take away, is let the trend develop. And we'll learn how to draw trend lines and things. We have a whole section on chart patterns. But right now, higher highs are upward trends, lower lows are downward trends, is a classic way to look at that. And you can see that kind of graphically here too, as well. So if you see on the left here, the uptrend, you see how the tick marks on the right-hand side, the closing prices, you see how on the right-hand closing prices, they're always going from each price bar, each up and down price bar, how they keep going on the right-hand side, keep going up. That's showing a definite uptrend because they keep going up. In fact, even the lows look like in this here, let me double check. Yeah, it looks like the lows are going up too. So this is a strong uptrend where the higher highs are higher and the lows are actually going higher than the previous day too. Again, left to right over time. Same thing with the downtrend, left to right, further time would be in the back. You can see how the closing, the lower lows on the right-hand side, how the prices are getting lower each time. Just a little bit. But so it's not a super strong one, but you can see the right on each individual vertical bar, how that represents a day, and how each little tick mark on the right gets a little bit lower each day, showing that there's a downward trend. Now, if we were to look at that over, let's say, a broader price chart, and we'll be doing things like this here throughout, and this happens to be an example from Procter & Gamble or P&G. They make household products like cleaning detergent and stuff. You probably use their products. And the part that I just showed you in the example I actually pulled from a real chart. And I highlighted that here with little green dashes. And you can see how, if you were trading this, you could see, on the far left of where the green starts, where the green highlight part is, actually going all the way left. If you go all the way left, you can see how the price bars were kind of up and down, right? Kind of, there's no definite trend. They're up and down, right? outside the green area to the left. And then they start to turn going upward, those black bars going upward, and that's what we were showing the higher highs. And then it reversed, and the trend went to those 3 price bars where it went lower, and you had a little mini trend there of lower lows, and it started trending the other way. And then if you go beyond that, beyond the green box, you can see it went up for a day, and then down for a day, and then started kind of going, sideways a little bit, up and down, and then you can kind of go on from there as far as some significant price moves both up and down. But if you look inside the green box, you can definitely see a strong upward trend, and for a short period, a downward trend there just based off price bars. The second thing I think you'd want to take a note on, by the way, is not only wait for the trend to develop, but also understand that the trend is your friend. Probably the most classic thing that's ever said in technical analysis is the trend is your friend. You'll see that come up every while. Because the idea of the trend is this gives you some prediction capability. When you have those strong uptrends, you can kind of predict that will continue, and you can kind of identify when that trend might be over. So the trend is your friend. Look for trends. You want to be friendly with trends for sure. And that's the key part of a lot of technical analysis, is identifying trends and making decisions around that. So remember, the trend is your friend, but also you got to let your friend develop. So let your trend become clear and develop, and we'll be showing you how to do that up in upcoming lessons. If you started playing around or looking at like charts and things like that, you've probably noticed spikes, right? Where you see this high-low range all of a sudden is noticeably different than the others, right? It just spikes up or it spikes down. Something's happened, right? And it really is a dramatic thing compared to the other price bars that are preceding it. And it kind of gets your attention because it's just dramatic, right? It spikes out there. Something has happened with the price where the range has gotten really broad, really fast, all within a day, let's say on a daily price bar. And you want to ask yourself, when you see spikes, is it true? Is it a true reversal? Has something really dramatic happened? There's a big event. Something has happened that is going to cause that security to trend in a different way. Is there a reversal coming around? It's going to just, something dramatic has happened. Or is it something that's more temporary, like a panic or a rumor that came out that's going to correct maybe in the next day or so, where it's like this big spike and then everybody's like, much ado about nothing, right? So those are the kind of questions when you're looking at spikes and when you're applying your technical analysis to a spike. Is it true or is it not true? And you can see them on a chart. Like, let's look at our chart again here, and you can see this big red spike to the right, right? So you can see that there's big red spike. And what do we know from learning about our price bars? We can see that it opened on that particular red spike there. It opened up pretty high. In fact, it opened up much higher than the day before. You look at that black bar right preceding it, you can see where the close was, and all of a sudden, the price spiked way up, right? But then why is the bar red, indicating it was a down day, when it spiked way up? Well, what happened is it got way up there, something where people are anticipating something or something was going on. All of a sudden, traders figured out, oh my gosh, this is not good news. This is actually really bad news. So then it went spiking all the way down. And that's where you can see where the closing is on that red bar to the right, where that's the closing price is well below the previous days, the previous days open and close. So it opened real high, something was going on, people are trading it real high, and all of a sudden, boom, and went way down. And I'm not sure why, but this is a great example of this particular one where it went way down and closed way down. Also, you notice that the volume bar, the bar on the kind of the bar on the bottom, all of a sudden also spiked up too. So our volume increased. There was a lot of trading activity. Remember, as we know, if there's a lot of volume, that can be more of a confirming event that something real might be going on. And usually when you see spikes, you're going to see, that horizontal bar get, pretty high because something's happened and causing a lot of things, a lot of action on that particular security. Now, what we'll want to do is to figure out, what's happening here, and do we want to invest in it? Now, maybe there's some news and we say we believe in the news, and so we're buying or selling based just on that news. But if we were looking at technical analysis and we're looking at trends, we might say, this is really getting wild here with this spike. It definitely closed down. I might want to be watching early the next day with the opening. Where does it open the next day and what might be going on, so I can see if there's a trend, going on. It looked like previous to that there was somewhat of an uptrend, going, definitely at least for a couple of days, it was going up as far as, going up. Actually, 3 days in a row it went up. but then it went way down at the end after a big jump up. So that's a spike. That's what a spike might look like. And then if we look at it, like, well, what did in fact happen with this actual stock? This is real stuff that really happened. And when we look at that, we can see like, oh, the bars turn black. So that means their prices are going up. There's prices going down in the red. Volume went down. But you can see after it closed way down in the red bar, or red price bar, it opened just a little bit higher. And then through the trading day, it had a more normal or narrower trading range and closed up higher, actually significantly higher. And then looks like it started a little bit of an uptrend. You can see the closing bars or the tick marks on the right. Then following day it went up a little bit, then up a little bit more, and then up again. So, something happened to cause a reversal for one day in that previous trend, but it looks like it got back on an upward trend. So, that's how we could evaluate that spike. Now, if it went the opposite way, the spike could have proven to be true as far as trend reversal, and we're now going to have a big, big downtrend. And if we just expanded it further, going back in time, you can see that big red spike in the middle. We had our little uptrend, and ended up what happening is we then went into a downtrend. But all these things that are happening, we would have been using our technical indicators to identify when these trends are forming and when they're not forming and when there might be reversals. So we're getting in and out at the appropriate times is the idea behind this. But be aware of spikes because there's something that's really dramatic, something dramatically is happening. Let's talk a little bit more about how we can use the trading range as a technical analysis tool when we're evaluating what might be going on here. And as we know, the range is the distance between the low and the high of a price. And we learned how we can identify spikes where there's these broad ranges in terms of the high and low, but there's other ways that we can use trading ranges as well. So let's look at some of those and kind of have an understanding of it. And it can be a leading indicator as far as a price change that is coming. And when we start seeing these ranges between high and low, there might be kind of something's coming. That's why we call a leading indicator versus something that's maybe more of a lagging indicator. So it can be very helpful that way as well. So if we look at trading ranges, and you can look at range expansion and range contraction. So if we look at these examples here on the left, we have range expansion. You can see that the price bars, just that middle part, if we're looking at that range, are lengthening over time. You can look from going from left to right, how they tend to be lengthening. And that would suggest a continuation pattern as far as, if it's expanding, that whichever way it's going, it could be up or it could be down, could be, continuing to go in that pattern or continuation. If we look at a range contraction, that's where the price bars are shortening over time. And you can see from the left to the right on the right-hand image there, how the bars are getting much, much shorter. And that suggests a trend reversal may be coming up soon too. So if we, as well as using these other indicators, we're going to learn all through the course, you start looking at range expansion, range contraction versus a continuation or a trend reversal might be being indicated by the patterns within the price bar themselves as far as what may be going on here. So range expansion and contraction don't tell us anything about the existing direction of the price move, just more so whether it would continue a continuation pattern or that trend might reverse, because it could go either way depending on whether they're contracting or expanding. But the range can expand or contract in both upwards and downtrends, so they can do it both ways, but it's more of range expansion is a continuation pattern, going to keep going the same direction, and a range contraction might show a trend reversal or basically flattening out or changing the trend is the big idea behind that. In addition to looking at trading ranges and how they could be indicating a continuation of a trend or the reversal of a trend, there are additional ways that we can kind of add confirmation to that. So let's take a look at some of these important ways that we can do that. A very important thing to look at is volume. And volume could be either rising or shrinking. And volume basically is looking how many transactions, how many trades are happening. Is that going up or is that going down? So if volume is rising, as in more people are trading the stock, or maybe existing traders are just adding to their allocation, right? So it's not necessarily new people coming in, it might be existing people, buying more. That tends to accompany a range expansion and really accelerates a trend, which whether it's going up or down, the trend could be going up or down, but as volume rises, that will tend to keep the trend going in that direction and really expand on it. If you happen to see an expansion of a range, wider range, but it lacks in volume, then that could be a mystery, and you need to look at kind of other indicators where it's kind of giving a false signal here a little bit. So you could look at indicators like in our momentum section of the course to use to kind of confirm what may be going on. But the idea is if it's rising, it's going to look at an expansion or accelerating the trend. Now, if volume is shrinking, which means fewer people are in the market for this particular security, or existing traders are reducing their allocation, they're now getting out of it. Falling off volume often accompanies a range contraction where the width between the range, the height and low might be contracting and might be associated with falling volume when you're looking at a trading range, a range of prices. Another thing you can kind of look at is looking in terms of trading range and getting some indicators and confirmations is around the open and close position. There's really 4 combinations. You can have an expanding range, the prices from high to low are expanding, and the closes are getting higher. There's higher closes. So that tends to indicate that buyers think the price is going to keep going higher, is the idea that the price is going to keep higher. If the range is expanding, but the closes are getting lower, the price is getting lower, then sellers are getting a little bit more anxious and maybe wanting to unload that stock. Thus, the closes are getting lower. So you look at that expanding range in both a high or lower close aspect. By the same token, you can look at a contracting range in high and low. So in a contracting range, they're getting narrower, not as big a width between the low and the high, but there is higher closes in this contracting range. Then it might be indicating that investors are feeling uneasy about the direction the security has been trending, and the higher close can offset some of that negative sentiment of the contracting range. So there might be a little unease. The range is contracting, but there might not be necessarily a reversal. They're kind of offsetting a little bit here. If the range is contracting and the closes are lower, well, that's kind of like a double negative for an existing trend. Traders are selling at a lower close, so they're willing to take lower prices, and also the range is contracting as well too. So maybe they're really just trying to unload the security and kind of get out of it, right? So, so that's an example. These are examples where high volume and lower close in a contracting range, as an example, and you combine the two, that can be a real big sell confirmation, right? High volume, it indicates that there's a lot more strength to whichever way the direction is headed. Lower close and contracting range shows that prices are going down. So combining them all together could be an example of a real pricing, big sell-off in terms of price on that. So there are some additional things to look for when you're looking at like prices and ranges and what might be happening, whether they're expanding, contracting with volume, and what might be going with an expanding range and higher closes or lower closes. Looking at all those things together, in addition to the other tools that we're going to then kind of layer on top of that. A trading range can also give you a feel for anticipated price gains and price losses in terms of, like, let's say your own profits from trading in this particular security. And you can think of the terms of the range in terms of amounts. What is the difference between them? So if we use, let's say, on day one, something had a high of, well, we'll use dollars as an example, $10, and had a low of $8 using absolute terms, well, we would say it would have a $2 trading range, right? 10 minus 8, for example, very simple. So that will give you an idea of potential profit around there. So if we look at this, an example even closer, let's say over 5 days, you have these different price trading ranges. Now, these are not the actual prices. This is the range. Like the previous example showed us, we had a $2 range. Maybe day 2 was $3, and then $1 and $4 and $2. So over 5 days, you have this total ranges of, in effect, $12, and you divide that by the 5 days, you get your average daily trading range of $2.40, right? Simple math at that point. Again, not prices in this example. We're looking at the trading range as a technical indicator and maybe as a profit anticipator. So we have $2.40. So let's say over that daily range, that $2.40, then if you had bought at the absolute low in this particular example over that days of trading, and you sold at the absolute high, then you would have made $2.40 per share of security that you had for that particular day, or during that particular series. Now, is it common to buy at the absolute low and sell at the absolute high? No, not at all. But you might be near each of those extremes as far as getting that, and you can get a feel for what are your potential profits. So something that might have a high range and you're buying maybe near the low, and it has a high absolute trading range, you might have more opportunity for profit than something that's at a lower or more narrower range. So it kind of gets into the volatility of a security as well too. But you kind of anticipate things with higher ranges might give you more opportunities, but you have to look at so many other things as well too. But trading range can give you an idea of a lot of things you can look at from a technical analysis standpoint. So the open, high, low, close price bar is the foundational price bar, but there's different ways you can look at price graphically and visually as well too. And I'm going to show you some examples of that, and you might use different types of price bars that you can tell on your platform to basically reflect the chart the way you want it to look. You're the painter of the canvas, so to speak, so you can make the chart look the way you want. That might be easier to interpret. And then some price bars are better than others too, and particularly things like candlestick price bars. We have a whole section coming up on that, and that's a real important section, understanding those price bars and those price bar patterns with candlesticks. So we're going to save that for that section. But here are some examples of some different ways that you can look at price bars beyond just the open, high, low, close foundational price bar. One that's very common is the HLC bar, which should look pretty familiar. It's the high, low, and close bar. Is basically missing the O. It's missing the open, right? And if we look at the one on the left there, these are two examples, by the way, of high, low, close bars. And the one on the left is pretty obvious. You can see there's no tick mark on the left side of the vertical line. There's no indication of the open. There is an indication of the close, and that's the tick bar on the right, and the range, the high and the low, but no indication of the open. And that's why the reason for that is a lot of folks really aren't all that concerned for many cases around the opening. They're really fixating more on the closing price, giving more emphasis to that. So if you're like that, you can use and clean up the chart a little bit better. You can use an HLC or high, low, close. Sometimes you might see it represented like on the right, where they kind of put where it looks like there's a tick mark on the left, there essentially is, but it's a straight solid line across. And so to really make the close kind of stand out more, you can see there's no body or there's no left tick mark. It's just the same left and right. That can get a little confusing because it might tell you that the opening and the close were the same. But if you set it up as, and it's a high, low, close bar, you can use that type of look if you prefer that look, and just know that there's no openings being reflected in that at all. Now, when we look at candlesticks, you might see some candlestick patterns that actually look like these. So you have to kind of differentiate between the two, where the open and the close are at or near the same price. But in this example of HLC bars, there is no open. It's just another way we represent it. That's why particularly, in me personally, I like the way on the left because it's real clear to me. But if you like the way on the right, that's okay too, Other ways that you can represent price as well are things like an area chart, for example, where you're looking at, things like, how does it look in terms of pricing things out and then having, kind of shaded underneath the price. So if you look at it, it almost looks like a mountain range, and you can see that it's, more kind of visual in terms of that aspect, but, it doesn't really clear out the lines, I think, as much as far as the the prices. Doesn't really show you openings and closes. It's really just kind of showing you closes, and it kind of shows you some peaks and valleys. So that might be a way to look at, let's say, an area chart. Below that, you can see where it's just dots. It looks like it's a scatter diagram of dots, but it actually isn't. It actually is the closing prices just represented as dots. And you can kind of get a feel for where the lines might move from there, but that can seem a little more confusing to me, just as far as a personal opinion. On the bottom right, you'll see a real common chart, which is called a line chart. And you can see it's got black lines and red lines. Black would represent, in this case, that the finished higher, the high or the close was higher than the open, and red means it was a down day, that they closed lower than the open. So you can get a feel for open and close with the colors that way. And line charts can be helpful when we start looking at things like moving averages, and we're going to look at an indicator where you look at moving averages, and that's a line itself, and you want to look to see where that line crosses across different price things. And sometimes line charts can be very helpful to see where that crossing point is. And then the one above that is another line chart, just using dots basically to represent the pricing that way. So you can kind of choose the way that you like to see things represented. There's also price histograms, which are bars going up and down. They're showing basically the price and it would be at the top of the bar. It would be the high price or the closing price, depending on how you set it, but typically it's the closing price. And the black bar would be a positive day, and red bar would be that was a lower day. And you can kind of see, some direction things from that as far as a price histogram. Again, I don't like that. It doesn't show me a lot of information, but some things, histograms can be real effective. Like when we talk about the relative strength index, an indicator where you could use a histogram to make it, more easier to understand. And I will show you that so you don't have to worry about that. But typically what you're going to see are those open, high, low, close price bars, or high, low, close, depending on what you want. Maybe a line bar to or a line bar, price bar to show where there might be a crossover. And then the real big one that you're going to probably use a lot and really see a lot are candlesticks. Here's a representation of candlesticks, and you can see they look like candles with a body and a wick at the top, some of a wick at the bottom, at both ends. So that's coming up, and that's a section you definitely want to really, look closely at when we get into candlesticks, which is really in effect another form of price bar, based again on the foundation of the open, high, low, and close price bars, but they can tell you a lot more and really are very, very helpful for technical analysis. In the next series of lessons, we're going to talk about gaps, where there's a big gap between, a previous day's price and maybe today's price. And what does that mean? And how can we trade these to our real advantage? And there are some definite opportunities with gaps and trading gaps. Some people, that's what they do. They just focus on trading on gaps. So we're going to talk about that in these next coming lessons, and that's going to be very interesting. You might find, like, if you ever traveled like through light rail or something like that, the separation between the platform and the actual train, there's a little gap between that, and you have to step over, and it tells you to mind the gap, right? So it's kind of the same thing with technical trading, that when a gap appears, you have to take a look at that. You have to be cognizant of it, because something significant could be coming on. So whether you're taking the train or technical trading, either way, it's very important to mind the gap. So let's talk about, well, what do we mean by gaps and when there's a gap or not a gap? So how do we use gaps to our advantage? And because it can be a really terrific trading opportunity for sure. And the key is to differentiate between what is a common gap and an uncommon gap. So let's look at those here very briefly. A common gap is something that can occur in a trending or non-trending prices. So it can occur in either one. And a common gap doesn't change the trend or start a new trend. It's common, nothing's really going on. There's a gap, yes, but it's not going to make a big difference. It's not going to change the trend or start a new trend. Those are the things we're really watching for. It's simply noise, nothing's going on. It might be a little flutter up or something like that because of some announcement or a rumor or something happens. And a lot of times when you see these common gaps that are not impactful, it occurs when the trading volume is low, right? There's less people trading, so there's not a lot going on. So a good way you kind of verify if something might be a common or uncommon gap is look at those volume levels. If the volume levels are low, very good chance it's a common gap versus something that, an uncommon gap we're going to talk about next, where it's very significant. A common gap would be something that's not significant. So if that volume is high and there's a gap, then you might have something that's real significant, which is the uncommon gap. And that could lead to a big price rise or fall in the next coming time periods, like days, in the next coming days. So an uncommon gap is a significant event that is occurring that may impact the pricing trend and provide a great trading opportunity. So we're really looking for is uncommon gaps. And there's 4 key ones to really look at, and those are breakaway gaps, runaway gaps, exhaustion gaps, and island reversals. So the next lessons, we're going to go through each of those individually and show you how to watch for them, how to recognize them, and then how to trade on them, to make some profits off of these types of gaps that can occur. Now, gaps are actually, rare things. That's why they make a great trading opportunity, because, something unusual has happened. There's been some significant event or significant news, and it's caused a gap in the prices. And a good way to identify it is first understand what typically there is, and that is there's no gaps. When you look at, let's say, this chart like this, you'll see, our opens and our highs and all that, but really we're looking at the trading range of the highs and the lows. And you can see from the trading ranges, whether it's an up day or a down day, there's always an overlap from the day before. Even where we have that big spike on the right-hand side, it opened much higher. There was actually a gap at the opening where that left tick mark is on that really spiky red bar. But then the prices came down to kind of overlap again from the previous day. and then it goes on, so on, so on from there. So there is some type of overlap when there's no gaps, and that's actually very common. What we're looking for is a situation where those ranges don't overlap at all. That would be a gap situation. So if we look at this example here, you can see like days 1, 2, 3, and 4, and these could be whatever time periods you want. If you're trading on minutes or hours or however your trading time frame is, we'll just use days here to keep it simple. But in particular, you're really looking at those closing, open and close prices. That's really more of the classic formation of a gap, is looking at an overall days trading range. And so days 1, 2, 3, and 4, you can see there's overlap between each of the ranges of bars. I don't have the open and close in here because that's not important when you're looking at a gap. You're looking at the range from the high to the low. And there's overlap from days 1 through 4. But then on day 5, there is a gap. You can see that there's a space in between the highest high of the range from day 4 there's a gap between the lowest low on day 5, so there's no overlap between them. And that would be a gap situation. Now, you can identify a gap at the start of a day because by nature, for a gap to occur, the opening is going to have to occur somewhere in a void, somewhere above the trading range of the day before. So you can say, oh, this is something's going on here by the opening. You need a gap at the opening for sure. But you cannot measure a gap until the day is over, because it could open as a gap, but then let's say in this example here, the prices actually fell and that bar got longer on day 5 going downward where there was overlap. If there's any overlap at all, there is no gap. There has to be a gap in terms of no overlap. That's the key thing to take away. So that's why you can't tell until the end of the day whether there's a gap situation that occurs, and then we're going to need to wait a little bit longer, as you'll see coming up, to confirm that gap, and that is a trading opportunity. But for now, no overlap. It can open, it can open in a gap situation, has to close in a gap situation. And we're really looking at the highs to the lows. And so you're measuring from yesterday's high to today's low. It would be an example of an upside gap. There's a space between yesterday's high and today's low. Or from yesterday's low to today's high, where there would be a downside gap. So gaps can be either going upward or going downward. And the difference is between, again, the bars highs and lows, not the opens and closes. So just really when you're looking at the gaps, you're really looking at that trading range of highs and lows. So if you're going to look at this example here on the right, what would you think that is? Is that an upside gap, or would that be a downside gap? Kind of looks at it like you're going upwards, so if you guessed that, you're right. But yeah, yesterday's high, it does not match up to, or does not overlap today's low. So there's a gap in between the two. By the same token, if we looked at this image, you'd see a downside gap where, yesterday's low does not overlap today's high. There's a space in between them. And so there's either a downside gap or an upside gap. Gaps can be either way, either up or down. And what you have going on here is you have a void. You have this space, and what's going on is there's no match of buyers and sellers. There's no matching of somebody looking to sell or buy at a certain price range within that gap area. There's a gap between the two price ranges between the 2 days. In this example here, prices had to go upward to form a match. So there might have been people trying to sell just a little bit above, the day before, or maybe even below, or right somewhere within the range of the day before. But something happened, either some good news or something that triggered where everybody's saying, no, I'm not going to sell that low. You're going to have to pay more for me to sell. And so the prices rise, and you can see a gap there between the 2 days. So there might have been some really good news overnight that had caused the price to jump up and create the gap. That's what's happening. Like in this example, could be the opposite in a downside gap. In this upward gap, you can see there's some news overnight. Prices jump right up, right even before the opening, and the first opening, bid, or so to speak, or trade is well above the overlap range. There's a gap in between. So that's how you kind of understand gaps, and what you're looking for is you're basically looking for the space and this void between two trading periods, or between the 2 days. Okay, breakaway gaps, very, very, very important. And what happens when there's a breakaway gap is it's going to bring in a lot of new traders, add volume. That's one way you can tell if it's an uncommon or important type gap. You're going to see volume rise. It's going to bring in new traders. And it's usually driven off some type of big event or some news thing, something that's happening that's really driving the impact on that security and really impacting. And there's a gap. It could be up or down, but there's a big gap that's coming. And it frequently marks the start of a new trend. When you have a breakaway gap, and I'll show you this visually what those look like in a moment here, but when you have that, it can mark the start of a new trend. There's a major change coming. There's a major change in your chart that you'll see. You might see that the daily trading range, the high-low starts to widen. You might see an increase in in-day volatility with lots of things being sold high and low all throughout the day. And also, we mentioned the much higher trading volume are good indicators that a breakaway gap is occurring. And what happens is it's actually going to break through support and resistance levels, can help confirm a significant breakaway gap. So, support level would be like low prices and resistance would be high prices, and somehow it's breaking through something, breaking through some, this trading range of prices, and that's why we call it a breakaway gap. And it is a significant leap in terms of the price, and we'll take a look at that now and how to trade on that here visually. So in this example, we have an upward gap, right? We have a gap between days 4 and days 5 prices. And what you're really looking for is a couple things. Ideally for a breakaway gap, you want it to be really proportionally big in terms of the trading range. So for example, if the normal range is, let's say, $3 or whatever your currency is, and the gap is $15 as far as between the preceding day's high and low, and the gap day then opens up higher than that, that might show you that something significant is going on. There's a big gap in between the prices, and the more significant the gap, the more impactful that is, and more likely you might have a true breakaway gap. Again, we have to wait till the end of the day to really confirm that it's a gap, that it doesn't come down in price like in this example and just overlap, and then we don't have a gap at all. Well, if we look at this, we have this proportionally big in terms of the trading range. There's a big jump up in terms of what was going on before, between days 4 and 5, and you can see in the preceding days kind of confirm that as well. And then also, to really identify a breakaway gap, it occurs when price is only slightly trending or moving sideways. There's not much going on, and then boom, it happens. It's not like there's some big, massive trend, and you have a little breakaway gap, but it's already part of a massive trend. That's not a true breakaway gap. That's something else actually we're going to learn that's going on. But if you look at, like here in this example, you can see where prices are at day 1, they're in 2, 3, and 4, they're up, they're down, there's no significant trend, or it's kind of moving sideways, and then there's a big leap up. If anything, you might have said, well, between days 2 and 4, there might have been a little bit of a downtrend, and then all of a sudden, boom, there's a big gap upwards. To day 5, something had caused that. So when you're looking at an interpretation of these, let's look at this one here. This is an example of an upside gap, as we know. So if there's something happens, some good news, creates demand, and people want the stock badly, or the security badly, and they're willing to pay higher prices to get it. Volume is typically noticeably higher than usual. If we were to put volume along the bottom of this, and we look at some other charts later, you'll see that. But if we had volume here, you'd usually see a spike or a dramatic increase in volume, because there's some news overnight, some good news, and everybody's like, oh, this looks like a good security, I want to get in here, and a lot of people are getting in now, and they're willing to pay these higher prices right from the start of the day, and that's what helped create this big upside gap. The other way of looking at a breakaway gap, of course, is a downside gap. And what that means is that current security holders, they want to get out of it. They want to dump this security and sell it, and they're even willing to accept even lower prices to do that. They're willing to go even lower than whatever was the low of the range the previous day. They just want out. And volume, again, is usually, but not always, but usually abnormally high in this case as well. Again, there's some kind of event, something's happening, and there's a mass movement either up or down. In this case, this would be a downside breakaway gap where there's been a significant kind of move here to sell the security. So either way, you're looking for these gaps, and you're looking for these significant moves for a breakaway gap, as opposed to other gaps we're going to learn about. Another gap, of course, that's really important is a runaway gap. And they're very, very important because it relates to continuing to ride a trend and continuing to ride that trend that might be happening when you have this runaway gap. And if you think about it, what the difference is between a breakaway and a runaway gap is a breakaway gap is the breaking away. It's breaking away and it's starting a trend. A runaway gap is one where it's continuing the trend. So you might have a breakaway gap that changes things and starts a new trend, And the runaway reinforces that later, as prices go, reinforces that and continues that trend. And maybe you want to continue to add to that position and continue to ride that trend. If it's, let's say, an upward trend, it could be upward or downward either way as far as a runaway gap. But the idea is it's not creating a new trend, it's continuing an existing trend as a runaway gap. And that means there might be some even more good news coming out or something that's been building on this. And there's a fear of missing out or FOMO or whatever. So it's created a big leap, let's say, in pricing. And so let's take a look at runaway gaps and how to recognize them and talk about the trading opportunity with them. So if we keep looking at our example here, you can see how over this time period there was a breakaway gap, and then that started a new trend, right? As breakaway gaps will start a trend, and this happens to be an uptrend. Then there's a little sideways movement, and then we have a gap between days 11 and 12, and that would be a runaway gap. Again, you can see it's kind of continuing more of that previous trend. So that's why it wouldn't necessarily be a true breakaway gap. It's real continuing the trend, and that's what makes it a runaway gap, a real strong indicator as far as that continuation of that trend. If we were to look at it in a different way here, you can see the black line shows that trend from the previous breakaway gap from starting on day 5. And then we have a little bit of a pullback, which is normal. People will buy in a dip. We had a little trend, of 3 days. People will sell a little bit, and then new buyers will, so that goes down. And then new buyers will come back in and reinforce the trend. And so we have that buying on the dip when it kind of dips down for a pullback for a day or two, maybe even 3 or 4. And then we have back again more of a movement back towards an uptrend. In this case, it could be a downtrend as well. But in this case, we're looking at uptrends. So we then have that big gap between days 11 and 12, and that's the runaway gap. So you're really reinforcing the continuation of the trend. It is very normal and natural to have a little bit of a pullback, so you want to be watching for that. And then all of a sudden, if you see another gap come up, that's your runaway gap, and that's going to really reinforce the trend. It's going to continue the trend. So we'd be looking forward to days 13 and going forward that trend that we had seen before will keep going, and that's a really good buy sign. If it was the opposite way, that'd be a good sell sign on a downward trend. But in this case, the example we're using, we can see we've had our breakaway gap, we've had a little bit of a pullback, now we've had a runaway gap, and we're still going and we're still doing well, continuing with this trend and getting some profits there. Oh, look at this kitty here. He's so tired, he's so exhausted. And that's what we're going to talk about is exhaustion gaps when they start to run out of steam. So what is an exhaustion gap? Well, it's all part of these uncommon gaps that we've been talking about, but the exhaustion gaps occur at the end of a trend. And really what they're signaling is things are going to start changing, or the party's over, it's starting to end. We're getting exhausted. So what's being exhausted is the news or whatever's happened to propel the energy of the early buyers that drove the security up in the first place. Let's say if it's a upward exhaustion gap, right? So you might have had a breakout gap that changed it and made it go up, let's say as a breakout. You might have had a runaway gap that continued that trend, keeping it going forward, but at some point it runs out of steam and has maybe another gap in prices where you see what's called an exhaustion gap. It's kind of like that one last buyer after a buying frenzy is over. There's like one last person and then it starts to kind of go the other way. That's what an exhaustion gap is. So let's look at an exhaustion gap in relation to what we've been looking at in the other types of gaps. So if we continue with this chart pattern here, you see we talked about our breakaway gap and we talked about our runaway gap, and that created the breakaway gap created the trend, and the runaway gap continued that trend. But then the trend started to run out of steam, and we have an exhaustion gap here. We have that kind of last buyer or buyers jumping up, creating a new gap, saying, this is so exciting. The trend's great. Let's drive these prices even higher. And you see where, they start to kind of run out of steam there. And you start having what would become an exhaustion gap, where you have that gap, and then like day 16, we're going to start having overlap, and we're going to start seeing that coming back down, is what would happen in an exhaustion gap. One way you can tell with that too, what's the difference? How do we know it's an exhaustion gap versus a runaway gap, or how to be aware of that? Because maybe that exhaustion gap is just another runaway gap. What we're going to look at is you're going to have low volume on an exhaustion gap, and you're going to have high trading volume on a runaway gap. So you think about your volume, how many people are actually trading things. If we look at the bottom of this here, you can see on day 12, where we had that real high spike in volume, that means a lot of people wanted to get in on the security on day 12 there, and they drove that price up, and then it kind of continues from there. Where if you see a gap like this exhaustion, what's going to become an exhaustion gap, you're going to see that where the volume starts, you have your gap, but then you see that the volume is actually pretty low. Again, that's an indicator that there's, in this example, less buyers out there. There's a couple, maybe the last one, who's willing to pay these premium prices, but it's starting to really run out of steam. It's becoming exhausted. So that means the party's over, so to speak, right? And so you're now going to have some overlap. You're now going to have maybe the security start trading sideways, or maybe even start to reverse and start going on a downtrend. So when you're trying to decide, am I looking at potentially a runaway gap or an exhaustion gap, look at that volume there and what's been going, typically with the volume on that particular security, leading up to this. And if you see a spike in volume, then it's a gap. In this case, could be a runaway gap. Or in any security, you'd have a high volume with a breakaway gap you'd look for. But an exhaustion gap can be real telling when there's already been an very established trend, and the trend is ending, and that's because you're seeing some low volume there. So be watching that volume there when you're trying to decide, am I seeing a runaway gap or exhaustion gap? And being ready to make a change, either way, whether, looking at where that trend is going to then change ahead and get out if it's appropriate, if it's an exhaustion gap. So if we look at this island here, you might say, well, that's a nice looking island. It has a nice beach. It'd be a nice place for me to relax on. But what if I told you there was nobody there with you, and there was no food or water, and nobody was coming to help you? It might not be such a great place to be, right? And that's what island reversals are. A lot of times they're not a great place to be, but they can be a very strong indicator to show what's going to happen next. So they're rare, they rarely occur, but when they do, they're a very, very strong indicator and could provide a great opportunity. So if you see an island reversal, you really want to pay attention to it. And kind of what they are is it's an exhaustion gap, where it's been exhausted, as we learned about, and it's going to have this gap, followed immediately by a breakaway gap in the opposite direction the next day. So what you're finding is that whichever way it's going, that breakaway gap the next day, you're finding a last trader who kind of finds they're on an island, by themselves, and they have to start adjusting their price either up or down to kind of get back in step with people who are willing to buy and sell or trade with them, and are, basically looking at, maybe a different way the trend is going to go. So let's take a look at these island reversals and how to recognize them, in a more understandable graphic manner. So to identify these island reversals, you're going to need an exhaustion gap, right? And so we know from day 14 to day 15 that we're looking at an exhaustion gap. We saw that our volume was, not going up. It should have had a real spike in volume there. It actually went down in terms of our volume between day 14 and 15. And so we know we're running out of steam, and that is our exhaustion gap. And then what typically will happen is you'll now start seeing overlapping bars, and it might start going sideways, might even start going down, or basically the trend has been basically broken at this point, and it's not trending upward anymore, as in this example. But sometimes what happens is the island reversal, as we mentioned, you have an exhaustion gap that is immediately followed. It's immediately followed by a big jump up in price, that looks like it's another runaway gap. The classic way to define that, it would be the next day, as far as there being a true island reversal. Sometimes folks will say, oh, you might have one or two trading periods in between, but really the classic way to look at it is between, like in this example, 15 and 16, you're going to have these two kind of back-to-back gaps. So you have your exhaustion gap, low volume, and then all of a sudden it just keeps going up higher. There's a whole nother big gap, let's try to push this even higher. And that's where you might see, even lower volume, let's say coming on, that bar in between those volume bars, where you could see even lower volume because it really is truly exhausted. You're really on an island. You're the last person out there trying to buy, and you might have a couple sellers out there, but it's really already post the exhaustion phase. And really where you can tell is you can start looking for that low volume on that exhaustion gap, right? So there's low volume, and that tells you it's time to sell. If there's high volume on a runaway gap, that tells you to buy, right? We saw a previous, on day 12, that runaway gap where it's time to buy. But a low volume island reversal is you're going to have that low volume on the day 16 in this example. And then the time to sell or buy depends on the island, right? You're waiting for the island to form. So we don't really truly know at day 16. We need a day 17 to show what's going to happen. And then what will happen is then on day 17, there's going to be some high volume. Is one way you can see you got your island reversal. You've got these low volume days of exhaustion gaps, and the island forming, and then the reversal going the opposite way is happening where there's a lot of volume and it's going to go the other way. So the time to sell or buy depends on the island, as I mentioned. So if we look on the left here, you can see that this was an upward trend that was exhausted, then jumped up from day 15 to 16 to an island. And then we're waiting to see what happens on day 17, and that's really what's going to confirm that we're on an island, that it didn't continue going up or something like that, where it might have actually been more of a runaway gap. It was actually a true island, after an exhaustion. And you can see how now prices have come down and there's another gap in between, but a lot of volume. Now people are really selling and they're trying to get out of it. That's the example on the left side. So that's now created a new downward trend on an island reversal. So it's time to sell, get out, book the profits that we've made from day 1 through 16, if we're staying the whole time, or 14, or however we've stayed along. But if we're in this security right now, we'd want to get out, right? By the same token, if you look on the other side, where if you look at day 13, 14, 15, things have been downtrending, right? We haven't bought yet because it's in a downtrend. There's an exhaustion gap from a previous, runaway gaps and breakaway gaps that have led to a strong trend going downward. Prices are going down. We see the exhaustion gap between day 14 and 15. We see day 16 following that exhaustion gap going out by itself on an island. We're going to watch to see what happens on day 17. What happens at day 17? The price goes back up significantly. We see that high volume. We see that we have an island reversal, but actually it's going in the other direction, and we want to buy on that. Now we're seeing a new upward trend that is forming, and so this would be a great buy signal, kind of confirming with that volume that we have an island reversal going in the other direction. So the key points is you don't know if it's an island until the second gap occurs. It's day 17 in this example. You might see it jump out way ahead after an exhaustion gap and kind of guess like, oh, is that a reversal? And it could be, but you really need to look at that volume, and you really need to confirm with that the following day. Others will guess based on the volume. Like if it's a low volume, they might say, oh, on day 16 our volume was low. And then we're going to guess and say that's an island reversal. And that's not a bad guess, actually, but to be a true island reversal, you're going to need that day 17 in this example. See, there's high volume there that really establish that, yes, things have changed. There's a definite change, and now a new trend is forming. So to really look at a classic completed island, you'll have to have an exhaustion gap with low volume, followed by an island gap with low volume, and in a sense, a breakaway gap, high volume, going in the opposite direction, forming that island. And you don't want to be on the island. You want to get either off the island or get on the new trend, depending which way it's headed. So those are island reversals. They're actually very rare occurrences, but if you see it and you kind of recognize it in a chart pattern, really watch that closely, because they are very, very strong indicators, probably because they are so rare and there's so many requirements behind it, right, with the exhaustion gap, all that coming in, the strong trends coming beforehand, either up or down. So watch for island reversals and be ready to strike. Nothing's perfect, of course, but this is a good, strong indicator. And do check those volume levels to kind of confirm what you're seeing is what's truly happening. Okay, we've come to a very important section, which is candlestick price bars. We understood that the open, high, low, close price bar was kind of the foundation, but the candlestick bar is an alternative to that, and a much better alternative to it, and really what people mostly always use. And there's a lot of things you can do with candlestick price bars, and that's what we're going to learn about in this section. And they're a better alternative, and they've been around actually a long time, since like the 18th century. They're called Japanese candlesticks because they kind of did originate in Japan, where traders were applying it to the rice market back in the 18th century. So this is not some new voodoo or anything like that. These are really well-established things that you can use by understanding the pricing, but also how these different price bars interact together, and looking for some candlestick patterns that we're going to learn about as well to show us some trading opportunities for sure. So if we think about it, the open, high, low, close will tell us a lot about what's going on with the price in a day, but candlesticks will tell us this and much more. And in general, if we think about what are some of the benefits of candlestick bars, and you'll see as we look at some examples, they're going to be more visual. They're going to tell you a lot more just by instantly looking at it. As you learn it, you're going to see that they're going to be simple to use and interpret. Maybe not at first, but it won't take very long for you can look at a candlestick and say, I know exactly what's going on just by glancing at it for a second as you get used to them. So they're simple to use and interpret. Patterns have some descriptive names, which are kind of fun, easier to remember, like a gravestone doji, So we'll learn about those and how to represent these patterns that are, really good patterns for us to trade around. And the patterns are widely known, so you can expect other traders to respond in specific ways to specific patterns, which is a good thing. If everybody sees something like, let's say, a gravestone doji, which again we'll learn about, and then people are going to react in a certain way, well, that helps us as traders to see which way the market sentiment is, which way things might be going, and we can trade on that too. So things where patterns and things work together with a large group of people is a good thing. And you can use it on any chart, candlesticks that is, and you can use it with other indicators, which is really powerful too. So you can use the candlestick and you can use it other indicators like a moving average or other things that we'll learn in the course, and you kind of use them to kind of work together to give you more strength around your decision-making process. So candlesticks really help that way. And they can have dramatic shapes or patterns to them that really grab your attention, and it might help you to react faster than like a standard price bar where you're seeing these lines and things, you're trying to match up the tick marks. Candlesticks can tell you stuff visually very, very quickly, and they can have these dramatic shapes to them, like real high and lows or very narrow bodies to them, different things that we're going to see. And so it can help you to recognize certain turning points, such as an uptrend or a downtrend, by just looking at these candlesticks. So very, very, very important, these candlestick bars. And let's dive into that here in the upcoming lessons so we can learn more about them and how to apply them. Well, the first thing we need to do when we're talking about candlesticks is understanding what they're trying to tell us, right? They're trying to tell us something. And so we need to be able to interpret what the candlestick is, price bar is trying to tell us. If you look at this example here, we have a red one and a white one. And these candlesticks are trying to tell us something about the pricing, the range of prices, the opening and the close, whether it was up or down. But we need to learn how that works. But you can kind of see just looking at these two examples that the candlestick bars price bars get their name because they look like candles, right? You have a body that looks like a candle, the main body, and you have a wick on top. And also with the candlesticks in technical analysis and pricing, you have a wick on the bottom too. And they can vary in different lengths and all that, as you'll see. But that's the idea, is they kind of look like a candlestick, or a candle, which is great. Now what's it telling us though? This is great, Steve, looks nice, but give us a little bit more so we can understand what this means. So if we look at these two here, and now we're going to look at how to interpret them, right? So what is this telling us? So let's start with the one on the left. Let's start in the middle here, where you look in the middle where it says upper shadow, real body, and lower shadow. So all candlesticks share these upper shadows, real bodies, and lower shadows. Some are different lengths, of course, but in these two, they're exactly the same lengths on all these. The upper shadow is basically that straight line that you see on both of them going up and down. The real body is the rectangle, kind of the body of the candle, and the lower shadow would be like the wick on the bottom part of the candle. So you have an upper wick and a lower wick and a body. Again, you'll see they can vary in size as far as height and all that. So now if we look at the candle on the left, the red one, you can see that the high of the prices of the day is at the top of the wick, at the top of the upper shadow. So that's telling us in this price range that would be the absolute high that the security traded during the day. If you jump down to the low at the very bottom, you can see the other wick where it goes down towards the bottom. That would be the absolute low in terms of prices. When you see these on a chart, you'll see the different prices and things, and you'll see all these candlesticks, and you'll see their highs and lows based on the wicks, the upper shadow and the lower shadow. Now the body itself tells you something. So the one on the left, you can see at the very top of the rectangle, at the top of the body, that's the opening price. So that line, that horizontal line, would represent what the price was at the opening of the trading day. At the bottom of the rectangle on this one, it would show you the closing price at the end of the day. What is the closing price? And then the color of the candlestick actually has meaning, so you can instantly see, did the close occur higher or lower than the opening? You can see this one being red on the left there is a down day. Prices went down. So the prices opened higher, but at the end of the day, when the prices closed, they closed lower. So just by looking at the candlestick color, you can see, red, down day, right? So I know my open is lower than my close, and my wicks tell me my high and low. The same thing on the right-hand side with the green one. The difference is that the close was higher than the open. You probably see that on the real body. The top represents the highest price, or the closing price, which is lower, or excuse me, higher than what it opened at. So it opened at where the open price is there, and then it had a range of highs and lows, but then it finished the day at higher. So the way you can tell that instantly is you can see that the body is filled in with either white or a different color, for example. So I know if I see a red body in this example, I know I had a down day, right? It opened and then closed lower. If I see it's a white body, I instantly know in a pattern of these candlesticks over several days that this one was one where it closed up higher than it opened. It may seem a little confusing at first, but it's not too bad. You'll get the hang of it here real quickly. If we look at let's say if something is bullish, as in the prices go higher, you can see again, here's that representation of the open being lower and the close being higher. Bearish would be where the candlestick is, typically red in color, and it would show a opening higher but then a closing lower. So it's a bearish or decreasing type of candlestick. And these candlesticks can be, green and white might represent bullish, red and black would represent a bearish one, depending on the price chart you're using, the platform you're using. And the open and the close depends on the color. It'll be at the top and the bottom of the box, and that'll indicate the color depending what happens. But your lows and your highs will always stay the same. Your high will always be the top wick, and your low will always be the bottom wick as far as the price ranges. Here's an example of the same exact security. Shows you the same period, what it would look like as far as with an open, high, low, close bars versus, let's say, candlestick bars. And you can kind of see they look similar, but they also look different too, and as far as what you can get from them. Now, one thing with candlestick bars is there's things that can be indicated. They give you more information within a pattern or the shape of the candle itself. Here's a closer look at the candlestick bar chart as an example, and you can start seeing that you have these different heights, right? See how some are really kind of squat, short and squat, and some are real long. Some have real long wicks at the top. Some have no wicks at the top, or very little, and long wicks at the bottom, no wicks at the top. In fact, you can see these one here over on the far left. You see some in the far left, after the long, kind of in between where it starts to rise up a little bit at the first part. You might see a candlestick that has a very long top, but not much for difference between open and close. So it has a very small, almost like a line across for a body. And that's actually called a doji. And there's actually things we trade around. That's a candlestick with little or no body, and it's a special case. And it's where the open and close are occurring at or near, the bottom. If it happens near the bottom, it's a gravestone doji. This is an example of a gravestone doji where it's occurring more towards the bottom. It'd be a different name if the same thing happened but occurred at the top. Open and close were near the top. So we're going to learn all about dojis here coming up, because they're very important in terms of recognizing a trading opportunity. But the real takeaway from that is to understand that these candlesticks can have different shapes, and they're trying to tell you something when you look at them both within their own individual candlesticks, but also when we start looking at patterns of candlesticks coming up. They're going to give us a lot of trading information. And some people, all they do is trade off of candlesticks. That's all they focus on is candlesticks. You can use them and then use other indicators with them as well. I think is very powerful. But a lot of people, they just love candlesticks in these different patterns, and it works well for them. So let's look at these interesting situations that occasionally come around called dojis. And what are they trying to tell us? And more importantly, what are they telling us, and how can we use them to be better traders, basically? So a doji is a situation where a candlestick has no real body or only a very small one. And the reason that happens is that the opening price and the closing price are at or very near the same level. So if you look at this graphic here on a typical candlestick, you see you have a pretty good sized body, real body, the rectangle part, with a wick at both the top and the bottom. And as you know from a previous lesson, those are called an upper shadow and a lower shadow. Now, if you look at these doji candlesticks, one's got the open and close more towards the bottom and not much of a candle body there. There is a body there, but it's like if they're almost exactly the same price, you're not going to see that width of prices between the open and the close because they're all close together. Same thing with the one on the right, the far right, where the price is opened high or higher and then it closed high near the high as well too. So there's still a range. You can still see the vertical main line down the middle. There's still a long wick running through and affect the entire candlestick with a high upper shadow and a low lower shadow. But the doji is showing a very small candle itself, the body showing that the open and close are occurring near each other. And because that happens, we can learn things around that. Now, on its own, though, a doji doesn't tell you all that much just looking at it alone in space. Other than that, there's indecisiveness in the market, right? There's no clear highs or lows or, excuse me, and there's no clear opens and closes that where it's going up or down as far as that. And really where a doji gains its meaning is based on the bars preceding it. What is happening before it? Because a doji can help indicate that a transition may be coming and what type of transition depending on the type of doji. So think of that way. Don't think like, I see a doji, I do something. Think, I see a doji, I need to look backwards a little bit to see what might be happening next, and that'll help me with my trading decision. Do I buy? Do I sell? What do I do? So dojis, kind of work along with the other price bars. So a doji that occurs after a prolonged uptrend means buyers are coming in and there's been this long prolonged uptrend, the prices have been rising, and you start seeing a doji, that could mean that it's coming to an end of their buying or bullish enthusiasm as far as a doji occurring after a prolonged uptrend. That would be like a series of like white or green bars, for example, of candles, those candlesticks showing that. And that might be the end of that trend. And that's called a bearish doji star, right? Bull means things are going up, bearish means things are coming down. So we have this long uptrend, and so now we see dojis approaching or coming in that might show indecisiveness, and we might be ready to make a move now the opposite direction or down, thus a bearish doji star. A doji after a prolonged downtrend, the exact opposite of that, where we've been going down for some times, means buyers might be coming in and they're getting more enthused about that security and they're starting to buy that security and that prices might be ready to start coming up. So it's been going down. We've had a series of red bars. There's now a doji that might be appearing, showing some indecisiveness, maybe showing us that we're ready to make that turn and go back upwards. And that's called a bullish doji star. So you have bearish doji stars, bullish doji stars, acting in the opposite ways. But that's the idea of these doji candlesticks that could show, where these changes might be occurring. So what do we kind of learn from that if we think about it now a little bit closer? What we know is that a doji is kind of a transitional indicator. It's not a continuation indicator, a trend's going to continue. If anything, it's going to tell us that a transition may be coming. That the trend, whether it's going up or down, is going to change. So if you're investing, let's say, along a certain trend, let's say a buying trend, you want the prices to go up and you start seeing a doji, then you might say, it might be time for me to get out and sell because that upward trend might be willing to change. Again, they could be up or down, depends on the way the trend is going. And then the stronger the previous trend, the more likely that the doji is actually going to correctly signal a change. So if it's not a very strong trend, kind of in and out, it's not that strong a trend, the doji might not be as impactful. But if you've had a long, real strong bull upward trend and you see a doji, there's a very higher chance that the doji will be correct, signaling that change in transition. Again, nothing's perfect, but it's something you definitely want to be aware of and maybe adjust your trading based on that. And then lastly, in the next lesson we're going to learn about, there are certain doji shapes actually that have extra meaning. So we know a doji is going to be a transitional indicator and the trend might change. Stronger the trend, a real good chance it's going to change. But then how that doji looks could provide us even more meaning. So that's coming up in the next lesson around doji candlesticks. Oh, in our previous example too, where we saw actually a couple dojis back to back, did it signal that there was going to be a change in trend? Well, not really that much, because the trend before it was not really fully formed. It was not a strong trend. You saw our trend was really a couple, days of pricing. There was a big, down day with that big high volume you see over there on the left-hand side. So maybe there wasn't a big strong trend leading up to that. And if we look back a little bit further on the right-hand side, you can see before had a real narrow trading range, up and down, kind of following this narrow channel Then it started to go up a little bit. Dojis appeared. Was it going to go back down? We were watching for it. As it turned out, it didn't really make a transition, but it was something to be aware of. And then that trend actually continued. So if I was looking at this on the right-hand side, I'd say, okay, we started to trend up. A couple dojis appeared. I was watching it. And then the trend continued up after that. You can see because they're black and they're white candlesticks and they're up higher, and even the ranges are higher. They're open, their close are higher, or their close is higher. I would say, maybe I am going to get a nice strong trend coming now because even the dojis couldn't throw it off. So another way to look at that. So a special shape around a doji can occur around the shadows. Remember, the shadows are the wicks of the candle. Upper shadow would be the upper wick. The lower shadow would be below the real body, would be the lower wick, like on a typical candlestick. As you can see in doji candlesticks, they have highs and lows, of course, and they have a range of prices, just the open and close are near each other. But when we look closer what might be happening at the top part of the wick versus the bottom part of the wick, either one might be able to tell us a little bit more information, and there's certain doji patterns or indicators around these shadows that can give us more clues as far as what might be happening next. So let's take a look at some of these here. So what shadows do is they provide special meaning when the real body is a doji. So for it to be a doji shadow indicator, you have to have a doji open and close are near each other in terms of price, or exactly or pretty close on. And if you see that the shadow is missing, not much of, let's say, an upper shadow, let's say you have very little or no upper shadow, that's an indication that something's happening. Or if the shadow is extremely long, let's use that same upper one where it might be very tall. Those are situations where you have dojis, and these different lengths of these shadows can be very impactful as far as telling us, from patterns that have happened in the past, what we can expect. So there are some common shadow patterns to watch for, and they can have, real interesting names too. But the main thing is you want to watch for these patterns because dojis can be rare, but if you see them, they might be a great opportunity. So let's look at these common doji shadow patterns, again, looking mostly at the wick and see what that might be telling us. So the first one here is a dragonfly doji. I love that name, dragonfly doji. And you can see the image there on the right there. And if you look at just the image, what is it telling you? Just look at the image for a second. It looks like a T, I guess. But it's really telling you that the open and high and close were all the same, right? A doji by its nature, the open and the close would be similar or at the same. But in this case, that the actual high was the same as well. So not only open at the high, and close at the high, the whole price range at the very high of the whole price range was at the top. So you'd have this long lower shadow doji, right? So the doji below it is a long lower shadow, and that's a dragonfly doji. And really what's happening is that, the price opens and sellers are really trying to drive the price down. They're trying to see if somebody will sell for less and establish a new low, right? They want the close to be below the open and try to establish a new low. But they didn't succeed. In fact, not only did it not succeed, it got pushed back up to the point where the open and the close were a doji and were the same. And near the high it started at the opening of the day. So how you interpret that, and you always need to look at the bars preceding a doji to interpret a doji. Again, dojis don't tell us things just on their own. You got to look at the bars preceding it, the candlestick preceding it. So the preceding bars are in a downtrend. We're trending down. Then buyers are emerging, and the downtrend may be ending. Think about it. It opens lower because we're in a downtrend, and they try to go lower still, but the buyers say, we think we're ready to buy. We think this is too low. And then they come in, they drive that price back up, drive up that from that lower shadow because we see the range on the low, and they drive that price back up. So in a downtrend, buyers are emerging, showing a transition. Remember, dojis are transition indicators. If the preceding buyers were in an uptrend, then sellers are emerging, preventing the buyers from moving to a higher price, and the uptrend might be ending. So you think about that. We opened at this price. Buyers might be wanting, let's go higher, but oh my gosh, there's all these sellers just drove everything low, and the buyers just couldn't even move it above the opening price. They got kind of stuck there. So it's another way to look at it, but it shows the uptrend might be ending. So again, the doji itself, you can't look at that and say, oh, we're going to start buying. Oh, we're going to start selling. You have to look at the preceding bars and whether they're in a downtrend or an uptrend. And you'll see that with some of these other examples as well. So that's a dragonfly doji. Let's look at a gravestone doji. So if you look at that one, it's kind of the exact opposite, right? You have a long upper shadow. You have a long upper wick. The open and the close were the same or approximately the same. Again, that's the whole concept of a doji. If you had a thick real body, then it's not a doji. But this one is because the open and close are the same. no real bottom, shadow. It's all upper shadow. And so what's happening here is the buyers are trying to drive the price up and establish a new high, but they didn't succeed. They opened at a price, tried to drive it up, came all the way down. The closing price was near the opening. So again, we're going to look at the preceding bars, and the preceding bars were in an uptrend. Then what's happening? Sellers are emerging, and the uptrend might be ending. So we're trying to go up. Buyers are saying, let's push this baby up higher even still. But sellers are saying, no, we're going to bring this down at least to our opening here, and we're going to bring it all the way down for the close back to opening. And so that uptrend might be ready to transition or end. Same thing with preceding bars in a downtrend, just the opposite. Buyers are emerging, preventing sellers from moving the price lower, and the downtrend may be ending. So we open on the left-hand tick side. They might be thinking about trying to go lower, but buyers are like, nope, let's get this high range up here. Let's try to end on a high note. Doesn't end up that way, ends up coming back down to the close being the same as the open. So that's the doji, but it's an indicator that things are happening and a transition might be on its way. So be watching for that if you are in a downtrend. Another way you can look at dojis too is if they're missing shadows. So sometimes the shadow can be very long or very long or short wicks. But what they're really kind of or long in one direction or other. But what if they're missing a shadow? Like let's say you have what's called a shaven top. You can see in these examples here for a shaven top where there's really nothing going on as far as higher highs. There's no real high other than the opening of it or the closing, depending on how you look at it. But they have this long shadow on the bottom. So these are two different examples. So if the opening is at the high, and it's all downhill from there. So in the red one, we know it opened at the top of the rectangle, top of the candle, and then went down way down as far as that long candle, that long wick at the bottom. But there's nothing really at the top. That's a shaven top in a downhill or downtrend. And you think about it, it's kind of a double bearish, right? Double bad for prices, right? Not only is the day down, but there's no buying really occurring even after the open. Everybody was kind of selling and kept driving the price down. We know from that it's a red candle that the opening was higher than the closing because it's a red candle body. And we know because there's no wick at the top that there really was nobody trying to drive those highs up. Now, as opposed to the green one, it's the same thing. It has a shaven top, no higher highs, but the close is at the high. Again, our opening is going to be at the bottom of a green candle, at the bottom of the rectangle, and it's going to go up from there. Well, it might have gone down for a while. Sure, there's a low range, but it closed at near the high. And there was no higher highs in terms of a range, but it's a real positive sign that the close went really kind of pretty much up from there. So that's a shaven top. And you got to look at that one individually to see, what's the trend doing, and what's really also especially what was the opening and what was the closing, whether it's a bull or a bear type of thing. Are prices rising or falling? Bearish prices are falling, bull prices are rising. The opposite of that, shaven bottom, right? So we can look at our candles, not much wick coming out of the bottom there at all. It's all kind of a main body, and then of course a wick at the top. So if we look at the green one there, a bullish shaven bottom, we can see that it opened at the low of the day. There was not anything lower going than that. There's no wick below that, and that the buyers really dominated to drive that price up. So it was really a bullish thing. They drove it up even higher if you went all the way up the wick, but it still settled up higher than the opening. But there's no bottom in it, so it's a very bullish sign by itself. The opposite, of course, would be if it closed at the low, then sellers are dominated. It's a red candle, so the top of the rectangle would show us our opening. Bottom would show our close on a rectangle, opposite of a green one, or of our real body, and it would show that it closed lower. So the sellers dominated. So even though it opened and tried to go up higher up that wick, it really ended up down as far as in the closing prices were right at the bottom. It wasn't like it went lower and then went back up a little bit with a wick extending out of the bottom. It was like, no, we're going to get this as far down as we can, and we're going to close there at the end of the day. And that's what happened there as far as with a shaven bottom. Now, these missing shadows, shaven bottoms or tops, if they're really long, that can mean something too, as far as the wick or that range is very long. So the shadow is as long or longer than the real body, right? So that's the key you're looking for. Are these really long wicks around them? And they got to be longer than the actual real body itself to be a true long type missing shadow. Again, may or may not follow through into the next day, so that can be a little tricky. It's not a guarantee, but it's certainly definitely an indicator. And again, you want to judge relative to the preceding bars, but you can kind of see here what that might look like as far as the shaven tops or shaven bottoms and really long wicks with these really long missing shadows. So let's look at that. So if you have a really long, let's say long upper shadow, long upper wick, so the high of the day is well above the open and close. Remember, it's going to be longer than the real body. So the high of the day is, the absolute high of the day is well above what it opened at and what it closed at. So the price series is an uptrend, right? So think about, we're going upwards in prices. That's a good thing, going up. And you see a long upper shadow that shows the failure to close at the higher high. And that actually may signal an uptrend is over. It's like, okay, we're still in trend. It's still a green candlestick. We still went up. Our opening was lower than our closing because we know it's of a green triangle. But we know that we tried to drive that price up real high and even a higher high, but we didn't get there. So it may signal, when you have a shaven bottom and you have a long upper top in a uptrend, that uptrend might be over. And then really just the opposite in a downtrend, right? The long upper shadow shows buyers are willing to buy at higher levels, and it may signal that the downtrend is over as well too. So look at what's preceding and then look at your candlestick and see what color it is as far as the opening and closing, and then be watching for these long, really long missing shadows as far as going up the top there. Same thing with the bottom, as far as coming out, a long wick coming out of the bottom. A long lower shadow shows that the low of the day, the lowest price of the days in that range, was well below the open and close. Remember, it's a long wick you're looking for, not just it's a normal wick, it's got to be longer than the real body. So if the prices are in an uptrend, we would know that because it's a green real body. The long lower shadow shows that traders are not willing to buy at higher levels right up to the close. They're exiting at the high, and they may think new highs are not justified. So it may signal that the uptrend is decelerating, it's not as strong, or it may actually even signal that it's ending, so you want to watch that closely. And the same thing with prices or series is in a downtrend. The long lower shadow shows a failure to close at the low. We didn't close at the low, otherwise it would have been a narrower or maybe a shaven bottom, but it's actually showing a shaven top and a very long wick, and that may signal that the downtrend is weakening or over as well, as we closed higher than those lowest of lows that were very, very long, very low lows. It closed up higher than that. So there might be an indicator to watch that an uptrend might be happening. Now, if you see something like this, would you immediately jump in and say, oh, I see that that red candle with that long wick, I'm going to buy at the next opener, I'm buying right now. One thing with the trends, you want to make sure that trends become, establish themselves by itself. This is not telling you, it tells you to be watching, but you shouldn't necessarily take action on it. You should be waiting for that uptrend to develop. You just be aware that a downtrend might be ending, and it might be going either sideways, or it might even be reversing to a full uptrend, and to watch for that. And we'll learn later in the course about how we can use confirming indicators to confirm these types of moves. But again, really looking for these long upper and lower wicks, missing shadows, in addition with a missing shadow in combination, that can really tell us quite a bit. So candlesticks are beautiful things where they can tell us a lot by the real body and the upper and lower shadow, what might be happening with prices in that day and what might be happening in a series of prices. So by themselves, they tell us quite a bit, but they can tell us even more when they're part of a pattern, right? We looked at like shaven tops and shaven bottoms and different things, and we said, well, you got to look at the preceding trends. Was there an uptrend or a downtrend? But there's also patterns of candlesticks where if you see certain things happening in terms of a pattern, that can be a very, very helpful indicator itself too, and you can trade off of those patterns. Now, two candlestick patterns might have different meanings depending on where they fall in a series themselves. So not only the individual price bars, but the candlestick pattern in part of a larger series of uptrend or downtrend, and we're going to learn all about that. And I tell you, people really like to focus on candlesticks themselves and trade just on candlestick patterns. As you learn the patterns, they can be pretty easy to trade off of. You can kind of understand them easily. They work well as far as working with another indicator, like a moving average or other types of indicators that you will learn in the course. They can kind of pair well together that way. So let's start looking at some of the real common, candlestick patterns that you want to be watching for, and when you see them, there's certain actions you can take to help you be even more profitable in your trades. Two of the most well-established and really classic candlestick patterns are the hammer and hanging man candlestick patterns. So let's look at those and how to recognize those. And these you'll see fairly frequently, and you can kind of watch for them. People really love to trade candlesticks, really watch for hammer and hanging man a lot of the time, and that's how they trade. So in a hammer, you have an established downtrend. You can see here how we have those 4 red candlestick bars. So that's showing our closes are lower than our opens each day, and we got lower lows kind of going each day. And then a hammer is going to mark the end of the downtrend. And what you'll see is where you're going to get a green type bar, and you're going to have a long wick on the bottom. That's what you're looking for, is a long wick on the bottom, and not much wick necessarily on the top, but you're looking for that long wick on the bottom. And what's happening is, sellers are able to create some new lows. That's why you have the long range to the long low there on the bottom. But last minute buying overcame it and actually created a higher close. So it started off as far as the opening being lower again, like the trend was continuing, and then they tried to drive, the sellers were trying to sell even more, and it was real bearish, and things were trying to go even further down in price and really continue a strong, let's say, downward trend. But now prices have really kind of reached their exhaustion level on the lows, and buyers are saying, no, this is maybe a good opportunity to buy. And so they push up from that whole range of lows, a real long range, and push it up and actually create that the close is going to be higher than the opening, and thus changing the color of the bar. And then you'll see it kind of being confirmed over the next days. You need to let the trend form and all that, but this is a good recognition that something's going to happen. And you can see over the next couple of trading periods that now we get more into an upward trend where we have higher highs is what we're seeing there. So you're looking for that downward, on a hammer, you're looking for that downward trend, these low lows, and then kind of a reversal from there, as now buyers get back in and say, no, we got to move this up. This is way too low as far as the price. Now, a hanging man is essentially the opposite. You have an established uptrend where things have been trending upwards. Each close or each open is higher than the close from the day before. We have green candlesticks in this case. But a hanging man marks the end of an uptrend. And if you own the security, that's the time to sell as far as at a profit. On a hammer, you're looking to get in and start riding a new trend going upwards. But if you own a security and you see a hanging man, now it's time to let's watch, because this might be the time to sell. And what's happening is, bulls, or people who have faith in the security, they're unable to keep the bears from making a new low and from keeping the close below the open. They want to continue that uptrend. They want to see that uptrend happens, but what's happening is the uptrend doesn't continue. You have, again, this very low lows. Again, it looks like the hammer where you have a shaven top, but then you have a long wick on the lower shadow on the bottom. But you can see how it's how the candles change from green to red, that the close is lower than the opening. And so now we're anticipating a reversal, and you'll see that play out in a true hanging man pattern, where now the candlesticks afterwards continue. Maybe they could go a little sideways, but you're probably hopefully looking, or you might see more of a downtrend there, and anticipate that. So hammer and hanging man, the actual candle itself has a shaven top and a long wick at the bottom, but you want to see where they are at in the pattern. That's the key part. You can't just look at it itself and say, this is what it is. You need that pattern coming before to kind of confirm that it's that it's establishing this true hammer or hanging man chart pattern, and then you can trade that indicator accordingly. Let's talk harami and engulfing candlestick patterns. They're similar, but yet slightly different too, of course, as well. And let's start with the harami. And harami actually means pregnant in Japanese. And you can, if you look over on that samples I have there on the left there, you can kind of see where you have a small real body comes after a bigger body before it. Here we have a long red candle, and then we have a short real body in terms after it. So you can almost imagine it's like somebody might be pregnant or whatever. And that's the idea behind a harami, is that you have the small body coming after a big bodied candle. And you want to look at the color of the candle makeup. It's green followed by red would be a bearish type sign, and red followed by green would be more of a bullish sign. So in our example here, you can see that we have a red candle, and then that is followed by a green one. So this would be a bullish one. And you can kind of guess at that because you can see there's going to be an upward trend following afterward. And what a harami is really telling you is it's an indication that a change in sentiment is coming. Something's coming. So if you're looking for an indicator that say, hey, there might be a reversal or some change coming here, haramis can be very helpful for that. And the smaller the real body on the second harami, the more powerful indication that the reversal is coming. If it's not much difference between the two, then it's not really a harami. You're looking for a taller or longer real body candle followed by a shorter kind of squat, small, difference one followed by after it. And you're looking at the real bodies of these candles a little more so than, let's say, the wicks going up or down. But that's where you're looking at these open and closes around the candle. So if you're looking at this harami, you'd say, okay, we can see we've been in a definite downward trend, or we've got a couple, basically 3 red candlesticks in a row. Boom, all of a sudden, this narrow trading range, but the opening is low and the close is higher, so it changes the candle color to green. That it's now a higher open, or excuse me, a higher close than the open after we've been, in a downward trend, signaling that a trend change might be coming. Now, as we know with trends, we want to make sure we let the trend develop. We could see this and say, it's definitely harami, and it turns out to be a false signal. It's not harami at all. So once we see that second day and certainly that third day, now we're starting to see more of a confirmation that a real trend reversal has occurred, and that now we can be trading off of that. How soon you get in, you might be a little bit more related to your risk and and how you want to judge that, and be whether you want to be quick on harami or whether you want to let that form more and be a little bit more confident. But either way, you're looking at a real body, a bigger one followed by a small one. Just look at the which one's preceding which to see whether that's a bearish signal or a bullish signal. Like the harami, engulfing candlesticks also will signal a reversal of a trend. So you're looking at trends and you're seeing if it's going to continue or be changed or reversed. And that's where engulfing candlesticks work just like haramis. But it's if you look at the images on the left here, you can see what's highlighted in the square. It's kind of the opposite, right? You don't have that pregnant type look. You have the opposite, where you have something that's shorter and smaller being engulfed by something that's bigger. And that's the key thing. You have to wait for that second bar, in the example in the box here, to occur. You can't just guess, oh, well, we have, let's say, an upward trend, and all of a sudden we got a shorter real body and say, oh, we're definitely going to have a reversal. That could not be true at all. It could be just a little it's just a matter of a trading day, and in terms of open and closes, and the trends is going to continue. They usually don't look this, clean and neat. You're looking for something that's going to engulf it. And that's really what's happening. Is there's a wider range of the opening and closing than the day before. And if you can look at either of the examples, you can see that the second day in the box is bigger or wider or basically taller, and it's going to completely engulf. And that's the key thing. It's going to completely cover or engulf the opening and closing of the day before. And if you have a higher opening and a lower close in this engulfing candlestick, that's a bearish sign. Prices are going to start headed down. And if you have a lower open but a higher close, then that's a bullish signal, and then prices will start rising. And in both ways, you're looking at the previous, what's happening before, to see if there's an established trend, because this is all about trend reversals. It really works when there's a trend, not so much when there's no trend yet at all. So if we look at that example up in the top with the bearish engulfing, we've got a nice strong trend. We've got higher highs going on there. Even that small little short one there of that candlestick is still a little bit higher than the high day before as far as the close. And so everything's going green, everything's going up. And then all of a sudden what happens, you have this big engulfing candlestick. So you see that engulfs it. You have this big red thing where the opening is opening higher than the day before, but then the close is going to go lower than the close the day before, and that's why it's a red candlestick. And so that's telling there's a lot of downward selling pressure. And that's where you need to wait for the next one to just confirm it. This will look like it, and some people, you can trade right on that and say, that looks real bearish to me, I'm just going to do it. And that's okay, you're taking more risk that way, and you have a bigger chance for being wrong or a false signal. But you can certainly do that as far as your own risk and reward pattern around that. But if I look at, let's say, now the second red candlestick that's coming outside the box on this bearish engulfing, I can see, okay, now I'm seeing lower lows, and so now I think we've got a true bearish engulfing pattern here, and then I can, if I own the security, I would sell it. I would sell at some point here to get out because I've already made my profits on that nice trend going up, and now I want to take my profits. Now, if I look at the bullish engulfing, maybe this is a security we're not in because it's going down in price. We have a definite downward trend with all those red candles down there. And then we have the similar thing, just the opposite. We have a lower low, a short body in the red, that's then engulfed by this nice big green candlestick, the real body of the candlestick. And so we have our closing is that's higher than the open and close of the red candlestick. And, everything's being engulfed in there. We wait for the next candlestick outside the box to kind of give us some confirming, waiting for that second bar to happen, and that price bar. And we can see, yeah, this is a trend reversal. Look, we're going upwards now. So this, when you start seeing things like engulfing candlesticks, think, is a trend being reversed? Is there a trend, and is the trend being reversed? And wait for it to happen. The longer you wait for it, you're going to lose a little bit of opportunity cost where maybe you could have gotten a little earlier, but you're going to have less losses as far as being wrong or a false signal. It's really good to let these engulfing candlesticks kind of truly, form a little bit and have that second bar, the one outside the box. So basically, and to kind of both bars basically, the engulfing one and the one after can be really good confirming patterns with engulfing candlesticks, and they work just like Aramis, where you're looking at trend reversals. So shooting star and window candlestick patterns are very interesting patterns themselves here. And in a shooting star, we'll start with that one, you have a small real body and a long upper shadow, right? And what it's doing is it's implying the failure of a trend to continue. It's a failure to close near the high. Certainly the high being in that whole upward shadow, that whole long upward line on the trading range going up. It's not getting you near how high it got during the trading period, the trading day, for example. It's coming back down. So if you can see in the example here, we have a green candlestick, and if there were, let's say there are other ones out there before that, so we're on a trend upward. I threw in a doji just for fun. Sometimes you'll see shooting stars after dojis. Again, a doji shows that there's indecisiveness. So maybe there's been a trend. We haven't had a real, let's say, reverse or anything, but we have a doji saying, yeah, they might be getting a little indecisive. It could either keep going up or keep going down. We got to, or go sideways. We got to watch. And then boom, all of a sudden we see this shooting star. And we see that, basically, that there's a high established as far as at the opening, but the close is closing lower. That's why it's a red candlestick, because the close is lower. A close is lower than the high, or the close is lower than the opening of the day. But in that candlestick, that first red candle, you can see has that real high kind of shooting star, kind of like the shooting star as far as the range of prices. So there was a lot of higher prices going up there. There was people trading at much higher prices, but it all started to come down, towards that real body there on the shooting star. And then you want to see what happens next. It's a good indicator that you've got a failure of the trend, and then we're going to go sideways or start a reversal of the trend and start going downwards. So if you shoot a shooting star, be aware that if you've been owning a security, that might be a time to get out, or be wary of that and be ready to kind of pull the trigger and take your profits. A falling star would be the exact opposite pattern, by the way, if you were looking at, let's say, like a falling star, and that would be more of a bullish signal, where this is a shooting star is more of a bearish signal. A different type of signal, and this kind of works with our gaps, if you looked at the lessons around gaps, is rising and falling windows, right? And so really what you're seeing is it's kind of like a gap up. It could be a breakaway gap, it could be a runaway gap, but for a rising window, you have basically a gap up. And what happens is the third day in the pattern does not go down to fill the gap. Sometimes people trade and they're like, oh, I anticipate it's going to go down because we had this gap and it's not really a lot of volume behind it, not a true, let's say, breakaway gap. So that third day, it's going to come back down as far as what we'd be watching for. And if it doesn't come back down, then we have a true breakaway gap. And this would be in a case of what you could call a rising window pattern, where the gap isn't filled and the upward trend continues. So you're kind of looking for this pattern in this example where you have a rising window where you have a gap, and then you have that continuation of the trend. It doesn't go back and fill that gap. Kind of fills, kind of fulfills that whole definition of a gap that we learned about in other lessons too. Same thing with a falling window. You're really looking at a gap down, right? We're looking at our bars from left to right. We can see we've had some downward trend. That's the red candlesticks in a falling window versus the green candlesticks in a rising window. So we have this candlestick. Now we have a gap, and they're both red, so we're both going downwards. Our prices are falling. And then the third day in the pattern does not go up to fill the gap, right? It doesn't go up and do that to basically fill the gap and try to maintain that more overlap. It's going to keep going down. And so that's more of a falling window and really kind of a confirmation that the gap is a true gap and that the trend is being a really established trend is happening, and that trend is going to continue. Again, breakaway gaps are going to look at creating new trends, or this could also have been a runaway gap, which is a continuation of a previous trend that we're not seeing on the images here. So look at the gap lessons again to see, to reinforce stuff about gaps. But basically what's happening in rising and falling windows is the trend is going to continue after the gap and really be established versus coming back downwards and filling that gap. And that's what you want to watch for. Let's look at 3 soldier and the counterpart of 3 crow, and basically a 3 green or soldier one would be 3 green or white depending on your charting software. But basically you've got an upward trend. You've got 3 long green bars. That's the key thing you're looking for. You've got 3 long green bars, and they're all consistently all in a row, kind of lined up like little soldiers, right? They're lined up like if you have plate soldiers or something, and they're all lined up in a row. And it's really showing the continuation of an uptrend. And really what you're looking for is that they're longer green bars, and that the consistency part, they're very orderly. It looks like they're marching in formation, so to speak, or at least marching upwards in formation. And that's a continuation of the uptrend. That's the indicator that you're looking at. And the stronger that indicator would be is if the top wick, the top part, upper shadow is short. And so it's showing that the close is at or near a high. We don't have real long wicks showing that, well, it really went up real high, but then it came way back down. This is just a nice orderly, it's just following like little soldiers going right in a pattern going forward. And really the key thing you're looking at in a soldier pattern is that it's consistent. Both these patterns, you're looking for these kind of consistent looking bars, not a lot up and down, just real orderly. And so that shows a strong indicator the trend is going to continue and go in that same direction. Now it could be going the opposite direction, a downward direction, and then we'd be looking at 3 crows. And our candlesticks would be red, or again, depending on your trading platform, could be black. Either way, it's going to be the opposite of something that's trending up. We're looking at 3 red bars. And they're going to be the same thing. You're looking at longer red bars. You're not looking at dojis or very small real bodies. You're looking at really good kind of consistent long red bars. Again, all consistently in a row. Less like the soldier pattern. They're called crows because they're going downward. So decided to be a crow. And it's going to continuation of the downtrend. You're looking at it and say, yep, prices are going to keep going down. I see these 3 red crows. They're marching in nice, orderly fashion. I'm going to, then trade accordingly around that. And so the stronger the indicator would be if the bottom wick is short. So that's showing where the closes are at or already near the low. They're not going way, way down, and certainly there's no real long upper wick trying to drive highs. They're real consistent red bars going in the same direction. In this case, for a crow, they would be red and prices would be following, but you wouldn't have a long wick at the bottom. So the shorter the wick, the better the indicator. And again, looking for both these patterns, what you're really looking for is that there's consistency. And it's really, that's why the number 3 is important there, because 2 can give you an idea or something like that, but you start getting 3 and they're all consistent like that, then that's a real, really proven kind of pattern out there. Nothing's perfect, of course, but a real proven pattern showing that we're moving in a direction either with the soldiers going upwards in a trend, and that's going to continue, or with the crows going downward in a trend. So look for these chart patterns. Well, I hope you enjoyed this powerful section on candlesticks and candlestick patterns. I want to leave you with some final thoughts. And one thing too, as you start to see patterns, you start to see more and more candlesticks, it'll become more second nature to you. So if it seems like it's like a little bit harder to grasp, you can always go back and watch a lesson And again, as you actually start using it, whether it's with paper trading for practice or in your real live trading, you're going to start seeing these things very, very easily, and it's going to help you to become a very successful trader. So some final thoughts around this is, one, you want to continue to learn and practice and learn to visually recognize what these candlesticks are trying to tell you. They're trying to tell you something. So the more you understand the candlesticks, and you can, and their patterns that go with it, especially the Kahneman patterns, and you can just visually look at it and see, oh, that jumps out at me. I know this is what's going on. That's going to be very helpful, and that will come as you learn and over time. And also that there are many candlestick patterns out there. I've shared the most common, most classic ones that almost everybody can use and maybe should use, but there are a lot of different patterns out there. If you search the internet, you might find all sorts of patterns. In fact, if anything, there's too many patterns, and they can be detrimental because some are not as statistically valid as others. The ones I've shared with you are ones that are the best ones. So if you try to learn too many patterns, you can have this steep learning curve because you're trying to keep all these patterns in your head, and that can actually cause you to be impact your trading in a negative way. Other things is you start to see all these patterns, you might start seeing things. You try to learn too many patterns at first, and you might have mirages where like, oh, I think I see this, but really it's not there, right? It's a mirage. And you start getting where you look at your charts and everything starts swimming around like, oh my gosh, everything seems like a pattern or nothing seems like a pattern. So start by focusing on, patterns that seem most interesting to you, or certainly the ones that I've shared with you. Start there, and then you can build from there if you want. But too much can be sometimes not helpful either as far as candlestick patterns. And as I mentioned in a couple of the lessons, I said that some people only trade candlestick patterns. They just really focus on that, and that's okay. They can be successful that way. I would say take some of these other lessons that you're going to learn and think about that. If you love that idea of candlesticks and training just these candlestick patterns. And by the way, sometimes a lot of these patterns are not as common, so your trading might be not as frequent too. If you're looking for just a certain doji setup or a certain pattern setup, it might not be as common as other types of patterns out there. But a good practice too is you learn other things in the course is to combine it with other indicators for like confirmation. So maybe I see a candlestick pattern forming, I might confirm it that, okay, volume is doing what I'm expecting to, either rising or falling or staying the same. So the trading volume is there confirming, but I might want to confirm it with other things I'm learning, like trend lines, moving average, weighted moving average, simple moving average, trend lines, general trend patterns, upward trends, lower trends, these moving averages, momentum indicators, sentiment indicators. There's things that we're going to learn throughout the course here that you can use, that if you see a pattern from a candlestick aspect, you can go outside that to something a little bit different and say, okay, I see this happening. I'm going to use a momentum indicator and see if that actually confirms what I'm seeing here. That both my candlestick pattern and my momentum indicator are saying prices are likely to rise. Well, then I'm going to buy because I'm getting a double confirmation. And we'll learn all about that too towards the end of the course, where we talk about kind of setting up your strategies and stuff too. But right now we're learning the tools and how to apply these tools and how to apply them to be, so you can be very successful. And I tell you, candlestick patterns, great section here, and really get into that, and that can really, really make a difference in your trading and help you to be very successful. So let's learn about some more indicators and ways to interpret using technical analysis. In this section, we're going to talk about drawing trend lines, right? Remember, the trend is your friend, the classic quote in technical analysis, right? Because when you have trends, you have established kind of patterns just in the trend of whether it's going upwards or downwards, and we can, very strong indicator, we can really trade on that. But to do that, we need to be able to draw trend lines and be able to identify and then draw the trend lines to help us make decisions around that. And trend lines are drawn with a straight line, so you're going to be drawing some straight lines here. You don't have to be old school and draw it on a piece of paper or anything like that. Your trading platform will let you kind of draw lines and connect them and move them around and do all sorts of fun stuff. So you don't have to worry about being good with drawing straight lines. I'm not good at art, so I'm glad for the computer technology. So it's done using the trading platform. And again, trends could be an upward trend or they could be a downward trend, right? In our trend lines, there will be straight lines either indicating an upward trend or a downward trend. And the thing with identifying trends and using trend lines to help you really identify those trend lines, and then we can trade off these trend lines, is it's going to give you more confidence on your buy and sell decisions, because you're now visually showing the trends, and you can trade off that. And don't worry if your lines aren't perfect. I mean, there'll be nice straight lines because of the software, because of the platform, but in terms of where you place them and all that, and as you learn how to do that, that'll will come with time, probably pretty quickly actually. And it's not always exact. I mean, the markets go sideways, things happen, there's outliers that happen, noise, all that kind of stuff that happens that causes a price to go up or down. So again, trend lines are not always picture perfect, but they're going to be straight lines and they're going to help you with your trading decisions. So don't worry about if your trend lines are not works of art, right? And we learned about some trend lines, or some lines actually have meaning behind them already. They're like a support line, which is the lowest price in a current trading range. So it supports the price from going lower. That's a good way to remember. It supports the price from going lower, like in this triangle you see here. Or you have resistance lines where the high price it's the highest price in the current trading range. So it resists the price from going higher. It's like a line, it's a barrier, that prevents prices from going higher. As a review on that, and they are trend lines that you can draw, as far as different types of trend lines you can draw, and you're trying to draw these trend lines to kind of get an idea of what is going on. And there's some questions around when you start thinking about trend lines that I want to kind of get ahead of right away. And so let's look at a couple things as far as the actual drawing of the trend lines. One question is, do I need to draw in a certain place? And yes and no on that. It depends. I mean, most people will draw at the top and bottom of a candle. But you can draw in the middle of the body as well too. The whole key is to be consistent. So if you're drawing at, let's say, at the tops and bottoms, don't halfway through us and start drawing in the middle. So that's not going to be consistent. That won't be accurate for you. So when we talk about the top or bottom of the candle, we're typically talking about at the wicks, at the upper and lower shadows at the far ends there, as you see demonstrated here, and you'll see demonstrated in the upcoming lesson. So that's how I do it. That's how most people do it. But there's nothing wrong with being consistent and going through the middle as well either. And the other part of this, do I need to use candlesticks? And the answer is no. You don't have to use candlesticks. You can use any type of price bar, and sometimes something like a line bar will make it easier to see a pattern, or you're going to use another indicator overlay over the top of it, such as a moving average crossover, where your trading platform will help make it easy as far as putting all that together on it. It makes it easy to switch between price bar types too. You can usually just choose a different type of price bar, you click update or something like that, and it redraws your chart all ready to go with now price bars instead of candlesticks, or excuse me, like an open, high, low, close price bar, or maybe like a line, not a trend line, but a price line, as opposed to candlesticks. So you don't have to use candlesticks. However, there's a reason people use candlesticks. We have a whole section around candlesticks. We talk a lot about candlesticks. Candlesticks are very helpful, since they can visually tell you a lot more about what's going on, like through the color of their bodies, the main body, whether it's a white or green or red, for, let's say, a downtrend, green, let's say, for an uptrend, or it might be black, whatever it might be as far as the colors in your system. Typically it's red for a downtrend, or a down day, excuse me, not a downtrend, but a down day or down period. And also things like the lengths of their wicks can tell you something, and they have their own patterns kind of within your larger, bigger chart pattern. They'll have their own patterns too that might give you some indications on what might be happening. It might confirm what you're seeing with your overall chart pattern, or it might possibly make you rethink your overall chart pattern because something is happening with the candlesticks. So I definitely would recommend that you use candlesticks, but you can switch between the different price bars depending on what might work for you at that moment in time or what you're looking to do. For example, this image here shows an uptrend. As far as we can see it, you can see that line there. That's a trend line. It definitely has got an upward slope to it, going along the bottom as far as the range indicator. So it's going along the lows of the day. But it also is, if you recognize it from like candlesticks, it's a three-soldier candlestick pattern. So you get extra confirmation. So not only is it upward trend line a good bullish sign, or that the prices will rise, but also having, let's say, that three-soldier candlestick pattern, it kind of gives you even more, an idea of, okay, this looks like a very strong trend. I'm getting it confirmed not only by the upward trend line that I've drawn, but I'm also getting it from the candlestick chart pattern. So I'm getting the idea that it might be an extra confirmation out there. Now I feel more confident in my trade. If I wasn't using a candlestick, for example, I wouldn't see that three-soldier pattern, because I wouldn't necessarily see that. So that's where candlesticks can be very, very helpful. And I would tend to recommend using them with trend lines in almost all cases, but you can switch over every once in a while too, as far as sometimes it works better with certain types of lines or certain types of prices. I think I'll actually demonstrate some of those. Well, once I draw a trend line, is it permanently fixed? Does it just stay there? It never changes or anything like that? And it typically will for certain periods of time, but in general, no. You do want to have a definite slope, and you will use straight lines and all that, but you might need to adjust those starting points or adjusting those points a little bit as things change on your chart. So it's more of a dynamic process. You might, let's say, have an uptrend, for example, and then it goes sideways a little bit, and maybe you're starting to draw another trend line to show the sideways movement, and then it goes up or it goes down. So you might have multiple trend lines on a longer term chart if you're trying to really get a feel for a longer overall pattern. So do think of trend lines as a dynamic process. So as we go through these chart patterns, you'll see us throughout the lessons drawing these trend lines, and in that part we'll get an idea of kind of where to start the trend line, where to end the trend line, when prices break through a trend line. That's what you're going to be learning all throughout this. But think about some of the basics that you learn in this part, and then as we go through the next part of the lessons and we look at continuation and reversal patterns, you'll see how we're using trend lines and the drawing of them in those lessons and how they all work together. So let's start getting into that as far as how to actually draw these lines, and more importantly, how to trade off these trend lines. One of the most important and common things you're going to do is actually drawing upward trend lines. You want to identify an upward trend so you can buy in early in the trend, ride that trend out and get some profits, and then later you'll sell when that trend starts to end. So drawing upward trend lines is very important. So and what you'll be doing maybe all the time if you like doing trading off of trend lines versus, let's say, other indicators, but always a trend line is a strong indicator on its own. So let's take a look at how to draw and how to trade on trend lines. In this lesson, we're going to talk about specifically how to draw and trade off of uptrending trend lines. So when you're drawing an uptrend trend line, that's going to be really your support line, right? You're looking at your lowest lows, and you're going to connect to your next lowest low that precedes a new high. Okay, I'm just going to cover these three bullets real quick. It actually makes much more sense when we look at the graph, so graphically, but it'll make more sense there. But the idea is that as long as new highs are being made, you redraw the line to connect the lowest low before the last high, and then and when prices stop making new highs, then you stop drawing, and you extend that line at the same slope in the future. If anything to take away from it, you're going to draw this long slope line, and it's going to be an upward facing line, and the idea is you're going to buy towards the bottom of or the early part of the trend, and then you'll sell towards the upper part of the trend, and then in between will be your profit. So this is kind of the specific definition about it, but let's look at the example and how to trade off that to make this make more sense, because that's a little trickier to just talk about it. Let's now actually show you how to do it. So as you can see on this particular example here, we have a starting point. So we're picking kind of that lowest low as a starting point. If we look at, let's say our chart looks like this, we're going to that lowest low, and then we're going to start connecting those other lows, and we're looking at trading ranges here at the bottom of the trading range. We're basically doing it off the bottom of the wicks. You could trade through the middle of the bars, by the way. Just be consistent if you do it that way, but most people, almost everyone does it this way, where you're looking at the low of the lows, and I prefer it that way, and that's how I'll demonstrate it, but it doesn't mean you're wrong. Just whatever. If you want to go through the middle of the candlesticks, just make sure you're consistent. So as you can see, I've drawn this line and I've connected these lowest lows. And so if I start at the bottom left where that blue line is, you can see the lows approach it like 3 times, right? That first kind of red long wick bar doesn't exactly touch it. Nothing's perfect, but it gets close to it. Then there's another like doji type bar where it's a very small candle body. It's also red, showing that the closest was lower. Barely lower because it has a small body, but you can see that there's a low to the bottom there that comes to the bar, and then we had an uptrend, or an up day, and you can see a shorter wick on the bottom there, but you can see where I've connected those together. So it basically is connected 1, 2, 3 points there, and a lot of people will buy on that second or third touch. That's the idea of when they're buying, and this will introduce us to now our rules around how do we trade around this. So this is how we draw it. Now how do we trade on this? So there's 2 rules around this. One that's called the support line entry rule and the support line exit rule. So the support line entry rule says that you buy on the second or third touch of the support line. In this, where I have the arrow here, you can see it's on the third touch of that. It could have been on the second touch or near touch of that support line. That's when you're buying in. You're in an upward trend, you want to ride the upward trend, that's when you're buying in. And then when you want to exit, once that support line is broken, right? Sell as soon as possible after the low in the range, falls below the support line. That means the trend is broken. You can see it's approached it, but it's gone past it. In terms of the classic support line entry and support line exit rule, you're basically selling as soon as it breaks that blue line. And what's happening here is you want to confirm that the trend really is forming, and that's why you're waiting for a second or third touch of the support line, because that establishes the trend more. In fact, the more touches it has, the more established the trend. So a fourth or a fifth touch would show a very established uptrend in this case. And the reason you want to exit out of quickly is you want to take those profits, book those profits. You're not hoping, once the trend line is broken, the trend line is broken, and that's where you want to then sell as soon as it hits that support line and get those profits in there. So if we look further along here, let's say we had bought on that third touch, and you can see how we've gone up. It's actually had like another touch there, and the price has gone up, and we get to a point where it goes below the blue line a little bit, and that's when you would sell, right? That first time it breaks through that blue line. Certainly when you have that other candle on the right of the line there where it's really definitely gone below it, you definitely are selling then, is the idea behind it. Because the trend is now broken. Now it could go sideways from here, it could go downward, but the definite uptrend has been broken. In fact, I took this from a real security, and this is what happened afterwards. So you can see it actually really did break the trend and start heading in the opposite direction. So I wanted to sell and get that profit before it went down and ate up all my profits, is the idea behind this. So I'm watching that trend line, I'm buying on the touches, and I'm selling once it crosses through there. And it's kind of extra credit in how trend lines can kind of combine with other indicators. If we were to look at this, is there something more going on here once we reach this point here, right? So we bought, let's say we bought on the second, or let's say we bought on the third touch. And then we have, the next kind of, let's say, periods happen. And you see those two last candlesticks. I've kind of covered up the other candlesticks for a moment because something's going on here. Do you see the white body candlestick, the second from the last candlestick, and then that big red candlestick there? And then I've covered up what happens after that. But if we were to look at that, we'd say, okay, we're in an uptrend, but that looks like something, right? Think about our candlestick lessons, or think about candlesticks. And this is extra credit, but if you were to say to yourself, that looks like an engulfing candlestick, right? We're in an uptrend, and that one big candlestick has engulfed, the big red one has engulfed the other one. You would be correct. That is, well, as we'll learn about candlesticks, or learn the candlestick lesson, that is a bearish engulfing candlestick. There are bullish engulfing candlesticks too, but this is definitely a bearish one. Means the prices are about to go down. And why is that? Because we were on an uptrend. You had a red candle body fully engulf a uptrended, let's say white, or it could be green depending on the color, but you have the red candle, a down day, engulfing a previous closing up day. So that's telling us from a candlestick pattern that there might be a turn here and going to a downtrend. You want to wait for that to fill in the next day where it should go back now downwards. And in this case, it went down. The close we had one in between day where actually the close was a little higher, but it broke that trend line. See where it broke that trend line for part of the day? That would have been a sell signal in itself, and maybe we should have sold there. You can sell there. That's the idea of a true support line breakage, that you are selling there. But if you were to wait it out a little bit more, you definitely would have a sell confirmation, because now you've got a red bar, red candlestick price bar. You've got an engulfing, bearish engulfing, and you've got a breakage of the support line. I mean, that's definitely, and if there's anything telling you to get out, that's telling you to get out. And so that's a little extra credit on this one first, this real one that we pulled from. And then when we look at the pattern after that, you can see, and this is from a real security, you can see that, boy, it went on a real tear downward. Look at all those red candlesticks right in a row there, just down, 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 and then it reached the bottom and then went back up. But in the week, maybe there's a new trend we could form to trade on that new upward trend to the right that might be forming. But if we look at this, we can see we had a nice little uptrend. We bought in there. We made some profits. That bearish engulfing candlestick was worrisome. Maybe I sell there. Maybe I'm hanging on for the trend line to be broken. But once it is, maybe that's the time to get out. I got a lot of factors telling me sell, 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 so to speak. So upward trends are great. It helps us to buy low and sell high as we go up on the slope and we go up on the trend as the prices increase. But it's also very important to understand downward trends. And so we're talking about downtrends and how to be wary and how to trade downtrends and be, working through those types of trend lines. So in a downtrend, what you're really drawing is not support lines, you're drawing resistance lines. And again, this will be much more sense as far as when we actually draw the lines and you see the examples. But basically, you're starting at the highest high, you're looking at your candlestick at the wick of the highest high, and you're connecting to the next high that precedes a new low. And you can see this line here, it's going to have a downward slope. And as long as new lows are being made, you keep redrawing the line to connect the highest high before the last low. So you're drawing your line along the highs, but it keeps going downward, right? That's the whole idea of a downward trend. And when prices stop making new lows, then you stop drawing, right? And then you extend that line at the same slope out in the future. You want to see, you're basically extending that line all the way out. And you're watching that trend line. So let's look at that graphically so it makes a little bit more sense here. If you see this downtrend here, you can see where I started. The highest high, in effect, is where I'm starting at. I'm at the top of the candlestick now in the upper shadow at the top of wherever that wick was. If the wick on where my starting point was in the far left was even higher, I'd be starting up even higher. I would always start at the top of the wick in this case. And then I would be connecting it down through these next ones that, connect along the slope as far as you can see where it's, this downtrend has really been established. Where it says downtrend established, that arrow, that's showing at the third, a real close approach or touch of that downward trending line. You can see I had a first one there, I had a second one there. In fact, when the second one happens, they're right in a row there, that could have been an established downtrend right there. A lot of people would consider that, that's fine, but if I really wanted to make sure, I could make sure it touches for a third time along those lines. But you can see we have a downtrend that is established, and you can see our downtrending line along those lines, right? So now we're watching this. We're waiting. We're either, if you're short selling or betting on prices going down as far as a strategy, you can continue to sell this, basically be trading along it, expecting lows to keep going lower, and they do. And let's say they keep going lower, and we now have a fourth test of the resistance line, right? So we can see that our resistance line there's been another test of it. Though in this case, the prices went up and they stayed up. You can see how we've got white candlesticks where it kind of started to go up for 2 days, let's say, in a row. So that's a little bit interesting versus the third downtrend. It had a spike up in prices. People were trying to get it above that trend line in effect, but it went back down and went way back down. And you can see where it had that third touch, had a real red bar with a long upper wick. In this case, the buyers are trying to drive that price up on the fourth touch of the resistance. So that might be telling us something, and why candlesticks are helpful, that buyers are trying to do something here. Will they break through that line or not? That's what we want to watch for. Are they going to break through that line and break the trend, the downward trend, or will go back down again and keep going on that downward trend? By the way, if you look at that last price bar we have there, it may look like a dragonfly doji. It's not. It's got a little bit more of a body to it than a lot of dojis have, but it's kind of a doji-like. But it's not technically it's not a dragonfly doji because there's no prior established uptrend. For a doji, you need to have an established trend, and we don't have an established uptrend. In fact, we're still in a downtrend, so it wouldn't really consider it as a doji and trade off it as a doji. But if you're looking at it and thought, hey, maybe that's a doji, good for you. All right, so let's see what happened in this particular case. Again, a real security. So it approaches that resistance line, but doesn't break through. But then you can see on the day after, it definitely breaks through that resistance line. I mean, it actually almost has a full gap up, but the whole candlestick body and the price ranges on the upper and the lower, all of them have gone completely past that breakthrough or broken through that resistance line. So that's a real telling that it really has broken that trend. Even if the upper shadow just goes past that resistance line, for many people, technically they'd say, yeah, once it does that, that breaks the rule as far as the resistance or the sell rule, and so in this case, it breaks the trend rule, not necessarily a sell rule, but it breaks the trend. So the trend has been broken. The downtrend is broken, and then it kind of goes sideways and it kind of goes on from there. But when we were looking at this trend forming, we established that there was a true downtrend. We watched it approach that fourth time, and then it could have kept going back down, or in this case, it strongly broke through that trend line. So we strongly know the downtrend has ended. Let's talk about channels, and channels can kind of provide some good opportunities for trading as far as trading within the channel and also recognizing when a channel pattern is going to be, broken out of. And a channel, as far as for trend lines and simply drawing a channel trend line, is simply drawing the support and resistance lines on the same chart. When we were doing downtrends, we're connecting things. We're doing uptrends, we're connecting things. We're now putting those support and resistant lines in the same chart. And one thing when you're doing this, you want to take note of which one is the predominant trend, right? So we're not looking at things that are, not trending or something like that. We're trying to, get some definite patterns around here. And if there was a predominant trend coming in, like an uptrend or a support trend coming into our resistance or into our channel, we want to take a note of that. And you might say, well, this kind of looks like a rectangle, and they can, and they usually do as far as that, but they could also, form other types of things too, as far as a channel or a range of where there's trading happening between the resistance and the support line. So if we looked at this with some of the examples we'd given before, you can see on the left there, we had our downtrend established, our downtrend ones. And so then we just connected the two lows there, as far as, the other end of the range from the highs to lows. And you can kind of see how a channel is formed, and there's things trading in between the channel. So for example, on the left there, where had it broken through, where the downtrend ends, let's say the downtrend hadn't ended and it turned back down towards going lower, then we would be watching that other channel to see if it would hit that support line at the bottom there of that channel and then rebound back up. Might be something, or trade with inside the channel. But in this case, it did break through and it formed some new stuff. You can see also, or some new trading kind of sideways, up and down type patterns. Until really getting now that we saw on the right, the same deal where we are connecting our tops and our bottoms, and now we have a new, in this example, have a new downtrend. Look at all those red close days in rows. There's 6 of them there, and you can see a pretty well-formed channel, forming along that too. Is the idea that we're looking at, is basically connecting the tops and the bottoms to kind of get a view for the channel. If we looked at another one, let's say on an uptrend, and this is the image you've seen before when we were talking about uptrends, you can see we had that bottom line, the support line, and we're buying on the second or third touch. In this example, let's say we're buying on the third touch, and we're now connecting the highest highs as far as, looking at that channel, and you can kind of see it more spreading out this channel. And this is where you can get into more of a dynamic process, because you could look at that and say, well, maybe if I adjusted my lines and didn't start at that first day there where I started lines, maybe if I go 2 days in, it might look something like this. Well, then that seems to be a little bit more of a narrower range, a more maybe accurate type thing as far as understanding what my channel resistance line on top might be, right? So there's a difference between those two different ways I drew it. The first way was, an accurate way, but the second way, if I was also to start my support line at the same spot, ideally that's what you should do, or you could do, but you might say, okay, this looks to be a little bit more accurate as far as what's going on, at least at the current moment. And then you can, combine, you combine this with other things too, just like we saw that bearish engulfing candlestick. This might help where I'm looking at the channel and I see that that big red bar, engulf the previous up close, where it engulfs that. And I can see, that big red bar hit both my top, my resistance, and my support line at the same time in a trading day. That's a pretty wide movement. And it's a bearish sign because it's a candlestick pattern showing a bearish sign. And then what happens next is I get my support line broken, and I could have sold then, or certainly when I get a full break of the support line, I can sell then as well too. So that's kind of showing me my channel and how my channel is kind of being worked in that channel, and then combining it with my trend line, and then combining in this case with a candlestick pattern too. So a couple of different ways that you can look at or combine it too, to kind of, you're basically trying to get a visual clue as far as what's going on. And so channels can be helpful when you're looking to, maybe sell at resistance lines, or buy at support lines, for example, or we start seeing things where we see a trend line being broken. Seeing that full channel pattern might be able to help us there as far as understanding what might be going on with that trend as well. So another tool in your toolbox that you can use when you're drawing your trend lines. Since we live in an imperfect world, even our trend lines are imperfect, as in sometimes you get false trend line breaks, right? Where it breaks through a trend line and it's supposed to keep going after the break. It's supposed to, not go back above the trend line, or not, go back into a trend, right? It has broken the line. There's a rule around that, right? Once the trend line is broken, the trend is over. So that's a very important rule to follow. But a lot of times there's something has happened. Maybe there's a temporary amount of noise, or there's some, some buying and selling that's caused something to happen that's only a temporary false break as opposed to a true break of the trend line. So we're going to talk about in the next couple lessons. We're going to talk here about how to identify these false trend line breaks, at least give us our best chance at this real vexing challenge. And then also we're going to have a strategy around how can we approach these false breaks and manage them in a better way when they may occur. So first off, let's go back to the rule again, right? Once a trend line is broken, the trend is over. That rule will serve you well. That is a very, very well-established rule. And it really takes emotion out of it, takes hope out of it. Oh, I hope it comes back above the trend line. It takes all that out of it. So there's nothing wrong, in fact, very good, that once the trend line is broken, the trend is over, and just stick with that. However, false breaks do happen, where they're breaking that trend line and the trend isn't over. It goes back into the trend, very quickly. So in this lesson, we're going to keep talking about how to identify those. And then the next lesson, we're going to talk about the strategy and how to deal with them as well. And one thing to note about this, the terminology is like a false breakout, but it's actually, they're not false. It really did happen. The trend line really was crossed. It really did happen. But what ends up being false is the conclusion you draw from it. In a way, you are misled. It happens all the time. And we're going to look at how maybe to possibly identify these things so we're misled less. There's really three good ways to kind of look at this. And one is, in terms of how to identify, is did the breakout occur as part of the range or the final close break it as well? And what we mean, did the actual close of the day, break through the trend line. So for example, if we look at this image here, we've got a downward trend. It's established on the second touch of that downward trending line, that resistance line. And then we get this long, let's say in this case, I adjust a little bit, you see this where we have this long red candlestick with a long high range at the top there where that breaks through the trend line. It broke through the trend line. That counts as the trend line breakage because it did break through. However, the close of the day, which is at the bottom of in a red candlestick in this example, did not break the trend line. It ended up going back into trend, back below the trend line. So that can be an indicator that you might have a false breakout. And it could also be on the upside too. Here you see the next arrow where there's a false breakout, you can see it was actually an up close day. Following the previous day was an up close as well, but it was up in terms of the close, but the close did not go above the trend line. The range did, the highest highs as far as the price range, but the open and the close, and specifically the close, still finished below the trend line. So it can happen in either case with either type of candlestick. And so these are one way to indicate it might be a false breakout where it got pushed up high enough to break the trend line during the day. The rule would say you would sell then, and that's perfectly fine to follow. But if you're worried about a false breakout or you want to push it a little bit further, wait for the close to go above it. And then you can see the last candlestick we have here. Not only did the close go above the trend line, but also the open went above the trend line, and even the whole range of highs and lows, the whole candlestick and its upper shadow and lower shadow, its wicks, all of it finished above the trend line. So that would show, yes, this downward trend is definitely over at this point, and it's not a false breakout. So when the close breaks through, it means it's less likely to be a random event or noise related. That means people are kind of, finishing their positions, closing their positions for the day. And so the close as the final price of the day is more, a much more accurate way, or at least an identifier that this might be a false breakout if it doesn't break through that trend line. If it does, then it's very well established that there is a breakout and the trend is over. Another way you can use in combination too, or use on its own, is to look at trading volume. How much buying and selling is going on, right? So if there's a high volume or a volume spike, that often accompanies the end of a strong trend, whether it's a strong uptrend or a strong downtrend. There's a buying and selling frenzy that's breaking through that trend line, that's causing that to break through the trend line, and associated with that, looking at the bottom of your chart where you've got your vertical bars showing opening, close, or volume, looking at trading, how many transactions are happening. When you see a spike in that and it's breaking through a trend line that you've drawn, then that's a pretty strong indicator that the trend is over. A steep volume decline shows that overall interest is waning and may signal a breakout. Right? It hasn't necessarily happened, but it may signal that interest is waning, may signal a breakout. And if there's steady volume, then it's less likely for a breakout. But be wary, as any cross of a trend line is also significant. So we're looking for a false breakout in this case. The trend line has been crossed. We know that's happened. We could be taking action just on that. But if we see, boy, there's a lot, the volume is not really spiking or declining or anything, it just kind of seems steady, then there might be a chance that this is a false breakout. But high volume, whether it's high or low, may signal that this is a true breakout. So be wary of that. But when it's steady, might be like maybe you can push a little bit further as far as that maybe it's a false breakout. And then lastly, a good tool to use is your other indicators, right? You can use your other indicators to help confirm or possibly disregard a breakout. Like, okay, they broke the trend line. Other indicators are saying the trend's changing. There's a reversal going on. Okay, I got it. If it's an uptrend, I'm selling because not only is the trend line broken, but my other indicators are saying that too, as an example. So using multiple indicators is always a sound idea, and we'll learn about that later as we talking about how you can have primary and secondary indicators and how to use that type of strategy, or a third or fourth indicator. So multiple indicators, can be very helpful, and those, sometimes they can give conflicting signals. They certainly can, and that's why sometimes you'll want to give more weight, that you would choose more weight to certain indicators than others, and you'd also want to look at your own risk profile. If you like less risk, then if a breakout occurs, just get out, right? You might want to just get out with the well-established rule. If the trend line is crossed, it's broken through, then you're out. Or if you're seeing a little bit more confirmation, even if there's confliction, if you want to take on less risk, then you want to get out right away. If you want to push it more again and see if this is a false breakout and take a little more risk, a little bit more downside risk, you can do that. Again, this is more about you and your trading style and your plan. And sometimes a confirming indicator can give you an advance warning to be on the watch for a breakout, right? That something might be coming. We saw that in the examples where we saw a nice upward trend line, things were looking great, and then all of a sudden out popped this bearish engulfing candlestick, which is a real clear indicator that a reversal to the bearish to the downside might be occurring. And we saw that occur. You could see, okay, our range went below the trend line. That's a breakage. We would sell just on that breakage, just on that because it broke. And the fact that it's an engulfing candlestick, or looks like it's one coming, we might have sold just based on that. You'd want to have that next day, that last red candlestick to kind of confirm the bearish engulfing candlestick. But between breaking the trend line and it's getting set up as a bearish engulfing, there'd be nothing wrong with getting out right away in before that. And if you want to wait a little bit more till it fully breaks that trend line, as it did here, and not only with the close also broken, in addition to all the ranges broken, that's fine too. Then it's really super confirmed. But you can use your indicators again to help confirm what you're seeing with your trend lines and help your decision making by combining and using other indicators when they happen. So that's a little bit about identifying trend lines or identifying false breakouts. Not easy. It is the number one challenge out there. But if you can start using some of these ideas, you can decide, and based on your own risk profile and what you want to do and how you might manage your trades, to start deciding like, okay, how is that going to affect my decision making? Again, if the trend line rule is broken, you can always use that rule, established rule. But if you want to try to see if a false breakout is happening, use some of these ideas and see what happens. And you might be rewarded in terms of, let's say it's an uptrend and it picks back up, or you might have taken a little bit more loss, hoping that the false breakout wasn't really occurring, and you wanted to let it prove itself a little bit, and it ended up being a real breakout. And then you need to act accordingly too, with that extra confirmation. Okay, so we talked a little bit about how to identify that a false breakout may or may not be occurring. And if that's so, what are some strategies we can use to help us become better traders along that as well when we think that a false breakout might be occurring? So that's what this lesson is about, is your strategic approach to these types of things, these false trend line breaks or potentially false trend line breaks. And once again, hard fast rule, once the trend line is broken, no matter how it's broken, the trend is over. That is the hard fast rule. Again, you're well served following that rule. Takes emotion, hope out of it, takes a lot of extra analysis out of it. So nothing wrong with that as far as once that trend line is broken, the trend is over. However, false breaks do happen, frequently happen. So there might be ways that we can use a strategic approach to really kind of deal with them and help us be better traders. And we're going to talk about how we can use support and resistance lines in terms of our strategy, but also how to apply filters around this too in this lesson. So let's get into that, how we might be able to deal with these potential false breakouts in terms of strategy. So here's an old friend here. Let's say we saw this happening, right? We saw this image here on the left there, as far as you've got this nice uptrend that you bought into, this nice uptrend, and before you see the definite turnaround there, but let's say you're seeing this uptrend, and you first see the support line is broken, and you're thinking, you know what, that support line's broken, but maybe that's just temporary profit taking. You can see we had this nice long trend before that, and we bought in in this example, on the third touch. But let's say if you bought in sooner even, then you'd have this nice long trend that you've been making a nice profit. And maybe there's just some temporary profit taking. Maybe it's just going to go down or sideways a little bit and then resume that trend. So if the close is below the trend line, you're thinking, well, maybe it might be okay to hang in there a little bit. Just hang in there a little bit more. So if you were to use this as a strategy around that, what you could do is adjust your stop loss order to kind of lock in profits, right? We saw when we bought, you put in and look at the lesson around stop loss orders and how to use these orders, but basically you're going to set a stop loss at a certain point. In this case would be moving it above what you bought it at. So if you're wrong and it's not a false breakout and it keeps going down, you'll be able to automatically sell because of the order you placed and lock in some profits there. The other thing you can do, like in this example, is adjust the total amount of the money committed to the trade, right? So let's say we bought in here at a certain amount, and we could say, okay, we're seeing some bearish signs, we're seeing support line breaks. Instead of selling everything, maybe what we do is we sell some, but not all of it, to reduce the risk and lock in some profit. And then we can sell all of it later on as we get a more definite sell signal as it starts to make that turn. So the idea is I've made a profit, I'm going to lock in some of those profits. I think I might have a false breakout, maybe some temporary profit taking. I'm going to hang in there a little bit, but with a smaller position, a smaller amount committed, because I've already taken some of it out. And if it looks like it goes south and it's really it is a definite breakage and it keeps going down, as in this example it does, well then I'll sell at that. I'll sell and still make a profit, but I'll get out of it completely at that point. And then I'll sell it all later on as that more definite sell signal. So you see in this example here, where we have buy, and then you can see where it crossed that line, then maybe you're saying, I might sell here, but I might not. Let me hang in there. And then it starts to see where we're definitely having a close all the way below the break line. Now we're really selling at that point. And maybe we already took out some profits at the sell maybe, and then we took the rest out of the sell definitely. But if it had turned and gone the other direction, then we still have some money in, and that we could keep running that trend. And again, with all this, you don't have to be perfect, right? You want to start using strategies to help lock in profits and things, so you don't have to be perfect on all this. You just have to be kind of smart about it. Another way that things could happen is, let's say a resistant line breaks, right? So the buyers or the bulls have broken through. You were on a deep downward trend and it's been broken through. The trend is well established. You can see the downtrend here on this image is established. You could have bought, you can see that on the second touch or the third touch that it's definitely a downtrend established. Even at the fourth touch, you could say, well, it's still part of a downtrend. And the question is, will it become a new uptrend once it's broken through, right? We're looking at, is this a false signal? It's already broken through. This whole idea is it's broken through. So the strategy around this on a resistance line break, it's been in a downtrend, it's broken through. Will this become a new uptrend? So the strategy, wait for the second or third touch to buy into the new uptrend. That's our orange line there. You can see we got a second touch there. Especially since we're coming out of a real steep downtrend in this particular example, this might be a case where it might be safer to wait for a third confirming, real establishing third touch, just to be sure, just because it just came out of a big downtrend in this example, for example. And that's the orange line there. Another thing you do is what's called selling short, and basically you're betting the price will continue to go down at number 2 or number 3 touch of the resistance line. So we're back in the blue numbers there. And you're seeing it, you could be selling short at those periods. And then you close your short position once it breaks through and then a resistance line breakout. So you're booking your profits at that point. So you're kind of betting this in terms of that way, or investing it that way. When we get into order taking about how to sell short and how to cover your shorts, we'll get into that, how it works. But the idea is, you think it's going to go down, you're investing in a way that you're betting on it to go down. It does go down, and then once it breaks that line, you're getting out. So again, you don't have to be perfect with any of this. And really, for most people who aren't selling short, they're really doing that first strategy of like, I see it's breaking through. I'm waiting for the second or third touch to buy in a new uptrend. And if that doesn't form, then I'm still staying out. I'm still staying on the sidelines. That's okay. I'm watching for new trends or new indicators, new confirmations to come along with a resistance line break. There's also, some interesting rules out there, or different ways you can approach it too. Beyond this, that's the core part. One interesting one is the 1-2-3 rule. It was created by Trader Vic, a famous trader, Trader Vic, author as well. And the whole part of this and all this is the goal is to manage the big challenge of these temporary pullbacks. In this case, of an established uptrend. So the 1-2-3 rule is related to definite established uptrends, and trying to sell out of a temporary pullback. You want to try to run that. You want to keep running with that trend. It helps you to not get out too early. So if you were, let's say, bought early in the trend, you've had this nice run up, then it pulls back. It's the idea of the 1-2-3 rule is that you're not selling during the pullback. Even across the trend line, you're not selling during the pullback. You're trying to work through this temporary challenge as far as a temporary pullback, so you can keep your money in and let that profit keep running. So how does the 1-2-3 rule work? Let's take a look at that. So let's walk through this in steps. So first off, let's say on this particular one here, you can see we have a nice uptrend. We bought on the second touch in this example, could have been on the third touch, but we bought in there, and you can see we have a nice price run up, nice profit up there, and then we see cross the trend line. That's our sell signal. And so that's the first time they tell us, oh, we got to sell, right? As soon as it breaks that line, we're selling. Or if you want to wait till it's a full close across, you could sell then too. So, but you're looking at this line and you're saying, I don't know if I really want to sell. And there might be some really good logistical reasons behind this, or tactical reasons, not hope and praying, but really some things that happen. If you look right before that sell, going back from the sell thing, you see there's a gap up, right? There's a jump between the two white candlesticks where the prices don't overlap, or the price range doesn't overlap. A gap up is always a good bullish sign, right? It doesn't mean it's necessarily going to happen that way. They'll keep going up, but it definitely is a good sign that something good is happening. So you had a gap up, and then also you see there we have all these higher highs. We have these high closes all in a row, 7 of them since you bought. 1, 2, 3, 4, 5, 6, 7. Since you bought, it kept going up 7 straight times. So that's good too. But then now there's this temporary pullback, or maybe it's a temporary pullback, you don't know, but you reach that peak and then you start seeing that the prices now start going red, and the candlesticks go red and it's starting to go down, and it crosses that trend line. So with that good stuff, all those high closes in a row and the gap up, do I really sell because it crossed that trend line, or are people just taking some profits and they're just doing that? How do I apply my 1-2-3 rule to this is the idea. So there's how you do it. So let's put on some lines on this, and this is how the 1-2-3 rule works. So first thing you do is, in order for the 1-2-3 rule to be activated, you have to have the support line broken, right? That's the whole idea. You're trying to see if this is a false signal. So first step, it's got to be broken, right? And you can sell right there. That's always the established rule. You can just sell there. But if you want to try 1-2-3 to see if it's more of a false type of breakage, then the second step you would do after the support line is broken is you're watching for it to test of higher highs. You might go down a little bit more, might go sideways, but then you're looking for a turnaround and for it to go back up and test the higher highs. That's that number 2 there. See how I draw on a line? Whatever was the highest point of that trend before it was broken, that's where I'm going to draw my line for my number 2 of the 1-2-3 rule. And you can see it was actually a red candlestick. It was a down day, but the buyers tried to push that price higher. They tried to keep going with that uptrend, tried to turn that into an update, but the bearers, the sellers won out on that day and then pushed it down and then kept pushing it down past the trend line. But that's where we're looking at that highest high on number 2. And then number 3 is where you look at where the previous significant low was, and this could have been higher up on the trend line, but not in this example. The previous significant low that approached the trend line is where you draw a line straight across. That'd be your number 3. And once that's broken, then you have real definite confirmation that this is not just a temporary thing, it's a definite thing as far as a turnaround. So if we look at the 1-2-3 in this example, you can see, of course, the support line was broken. And the highs, they had a little pullback, had a little turnaround, but it never really tested that higher high. See how the highest point after the support line, after the trend line, never got up to number 2, never broke through number 2. It was really what we're looking for. We're looking for it to break, for this to have worked. In this case, it didn't. It should have, if it worked, it would have been breaking through at number 2 at this point, and then establishing or reestablishing that strong trend after a temporary pullback. That's what we would look for, is that breakthrough of the number 2 of the higher highs, and it didn't. Instead, it went down, and maybe it went down a couple more days, a couple more red bars, and we're saying, well, maybe we're just in a little pullback, a little narrow trading range that's going to go back on trend, going to try to come back to that number 2 and go higher high, but it never did. In this particular example, it went down to the number 3 line, the test of the previous significant low, and then broke right through it, right? It broke through, and that's your confirmation. As soon as it breaks through, that's enough confirmation, and you're selling at that point, to get out once it breaks through that. So as you can see in this example, I would have made more profit in this example if I would have sold at number 1, if I would have followed the rule, not tried to test for a pullback. If it would have broke through at number 2, then I would have been rewarded on that, right? So the idea is you're looking at other confirming factors, you're looking at things to see how temporary this pullback is, or if it really is a reversal, like in this case. But even by setting my 3 at the previous significant low, between when I bought and that previous significant low, I made profit. I did not make as much profit as I would have from the green arrow up to the number 1 where I sold in this example, but I would have still made some profit and tested out the pullback there. So this isn't a case where it didn't fully work out, as far as it worked out in terms of still getting profits, but it didn't work out as far as hanging in there through a pullback and then breaking through number 2. And that's the idea of the 1, 2, 3 rule. You're looking for it to break through a number 2, and in your downside, you're protecting yourself with the number 3 as far as your significant low confirmation. Another strategy you can use to kind of test to see if something is a false breakout, is breaking through a trend line, is to apply a filter. And we can use filters in lots of different types of indicators, but we're going to talk about applying a filter in a trend line, and specifically, applying something when trend lines are broken, for instance, in terms of trading mechanisms. So let's talk about that. So at its base level, a filter is simply a modification of any trading indicator. And basically, you're setting a predetermined rule on an action that you'll take when certain conditions are met. All right, so that's just the key thing. It is predetermined. You've already decided that when this happens, then you will then you will take a certain amount of action. And we're talking about this specifically with trend lines, but you can use filters with different types of indicators as well, and some work better than others when we get into the lessons around more detail around filters with other types of indicators. But in this case, we're looking for a trend line breakage, right? We're doing a filter, a predetermined rule that when a trend line is broken, we can modify the clear rule of whether to buy or sell by adjusting it with a filter. And that filter can be an amount or a percentage of the break. So it needs to break by a certain percentage before we'll take action, not simply breaking, but has to do so by a significant or certain amount of percentage breakage, or duration or time of the break. How many, let's say, time periods, maybe a day or days after before I take action. So I'm not taking action immediately. I might be taking action because I've modified my indicator to let it kind of be out there a little bit more in terms of time. And the key part, again, of all this with filter conditions is they need to be met in order to take action. You predetermine this, and you've said, okay, I'm going to do this. I'm going to follow this plan is the idea. So let's look at an example that will really kind of bring this home. So let's say we know the support line exit rule, right? So you're selling, you've bought into an upward trend, and you're going to sell out of that trend as soon as possible after the low falls below the support line. The low, anytime in that low price range during the day, the support line is broken, the trend is broken, you're selling. That's the rule, right? So that's the rule. Now let's modify or filter this rule is another way you can approach it. So you're not selling exactly at that point. You're trying to give yourself a little bit more to see if it might be a false or temporary breakout. So ways you could do that is say, okay, I know the support line exit rule says I should sell as soon as it breaks the line, breaks that support line. But I'm going to have an amount type rule, and it might be like something like, once the price range, I'm going to say the price range has to break the support line by 10%, then I will sell. So it's not simply enough that it breaks it, it's got to do it significantly enough by 10%. Or I might say not only the range, I might say, well, the close, the actual final close has to break the support line. And that has to not only break the support line, but that needs to do it by, let's say, 5%. Then I will sell. By the way, these numbers, 10%, 5%, those are not etched in stone. You can use your own numbers, and you'll want to, as you learn your securities or maybe the universe of securities you're trading, you might make those numbers lower or higher, depending on your risk level and how much profit you want to book. But also, like some securities have wider, ranges of, of trading. And so 5% or 10% might be too low. Maybe you want to make that even steeper, or vice versa. You may make that 2% and 4% or whatever. You can pick one or both, either way. But the idea is you're picking an amount that the price range has to support by in order for you to take action. In this case, we're looking at breaking a support line to sell. So in this case, we would sell. You could also use a duration type of rule too as a filter. And for example, you'd say, I will allow one full break of the support line, but not two. So that means if it breaks the support line, on one day, let's say we're trading on a day, and you're like, okay, it broke the support line. The support line exit rules, I'm supposed to sell as soon as possible. So I should be selling now, but I'm going to set up a filter and a rule and say, I'm going to wait until it breaks it twice. And if it doesn't break it twice, right there in the following day, then I'm sticking in there. So that's the idea of making these a little bit more filtered out. And again, these are examples, adjust to your own securities and as you gain experience and what you feel comfortable with too. But the idea is I'm not following the hard and fast rule of the line was broke, I sell. I'm putting some filters or modifiers to it to allow me to stay in a little bit longer, put a little bit more at risk, because I'm taking a little more risk around that rule, but I'm also trying to filter out a false breakout is what I'm trying to do here. So if we look at this example here, the same example, we could see that, okay, we bought in on the second touch. We're in a nice uptrend here. You could see that when it breaks the line there right at A there, we should have been selling right away if we followed the rule to the letter. It broke the line, we should have sold. But let's say we had a filter that said we have to not only break it, but it's got to break it by 10%. We would say at the letter A, estimate here in this example, but we'd say, okay, we're not going to sell here because it didn't break the line by more than 10%, right? So it didn't break the line by more than 10%. We're not selling because it's less than 10%, really is a way to look at it. So it's no sell, the break is less than 10%, it's no sell on A. Now, if we look to B, now that it's broken past the line a second day or stayed below that line, we can say, oh, we're going to sell because the close of that day is greater than 5% breakage through that line. Not only broken through the line, but the actual closing of the day, that was our second example. Now we're selling because it broke through. And then if we were applying C, we would say, okay, we're not going to sell on the first full day because that's B. So let's say we're looking for a first full day of a full sell through, and that was our rule, our modifier, and we wouldn't sell on B, we never would because it's only the first day, but we will sell on the second full day that's below the support line. So this was, again, our rule was the first full day. You can see A was not a full day as far as being below the close being below the support line. Right close to it, you could say maybe right on it. But the first full day we could say is B, not selling because that's our rule, our modified filter. And then the second day we're going to sell on the second full day, and so that's when we're selling on C. The unfiltered rule, without that would say, okay, you're selling as soon as you're breaking that line. And you can see, okay, well, we've got these things in place, and then we have this little turnaround, and maybe it'll start a new uptrend, right? But maybe we held in there a little bit longer than if we would have sold right at the line. Again, who knows what else is going to happen after we break through the trend line. If anything, we know what's supposed to have happened is the trend is broken, but there are temporary pullbacks, there are false signals, and so this would be a way to kind of filter out a false signal if this was going to go back upward is the idea. But that's how when you make your predetermined rule, then you follow your rule. You got to have discipline around that. So if you're using a filter strategy, there are definitely some arguments against using filters for trend lines. There are good arguments for using filters for maybe other indicators, but for trend lines, there's some good arguments against them, and you should be aware of those. And one of them is that the breakout principle is a very powerful and well-known concept. If you just follow it and you don't play with filters, you're going to be fine. And that's very true. In fact, that would be, I would say, the number one argument is stick with that powerful, well-known concept, and it's simpler that way, and you can execute that way, and you can have success that way. Also, when you'll know other traders are following that powerful and well-known concept, So they're getting out too as well. Again, trying to, let's say in the case of a sell rule, they're getting out because the trend line's broken, so it's putting more downward pressure because they're following the core rule around that and they're not using a filter. So that's one way, that's a very strong argument. Another argument would be that each security should, in theory, have its own filters applied to, as one size does not fit all, right? Each security is its own kind of entity. Thus, you'd have to juggle many different amount and duration filters to trend lines to really make it work or be fair application of it. And that's hard to apply and track, right? If you're tracking whatever, pick a number, 10 different securities, just to pick a number, and each one has its own filter, and some are, duration filters, and some are time filter, or percentage filters, or time filters, whatever it might be. That's a lot to juggle around that. It makes it hard to stick to your disciplined predetermined rule. So that's a good argument too as well. Though I think with a lot of securities there's more commonality than that, but there is a good point that each one certainly is its own entity, and you have to be wary of that. But as you apply and you learn your filters, you can kind of overcome that argument a little bit. But that first one, that the breakout principle is powerful, that's a very strong argument. So here's a strategy you can use. You don't have to use it as far as a filter strategy. And again, you can always fall back to the core rules around that. They're core rules for a reason, so think of it that way. But if you like the idea of trying to use filters or other ways to modify to kind of not, if you've been getting frustrated with maybe getting out too soon when it's actually more of a stronger trend, and maybe using other indicators to help you, you can use these filters and these other types of strategies to try to manage your way through the most vexing problem in technical analysis, which is false breakouts, for sure. I'd like to leave you with some final thoughts around trend lines. They're obviously a very important and core part, and many people just trade off trend lines. So let's wrap up with a little bit of some final thoughts around trend lines. First off, it may seem a little complex at first, like when do I start, when do I end? Again, you just extend out that line, but starting, picking, it's a little bit more dynamic of a process. And you understand it will get easier with practice, right? And you'll start seeing it, start making sense, and it'll be fine. You'll be fine. So it'll get easier with practice. And the trend lines are an indicator. They're a tool, just like there are other indicators out there as you're learning in the course. And so you can choose the indicators that you want to use, right? So you can always do that. And there's an indicator, the trend line and trend lines are trying to show you, is there an established trend, and is that established trend upward, or is that established trend downward? And so that's the whole idea of it, right? And it's great to combine with other trading indicators. So if you have an upward trend, you could use another indicator like a moving average, crossover, Bollinger Bands, lots of different indicators out there that we're going to learn about. You can, or candlestick patterns, for example, and then you can use that with other trading indicators, and that'll help give you further confirmation and confidence in your trades, and also confirmation that you've drawn the trends correctly, and that's all making sense and working out and being as predictable as anything can be. And that's the idea of a trend line, so they're a very strong indicator around that, because you want to trade off trends, because that's much more predictable than kind of just guessing out there, right? So if there is no trend, if there's no indication of a trend, there is no trading opportunity. You don't have that prediction ability without some type of trend, either up or down, to see what might be happening next. That's where the phrase, the trend is your friend, comes from, because it helps you with that prediction aspect, and then helps you to manage your trades and make decisions based on that technical analysis and logic versus, other ways people might make trades, the weather, whatever it might be. So you're trading on trends means you're not always in the market on all the securities you follow. You might be following a basket of securities. You might be in the market, or you've got a trade out there in some, and others are on the sidelines waiting for some type of trend that you want to trade to develop. So that's where you're in and out in different securities and at different times, with the whole goal of making profit as you use all these indicators and building up to a total profit and success is the idea. But trends are something that you need to develop too, and you need to make sure and firmly establish that a trend has developed. If anything, where people may struggle is they try to jump in too early on a trend without waiting even at least for a second touch that the trend is established, let alone maybe a third touch that might be much more confirming. So you have to be patient with trend lines, right? So you have to let that trend develop. Once it develops, then that's good. You want to make sure that trend line develop. And another thing that people can struggle with is that they try to make the trend line fit. They really want to buy a security. They think it's going to go good and it's starting to look good, and they really want to get in there. But if the trend isn't established yet, then you're at much more risk, right? Then you're not trading on a trend. You're much more risky. And so trend lines help take out some of that risk. It's also very dispassionate. You're not based on hoping, you're based on math, statistics, and logic and things like that to show, and also that herd mentality and trading mentality where lots of people are buying in, they're seeing a trend, they're helping reinforce the trend, you're seeing it too, and you're getting in at the appropriate point, and then you're making your profits as well by trading with these trends is the idea in a dispassionate way. Another thing as far as a final thought, and this I think is real important, is you don't have to be perfect, right? You don't have to be in your trend line drawing. You want to be good. You want to keep getting better all the time, but don't beat yourself up like, I thought there was a trend. Because sometimes what looks like a trend ends up not being a trend. Things that look like a breakout are just a false breakout. And this is just reality of trading life. There's winners and there's losers in your trades. That's all okay. It's a whole process, like what we're learning in the course. We're going to learn about how to manage your investments too as part of this too. So it all goes together. So you don't have to be perfect, let's say, in your trend drawing, and you don't have to be perfect in your trades. You're going to win some, you're going to lose some. And it's hard to get in perfectly at the bottom and perfectly at the top, right? I'm going to say hard. Let's say it's impossible to do that consistently. But the idea is you're getting in close enough towards the bottom and close enough to the top that you're making that profit in between, and you're using your trend lines to help you do that. In fact, a really good quote around that idea is, this is from Bernard Baruch, which was, I'm willing to let others have the first third of a move, and the last third of a move, I want to be in the middle third. All right, so look at our image here, right? We're not trying to buy at 0 or the number 1 touch of, let's say, an upward trend line. We're buying at number 2 or 3, and then we're not trying to, sell exactly at 5, 6, or 7, or even right at 4 necessarily. We're trying to, sell close enough that we make a good profit in there. So the idea of that is we're trying to say is be patient. Let the trend develop. Reduce that risk by letting the trend develop. Don't buy into something you think you see at touch number 1. That's not a trend yet. Number 2 or 3 is a much better indicator. So you're reducing that risk. Be happy with all the profits in that bulky middle third, right? The profits between number 2 and number 4 are great, or number 3 and number 4 are great, and you're doing that over and over again. That's going to be very profitable for you. So don't worry if you thought, I got in too late or I got in too early. Enjoy that middle third. And then, it's kind of that idea of the trend is your friend. You need to have that trend established so it'll be friendly to you and be really real profitably for you as well. So there you have it with trend lines. I hope you enjoyed this section and start practicing. And the more you draw trend lines and more you use your trading platform to draw the lines and you experiment with the different stocks, use that paper trading to practice and see, how well you're analyzing things without real money. Use the paper trading to help with that, and using fake money type of accounts. That'll be real helpful for you because you're going to start developing that skill and you're going to start seeing these trend lines and you'll start to see them easier and better. And then you should start overlaying other indicators on top of that, like chart patterns or candlesticks or moving averages or relative strength index, all these different indicators. Now you're really coming together as a strong trader, and that's my hope for you. So with that, trend lines, and remember, what are we going to say like the 100th time? The trend is your friend. For many people, when they think of technical analysis, they're really thinking about like patterns, patterns on a chart. Maybe you're drawing trend lines or hand drawing patterns or recognizing patterns on a chart. Now, we don't hand draw them anymore. The trading platform will actually help you to draw lines electronically on the screen. They're very helpful that way. You can use different colors, all sorts of great stuff. But that's the idea, is like, they're chart, and sometimes it's called charting, for that reason, because you're looking at these patterns, and there's nothing wrong with that. Chart pattern trading and trading off chart patterns has been very successful for a very long time and can have some of the strongest indicators out there as far as making decisions around whether to buy or sell a security. So, and they also have really fun, cool names sometimes. Like they got fun names like the dead cat bounce, right? Who wouldn't want to trade based on something that's called a dead cat bounce? Or maybe you wouldn't like to trade on that because you like cats. I don't know. I like cats. I used to have cats. So some people will trade only on chart patterns. They learn their favorite patterns, they really become specialists in those areas, and then they can visually recognize them fast. In fact, if you really are a visual learner or visually like to look at analysis and things like that, chart patterns might be really great for you. If not, they're another tool in your toolbox, of course, as far as different indicators and combination of indicators that you can put together, but they can really, for those who can, if you can see these patterns developing, that gives you an edge over maybe other traders who can't see them developing as quickly. And my goal here in this series of lessons to help you be able to see those patterns, easily as far as seeing the patterns. And the idea is you're going to visually see these broad patterns, and they may look like objects, actually, and a lot of their names come from that. You'll see in upcoming lessons. They might look like a triangle or a rectangle or other shapes, or things like a cup with a handle on it. And when these things form, that means something might be happening. And the idea is a pattern that's indicated something in the past and has been proven over time will do so again in the future. Now, nothing's perfect, of course, but that's the idea behind it, that similar situations will recreate these repeatable patterns, and we can trade off those. In fact, your fellow traders out there are seeing these patterns, some faster than others, but when they see these patterns, they're reacting in predictable manners. And for us, when we're trading and we have these indicators, whenever we can see the larger group of traders out there in the world behaving in predictable manners, that allows us to really be confident in our trading itself and in our actions and our strategies that we're putting together. And then these chart patterns, most will employ straight lines in many cases, or try to, or certainly when drawing a trend line, and some of course are much more dynamic in their shape. And pattern lines will follow typically either the highs or the lows, right? So you're seeing these patterns develop around the highs and lows. And pattern types are organized whether they forecast or predict or indicate a continuation or a reversal of the current price move. So the idea is you're seeing a trend, either upwards or downwards, and you want to look at that pattern that's developing and see, when you recognize that pattern and maybe invest or trade around that pattern, is it going to continue? Let's say it was an uptrend. Is it going to continue in that uptrend? And so we might, if we've already bought, we might want to keep holding that until it gets to a reversal point, or maybe we want to buy now and ride that uptrend. And some will indicate a reversal, which is the exact opposite. Maybe it's been, in this example, an uptrend, and now it's starting to run out of steam, and it's going to change and go either sideways or maybe start going down. And so maybe if we own the security, we want to sell more closer to the top. So continuation or reversal patterns are very important to recognize which is which, and we'll be going into that, of course, throughout the upcoming lessons. Now, it might take a little practice to start seeing the patterns, okay? It's okay, that's normal, because when you're dealing with real life, things don't match up perfectly. What I might demonstrate or you might see out there might look like a triangle, but when you go out in the real world, it might not be as perfect a triangle, for example, but you're still seeing that movement as far as how the prices are reacting, let's say inside the triangle, in the triangle section. So it's okay if they don't match up, in a perfect thing, and it's not a perfect world that we live in. The other thing that can frustrate a lot of people around with patterns too is that they take time to develop. It's not like something that, okay, all of a sudden you look at the next day's price bar and all of a sudden, boom, there it is. There's the development might be that next day's price bar is the one that now confirms your idea of what you want to do. It did something and now you're going to take action. But to get to that point, a pattern had to develop over a period of time. And the period, of course, can be, the period of time frame you choose, whether it's short time periods like, minutes, hours, or days, or longer periods like weeks or months, even years. So that's the idea behind that the time frame can fit these patterns any way you want them, not any way you want them to, but any way you can use the pattern the same way no matter what your time frame is. But a lot of times you can see a pattern developing and you might get excited about it. Like, I can see it coming. I just need a little bit more and I can confirm it and I'll buy in and it'll be great. And then something changes. Something changes in the news. There's a big event that happens and your pattern never fully forms. And that can be a little frustrating too. However, when you get it right and a pattern fully develops, it can be a very, very powerful indicator tool that you can use. Very, very powerful. So it's something you do really want to become familiar with. Plus, chart patterns can help with your confirmations. They can help confirm other indicators you're using. You'll learn about in things like around, let's say, how to trade off moving averages, for example. And you can use it to help, your chart pattern can help confirm that maybe a trend exists, or that what you're seeing with your moving average indicator or tool is being confirmed by another chart pattern, or vice versa. Or you can use it to confirm around things like trading volume changes, right? So you see a pattern, you can confirm that chart pattern itself, because the trading volume either goes up or maybe it starts going down. A lot of times when there's a higher volume, it'll typically indicate that the pattern is now reaching its completion phase, and so is ready to be trade worthy, as they say. So there's An art and skill to that a little bit as far as doing chart patterns and all that. But I think for many people, that's one thing that they love about technical analysis is they love that kind of idea of looking at patterns and making decisions off of them. So chart patterns are designed to tell you if either the trend will either continue, or what's called continuation pattern, or change or reverse, a reversal pattern. And in this section, we're going to talk about continuation patterns. So you're going to be seeing trends, you're going to see things continue along the trend. So kind of keep that in the back of your mind. We're going to be talking about continuation patterns in this area, and then later we'll be talking about reversal patterns. But reading right from here, you can kind of see that one of the key kind of parts of this is there needs to be a trend, right, for either one. If there's no trend, you really have no continuation or reversal pattern. That's been fully formed. You might see a pattern in development, and you might be a trend be in development too, and you'll see that as we go through the lessons. But one of the key things is part of this whole trend is your friend, and the trend is going to help you as an indication and a predictor, and the patterns do that too. But they need that trend to be there as well. So that's where with chart patterns, sometimes they take a little patience around that because you're waiting for these things to develop. So in an established trend, what happens is let's say it's an uptrend. There's a trend that's being established. Prices are headed in a certain direction. That's what we made trend. Prices are either going up or down, and and what can happen is there's a pause. There might be the strong trend either way, either up or down, and then there's a pause, a little slowing down of buying and selling. The trend is starting to lose its steam, so to speak. It's not as being firmly bought up or firmly sold off, so to speak. So it's starting to lose its steam. And when you see a continuation pattern, that is indicating that the trend will accelerate again after the pause. So let's use that example of an uptrend. Let's say you've got an uptrend going up. There's a pause, so prices kind of stabilize or go sideways, maybe down a little bit, and then with a continuation pattern, they would keep going up is the idea of a continuation and feel good. And when you are, let's say, investing off a trend, and you see a pattern that's there, you can feel good that you've identified the trend correctly because it's a continuation trend is the idea. So you can feel good about that, okay, I have a really good handle on this particular security, how it is trading at this moment in time because I see the trend, but I also see the continuation pattern kind of reinforcing that. And we can make trading decisions around that as well. So when you're thinking about trading and you're trading continuation patterns, if it's an uptrend, prices are rising, you don't want to sell. You want to ride that price up further. Hopefully you bought in at some point lower. The prices have gone up, so you've made profit as the prices have gone up. And you're seeing this pattern. You maybe see a pause, but you see a continuation pattern. And so the idea is that it's going to keep going up and you'll get even more profits off of that initial trade. In fact, what you could do in some cases is you see that, you could add even more to that trade, keep investing a little bit more in that security. Not only do you have your original investment, but maybe now you see this chart pattern and a continuation pattern is formed. You can even add a little bit more or add more, and now you've got even more money that's as you adjusted your position to kind of ride upward in an upward trend. Now if you're, let's say, looking to buy as opposed to short selling or other types of strategies out there, but let's say if you were buying securities and you see a downtrend, well, you can see that established downtrend, and you need to continue to wait that out and wait out that downtrend before buying in, right? So it's a good way to judge to see, is it going to reverse? Is that downtrend going to maybe go start into an uptrend now? But with a continuation pattern, it would be like, no, I see a continuation pattern in a downtrend. That means it's going to keep going down further, which might mean we might have a great opportunity coming up in the near future once that continuation pattern basically runs its course. So that's the general idea behind continuation patterns. Let's now look at some specific examples of the actual patterns that you can see and how to trade off of them. In terms of chart patterns, one of the more common ones you'll see out there are triangles. And really what's happening with there's a converging of a support and resistance levels. So think of, I think of support levels as prices don't go below a support level, they're bouncing off the bottom. There's a level where they're not breaking through or going lower. And a resistance level would be at the high part of prices, where prices maybe are marching up to a resistance point, but they don't break through that resistance. They kind of turn around and start coming back down. And they're trading between these support and resistance level. But with a triangle, these things are starting to come closer together. They're converging is what's happening. And they could be either in a rising or declining prices. The trend could be either going upward or downward. And so what's happening is the trading price range is starting to converge or narrow. Maybe it started out here and then it started to get narrower here, and it actually forms the shape of a triangle, as you'll see in the upcoming lessons here. And then what happens is the breakout, when it breaks through one of those lines, either a support level or a resistance level, when it actually breaks through those and then starts going further in either direction, whichever way it's going to go, it usually will break in the direction of the original trend with a triangle. That's very important. It'll break in the original direction of a trend with a triangle. So if the original direction, let's say upwards, and the triangle forms and starts to converge, then if it's an upward trend, it'll break through that resistance level at the top and then break through to higher prices, because an uptrend is higher prices. So if we bought here and we're starting to see a nice uptrend and a triangle forms, that's a nice pattern to kind of stick in there and let it break through that resistance level, and we'll be seeing that. So, because think about, again, as chart patterns go with triangles, they are continuation patterns, and that's why you'll follow whatever the way that original trend is, either upwards or downwards, because it is a continuation pattern as opposed to a reversal pattern, which would go the opposite way. But these are continuation patterns, as you'll see in here. Look at, let's say, not at the very beginning, but kind of start at the middle. Do you kind of see, if you look at the highs and the lows, if you were to draw lines connecting those high highs and those low lows, does it look like it's headed in a certain direction? Does it look like a triangle is forming? And it's not like, I believe the word is isosceles triangle, all the sides are equal. It'd be more of, I believe, equilateral triangle. Boy, it's been a long time since I talked about that. But the idea is that a triangle is forming here. And do you see it? Well, let's put in those resistance and support lines here. And now hopefully you can see, the triangle as it's forming here. And you can see that higher highs were not made, but the uptrend's going to continue on this. So, and the prices don't reflect new lows either. They're trading within that resistance and support line, those lines up there. And you can see how they're converging together. They're getting closer together. So if we start at the far left of the triangle where that dotted line is, and then you can see how the prices went up to that resistance line, but didn't keep going. The uptrend didn't keep going. It turned around and went back downwards. So now it's going downwards, and then it hit that support line, but it didn't break through there either. It then turned around and went back up. And there's always ups and downs as you go throughout, but it then marched back up to that resistance line, and so on with multiple touches. And you can see how the trading range narrows. So that is what's called an ascending triangle. Ascending because it's an upward trend, and the triangles, the bottom line, that support line, is sloping upwards, where the resistance line is more horizontal there. So that's an ascending triangle, which is a continuation idea. And so when do you buy on this? So you're buying when it's getting to that low, it's getting close to that support line, right? So you want to let the trend develop. You want to let the triangle develop. That's the key thing with patterns. You don't want to say, oh, I first saw it, hit that first touch of that line, I'm buying then. We don't know yet whether that's going to kind of reverse around. So typically you want to buy in like the second or third touch of a support line. And the more touches a support line has, the more approaches or close or near touches it has, the stronger the indicator is that that trend is holding, that those price levels are holding and then becoming more predictable. In this case, we've got, you can see where we started to the far left, kind of where the dots are, and we got 1, 2, and we look at the third one where it's approached, and once it makes that turn away from that at the third one, that's when we buy in, right? So that's a very strong confirmation. You can also use a second indicator to further confirm, with volume or a moving average or some other type of indicator to help you confirm as well. You don't have to trade just off the triangle. You could buy on that second touch, by the way, and that's perfectly fine. The third touch just gives you a little bit more confirmation. The more touches, the more confirmation. And the idea is we bought there on that third touch. It went up a little bit, actually then came back down and then touched again for a fourth time, then went back up again. But you can see with that support line there, we've established a support line. The third touch helps support that support line, and then it actually reinforced with the fourth touch there, and then the prices went up, and you can see our profit between where we bought. And then if we wanted to sell at the top of that resistance line, we could, or if we wanted for it to turn back around again, we could hope for another touch of that support line. But if you see in this ascending triangle, you see how everything's getting narrower, the price range. So now it's getting a little bit more closer as far as will it turn around, or will it resist, or will it break through that resistance line, or if it goes back, will it break through that support line, because the triangle is converging, it's getting narrower. That's the whole idea of the pattern. And because it's a continuation pattern, we have a better chance of the breakout, of course, happening. And the whole idea is it's going to break out on the top end because this is an ascending triangle. Prices before were rising, and then they got into this triangle pattern where they went up, they went down, they went up, they went down, and then started to converge. And as they got tight and converged, then somebody had to win, the bulls or the bears, somebody had to win. It had to break a resistance line or support line one time. And since triangles are considered continuation patterns, your breakout is going to be in the direction of whichever way the trend was, and the previous trend was an uptrend in this example, or an ascending triangle. It is always a breakout to the higher end because you can see the support line has an upward slope to it. So that's where your breakout is. Now in a descending triangle, it's the same concept, just the other direction. You see how our support line now is horizontal, and our resistance line has a slope, and it has a downward slope, and a downward trend leading into it. Again, it's a continuation trend. So the lower lows are not made, but the downtrend will continue as it trades within that and it converges in there. But the prices are not making new highs either. The prices are starting to narrow and get closer down. So really, to tell whether it's an ascending or descending triangle, you'll look at which line is horizontal, basically straight across, and which one has a slope. Ascending, going higher, would have a resistance support line, that's uptrending, and a descending triangle would have a resistance line that's downtrending or downwards sloping. So if you own, let's say, if you own something, you might not buy or sell your holdings depending where you're at within the triangle. If, let's say, I had bought earlier and it was downtrending, but I had bought earlier, and I had it where it starts coming back up within that triangle, I might try to sell near the resistance line, really to just get out is the idea. Because again, a trend is going to it's going to keep getting lower. Each time it bounces between that resistance and support line, the prices are going to keep getting lower until eventually they break through. And they break through, and they're going to break through in the direction of the trend. Though anything that happens, some kind of unusual event, things could happen, something that that would break the pattern that way. But if following the normal pattern, it's going to break out to the downside because that's where the original trend was. And you can even see within the triangle how it's converging towards the downside. Prices get lower, and the range gets more narrow as we go down, so it'll break out to the downside. So when you see a triangle forming, the first thing to identify is it an ascending triangle or is it a descending triangle? And then you can base your trades, you can watch that, let it form, and you can base your trades around it. Again, with either triangle type, you want to at least touch or get near that line that's approaching at least 2 times to help confirm that this is a real pattern that's in formation, that's in development. A 3rd touch is even better, and the more touches you have, in general, the more formed the pattern is, though you might be missing out a little bit if you wait too long. So usually like a 2nd, and certainly a 3rd touch is a good recommended best practice when you're trading within many of these chart patterns, or almost all these chart patterns, but certainly with triangles. Another continuation pattern that's going to follow the trend either upward or downward are what are called flags, right? And it's a continuation pattern, but it has a dramatic but brief reversal, and it's a real dramatic reversal. So if your prices are, let's say, downtrending and they're going down, on a flag it's going to reverse and the prices are going to go dramatically up for a little bit, and then they're going to come back down and follow that reversal, as we'll see in the example coming up. And the whole idea, like a lot of chart patterns, they look like something, and that's how they get their name. So it looks like a flag, or like a pennant on a flagpole, right? And it's similar to a triangle as far as it's got a shape and all that, but it really kind of looks like a flag, a pennant, or a flag with a flagpole. And then you're seeing is a sharp rise or fall, depending which way the trend's going. It's going to go the opposite way for a short period of time with a sharp rise or fall, depending, and going the opposite way of the trend, and then pick up the trend after that. And what you'll see also is that the pole part of it, that's where trading volume is. That's where you get this spike up in like your chart where you always see this a large amount of trading volume. A lot of people are trading, they're buying and selling the security very frequently. So you see a large, trading volume at the base of the flagpole. And then your pennant could either be at the top of the flagpole or at the bottom of the flagpole. But it's the idea of that volume is what's making your flagpole. So if we were to look at this chart pattern, and for fun, I threw in an area chart. You can see the top there, the peaks of these mountains are the prices, that they're, closing prices that they're at on this chart. And along the bottom is volume, represented by green would be an up day and red would be a down day as far as the trading on that particular day on this particular style of chart. So you can see the prices, then look to the bottom as far as the volume. And if you look from left to right, not much is happening, though it does look like we're in a definite downtrend. And as those bars get, on the horizontal bars, the volume, the trading activity, you can see there's a big downward dip as far as the trading activity that goes there. And then all of a sudden it reaches a bottom and then it shoots back up and then continues the downtrend. And if you can kind of see where like those green bars are, you start envisioning a flagpole there, start envisioning that there's a flagpole, there's going to be a reversal of the dominant trend, and then at the top we might have something that looks somewhat like a pennant around that. If we add some lines on here, you can kind of see, where it's that pennant forming. It's kind of a triangle. It's kind of a more rectangle-ish as far as being more parallel lines. But the green lines on the bottom, which is the spike in trading volume, is one thing you need to be part of a flag pattern. Your flag needs a flagpole, so that you can see how it's all of a sudden had this big reversal, shot way up, and kind of forms this flagpole with a pretty big pennant on there. In this particular example, where there's this big spike in profits in prices that come up. But then what happens? It starts to go back to the original trend. That's why this is considered a continuation pattern. So if we put the let's say a trend line on top of that, you can see that once you get past this kind of flagpole idea, it's going to go back to that original trend. So the way to trade a flag is, let's say you see this dramatic volume, you see this dramatic spike up, and you might be able to trade in there early enough to make some profits and then get back out right away. At least in this one where we're looking at a downward trending one. An upward trending flagpole would be the opposite around that, with an upward trend. But typically when I see flags, and really I see them as more, because I'm used to the traditional look of a flag on a flagpole, I guess that makes it easier for me to see when I'm seeing something in a downward trend and I'm really trying to trade on that upward spike, is how I treat it and how most people do it if they all of a sudden see a flag. Something's happened to cause that flag. That's why the trading volume comes up. There's probably some type of event or some news there. Maybe there's anticipation of a good earnings announcement after a series of bad ones, or if it was a stock, or something's going on in the crypto or Forex market, if you're trading those types of securities. Something's happened to cause the flag to, that big sharp rise. But then after that event happens, people are like, no, this is still not a great security. It needs to downtrend some more. And you can see where it picks back up on that trend. So flags can be, if you see them forming and you can get in soon enough, let's say, especially when you have that sharp reversal for the uptrend before it goes back down again, can be a great way to get a trade in there, make a little profit, maybe quite a bit of profit, and then get out right away because it's getting very spiky there. Just make sure you get out before the overall continuation trend keeps going back, as far as pushing those prices back down. Let's say if you're buying in more towards the bottom. Well, if you like triangles, you might really like rectangles. And rectangles, like triangles, are a trading range that are bounded by a support line on the bottom and a resistance line at the top. However, instead of like converging, it's more running parallel, forming the shape of a rectangle, as you'll see. And they'll continue along that kind of path, which gives us a lot of good trading opportunities inside the path until there's a breakout of the rectangle. Now you might say to yourself, well, which way does it break? Does it have a tendency to go a certain way, whether it's going to break through a support line or resistance line? The answer to that, because it's a continuation pattern, is it's going to follow the direction of that previous trend. See how continuation patterns will follow the original trend compared to, let's say, reversal patterns. But rectangles are by nature a continuation pattern. So we'll be watching those trends and that overall direction of prices, either up or down, and then we'll see how the rectangle forms, and then we'll see how we can maybe trade around that. So if you look towards the middle of the chart and think about those support line at the bottom and a resistance line at the top, if you were to draw those two lines, and form a rectangle, just visually look at this for a moment. What might it look like on your chart? Where you'd be drawing it on there. Think connecting the highs and the highs together, maybe at the top, and lows to lows with horizontal lines. So if you saw something looked like something like this, well, terrific, you were right. If not, that's okay too. We're learning here. That's the whole idea. I just want to give you a little kind of mini idea as we're going here. And you can see in this particular rectangle pattern that there's an uptrend that we're entering into the rectangle into. So in this case, there's a continuation pattern, so it'd be a definite direction, which was this uptrend. But then it gets kind of this narrow trading range of resistance and support lines. It goes up and bounces at a resistance line, which can't push the prices higher. The buyers or the bulls can't push the prices higher, so prices come back down. But a new trend doesn't form. It doesn't turn into a downtrend. It basically stops at that support line and then turns around and starts going back up towards the resistance line, and so on, trading in this range. And how wide the distance between the resistance line and the support line will vary by the security and at that moment of time. Sometimes they can be very, very narrow. Sometimes they can be much wider, of course. So it's not so much the idea of how wide or narrow it is, it's more that it's actually formed this rectangular pattern. And if we look at that, you can say, oh, well, there's opportunities where I might want to buy, or there's opportunities where I might want to sell within a rectangle pattern. And that's true. We want to make sure that the pattern has fully formed. So again, we're looking to buy in at the number 2 or 3 touch of it. You could buy in, let's say, you can see the first touch there. I don't have an arrow there. The second touch, I don't have an arrow there too, though a lot of people buy in the second touch at that support line. A real good confirming way is to buy in at that third line. You could put in a buy number 1. And then you can wait for it to come back down. It's either going to break through that resistance line at the top and keep going, but if it turns around, there's a really good chance it's going to bounce again off that support line. So once it comes back down, if you're a little bit later or seeing this later or want to be more sure, you could buy at the number 2 position here. So you can buy in the second, third, or fourth touch. If you're looking to sell the security, one thing you can do is do a lot of trading instead of waiting for the trend to go back in a certain direction. You could just trade frequently within the rectangle. So every time it comes up to a resistance line, that's where I'm selling. So I would be buying, let's say, at the support lines, let it have its run up, sell it to take my profits, let it come back down. Right now I'm out of the security. Once it gets down back to that support line and rectangle holds, I'll buy it again, and then kind of repeat that until it breaks through as far as breaking the pattern. But until then, what a nice trading opportunity to trade frequently as far as buying and selling inside the rectangular pattern. All right, so let's say in our rectangle here, where do you think the price will go next, right? I mean, we're now at the top, we're at a resistance line. It could either break through the resistance line and go, basically go upwards, to where I've labeled letter A, or it could turn back around and go to letter B. Now, we don't really know, but if you were to guess, maybe you'd have an idea of a guess around that. Guessing is not something we want to do in technical analysis, by the way. But when we're looking at a chart pattern for fun, you can kind of think about which way it might go. And how you can really help confirm that when you reach, let's say, the top or either resistance line or support line is look at your other indicators to help confirm things around volume, moving average, relative strength index, things that you're learning in the course, where it'll also give an indication of like, oh, this is a buy opportunity or a sell opportunity. So use those other indicators to help confirm that you'll learn in the course what might happen here. But let's say I told you it was either going to break either through resistance line A or it was going to turn around and go all the way down and break through the support line B. Just based on what you see here, which one do you think it is? I'm not giving you any other indicators. You just got to go with the pattern here. I'm just telling you it's going to do one or the other because I'm the instructor and I'm having fun, and hopefully you are too, right? Which one do you think it is? Now, a little hint here, rectangles are trend continuation patterns. What was the trend coming into the rectangle? So if you thought, okay, I'm in an upward trend, so I'm going to say A, well, you would be correct because that is the uptrend was already established before. The uptrend then went into this rectangular up and down pattern. And if it was going to break through, we'll be watching for it to more likely break through on the letter A there, break through that resistance line and continue our uptrend. So that you can see that if we're, say buying at the support lines, and even if we're doing frequent trading within the rectangle, because I bought at that support line, once it approaches that resistance line, if it turns back away from the resistance line, I could sell, get out, and then do it all over again at the support line. Or since I've already bought at a support line, I could buy again, or if I've held it through this whole period, by the way, too, and I bought it way back when, on that uptrend, I could then hold on to it and wait for it to break through that resistance line and continue the uptrend going upwards is the idea. Now, if it was a downtrend, it'd be the exact opposite, right? So, just think of this rectangle and just the line on the left there flipped where it would be a downtrend and it would break through B, break through the support level and continue the downtrend. And you adjust your trading accordingly. Now, sometimes rectangles will have that same parallel move between the upper and the lower, the support or the resistance line and the support line. And the key is they're not converging. They're moving parallel together, but they don't necessarily always look on their side like in a sideways market. Sometimes they can trade on an angle or on a slope, either kind of continuing that uptrend or continuing that downtrend. Even with inside that, it's got some movement inside there, and that would be what we call a channel. It's really a rectangle, and there's a channel of prices that are happening. But the idea is it's not converging like a triangle. It's still this narrower trading range, and then to treat it appropriately as a rectangle. Again, triangles and rectangles, continuation patterns, trend is your friend. The idea is you're going to watch for them to go through. If they do break through, they're going to go in that same direction of the original trend. Nothing's perfect, of course. That's very important. But that's the idea of these chart patterns that have been proven over time. More likely than not, hopefully is the ideal continue that pattern. Arguably, one of the funnest names in patterns is the dead cat bounce. And traders love dead cat bounces. It's a continuation pattern, so it's going to continue whichever way that trend has been headed before. And they love it, not just because the name's kind of funny, but it's actually a very good trading indicator, as we'll see here coming up. And they're very rare, actually. When you see a dead cat bounce, sometimes you'll see forums or people who are talking about trading say, oh my gosh, it's a dead cat bounce. And or it seems like it's forming. Watch out, it looks like a dead cat bounce. So you'll see some of that out there. But because it's rare, but the reason that traders love it or like it is it's very consistent. It's one of the more proven patterns out there. It's a very consistent pattern. And it includes a gap as part of the overall pattern. There's a gap in prices, as you'll see when we walk through how this works. And a gap by its nature is a very strong indicator as well. So you have an indicator that as part of the indicator has a strong indicator built kind of right into it. So that helps to make it very, very consistent is the idea of a dead cat bounce. So let's look at a dead cat bounce and how that kind of works, because it's a chart pattern that'll take a little bit of time to form because certain conditions have to be met along the way. So what happens is you see this, we're going from left to right, of course, with our time farther back in time to the right, more recent times, and prices, high at the top, low to the bottom. So what we're seeing here, you can obviously see that there's a downtrend, right? Remember, whenever we're trading chart patterns, there has to be an established trend. So what we're seeing here, and this is a dead cat bounce, there's a downside breakaway gap. So you can see the 3 bars to the left, the 3 price ranges, and imagine before that there was an established trend too. And then all of a sudden there's a downside gap, right? There's a big gap in prices. The lows of the previous day were well broken and went to even lower lows, and we have a gap in prices there. Review or take a look at the lessons around gaps and trading gaps. We'll learn more about gaps. But the whole idea is there's something's happened. There's some type of big bad news or something happened to cause a big drop in prices. And then typically for a dead cat bounce, you want to see a dramatic drop. It's not a small 2, 3, 4% breakaway gap or big drop or drop. You were looking for something like 25% or even up to 70% drop. You're looking for some really bad things to happen. Your cat is dead, unfortunately. And so you have this big gap. So look for a big gap of like a 25 to 70% price drop. And then it basically, forms this, it goes in this now new, even steeper downtrend. And then it reaches a bottom of the downtrend and it hits the floor. Your dead cat hits the floor and it bounces. So you see there's another breakaway cap off the bottom where it bounces up, right? The prices have now made a leap up. And it doesn't have to be a dramatic leap up, just that there's a gap that's formed. The idea is that it's gone. You've had a downside gap. Things have gotten even worse. It keeps going down, down, down. It looks terrible. And then it bounces off the bottom. And then it starts going up. And so it's a the idea of the formation of the dead cat is it's a short-term thing. It doesn't reach the original price gap prices. It doesn't, see how it does, when it reaches its peak, it doesn't go above the prices or above where that original gap was back to the original, let's say 3 downward lines there on the far left. It's going to kind of start to approach that, but then it's going to turn around again. Again, a dead cat bounce is a continuation pattern. So it's going to resume that strong downtrend. But the idea is something's bad happened, drive it down, and people are looking at it as it hits the rock bottom and bounces. They're saying, this is way too low. Maybe this has been oversold. Let me buy in, and then you get more buyers, and that has the bounce. That's your breakaway gap. That's the bounce. So the idea is you want to trade on the bounce. but be ready to get out, right? So you're seeing this happen. It bounces up. You see a breakaway gap. You need a breakaway gap going upwards, not just a trend going upwards. You need a breakaway gap going up to be a dead cat bounce. You trade on that, short-term trade, but you're ready to get out, especially as it starts approaching that first breakaway gap to the downside, or approaches the last kind of low in the previous downtrend low. You want to get out and take your profits, because what's going to happen with a dead cat bounce is it's going to reverse, or basically this temporary bounce, this temporary reversal is going to go back to the original downtrend. So be ready to get back out. You can have the exact opposite of that, and that's even rarer than a dead cat bounce, which is an inverted dead cat bounce. Just imagine this, but you're in an uptrend, and all the same concepts apply. Is just in an uptrend is what would be happening. Again, very, very rare, but if you see that, you can kind of trade appropriately around that. So the idea of the dead cat bounce is it's a short-term kind of profit opportunity, and that's why a lot of traders like it, besides the funny name, is they can get in and get some profits, but they're really watching it closely for any sign of a turn that might be turning back down to that downtrend, and then they get out right away. With a dead cat bounce, you want to trade on the bounce as it bounces off the floor. You don't want to go back into that downtrend, because the downtrend is going to keep getting worse. It's going to go past that floor and start creating new floors on this bad downtrend. So dead cat bounces are good trading opportunities, but just be aware of how to trade them. That's the real key part, is that you're trading the dead cat bounce. It's not something you would hold for long periods of time. You're just trying to trade on that bounce, get in, get out, make some profit. A very interesting chart pattern is what's called a cup with a handle. It actually looks like a cup with a handle on its side is the idea. And what makes it interesting is it's not only a chart pattern by nature, but it's combining these price patterns like you'd have in a chart pattern and trends and all that with things. Really, you have to have certain other factors or indicators that are part of that. Volume levels, how much trading and buying and selling is going on, as that cup forms, as we'll see here in a moment. And you're going to use an indicator, the moving average indicators as well too, to help kind of confirm all this as well. So they all kind of work together, and we'll walk through how all this works, including the moving average a little bit, so you can see how this all pulls together. And it is a continuation pattern. So the idea, if the trend, and the idea of a cup and handle is the trend, let's say it's going upward, cup and handle will form, and then the trend will continue is the idea. So it's a continuation pattern and takes time to develop. So this is one that does take time to develop, but when it does, and if it does, it's a very, very strong indicator when it does. We'll walk through why that is from kind of the psychology of what's going on with investors and traders that's forming this pattern. And as I mentioned before, it's fun because it looks like a cup. So if you can start visualizing a cup on its side, not the downward one, but on its side with your cup and your handle, then that's kind of cool, right? It kind of is an interesting thing. So let's take a look at a strong indicator, cup with handle. So if you look at this here, this chart pattern, let's start off, let's see if we can guess. Let's do a little more guessing game. So look at it and just start looking at it. You're looking for a cup. So in a cup, let's say you're looking at its side, you'd have a cup that would hold a liquid, right? So you're looking for an indentation in this chart pattern, these price lines that are going on this upward trend. Can you see the part where there's a depression where you could maybe put some water or some, adult beverage if you like? And is there a handle that might be on looking at our screen, the right-hand side of that cup, because they're going from left to right as far as time? So that's what kind of the pattern looks like. If I put a little bit of a highlight on there, you kind of see how it's starting to form like a teacup, right? Like it's starting to form a cup around there is the idea. So that's what you're looking for, is that cup with the handle. But to get there, there's a lot of things that got to happen. So let's put a whole bunch of stuff on the chart and let's walk through it. So first off, let's start at the very far left. We've got to have an upward trend, right? And as you can see here, the general direction, if we were to draw more specific trend lines, but you can see that the slope is upward, the prices are getting higher. There's an upward trend. And then you can see that the bottom of the trading volume is kind of like this medium trading volume that you'd see looking over the history of the prices for your security, whatever trading volume it is. Some securities trade a lot all the time compared to others, but you're looking at this particular securities, horizontal or vertical bars at the bottom. And let's say this, blue part represents that range of volume, and it's kind of a medium volume, right? So it's on a nice upward trend, nothing exciting happening, but it's a nice, good upward trend. Maybe we bought in earlier and we're hanging in there. that would be terrific, right? And that's maybe the idea. So we're seeing this happen. We're seeing this trend. And then it starts to reach a peak and starts to go downwards, and then it goes down in the cup part, and it starts to go sideways, right? So it doesn't go into full downtrend mode. It just starts to go sideways. The prices kind of bounce up and down a little bit in more of a flat part, forming, in fact, the bottom of the cup. And you'll see the trading volume is low on this. So you can see how they're all working together here, that the trading volume is low. And then as we go back up, you'll start to go back up, and then a handle forms. And that's when the handle forms, and certainly when there's the continuation pattern of the upward trend, we're back to this rising pattern, back to this upward trend. But one key part of that is that the trading volume is higher, right? So all of a sudden, a lot of people are trading it, and they're driving the prices higher. And then all along this, you're looking at this, you want to overlay on this is the simple moving average, or you can use a different type of moving average, like a weighted moving average. Look at the section around moving averages and learn more about moving averages. But basically, like let's say a simple moving average is looking over, let's say, the last 10 days or 10 periods, typically days, and saying what's the average prices. And really where that line comes in there is to form the bottom of the cup. We don't want those to go either too far, but we would rather they didn't break the simple moving average at all. But if they, or only just go a little bit below, just a little titch, we don't want it to go way below the simple moving average, because then we don't have a cup. We have more of a downtrend, or we have more of a V-shaped cup, which is what we don't want. We want more of a U-shaped type cup like we see here. So you're using that simple moving average to kind of help confirm and be a basis on that. And you can see how it follows along with the trend lines above it as far as that simple moving average. So what's happening here? So this is what it is, and you can trade off that, right? You could have either invested in the upward trend and then see the cup form, and you're hoping the cup forms, you hang in there, and then once you see the handle, you really hang in there because now you're going to be in an upward trend. Or maybe you're not in this security at all, and you see this cup forming, and then you see the handle, and you start seeing that sideways move in the handle, then you're starting to trade in there because you know an uptrend is coming, or you're hoping an uptrend is coming, and because it's a continuation pattern. And so you're buying in at that point as well. So you either had bought in earlier and you're holding through the cup and handle phase, or you see the cup and handle forming, and now you're buying somewhere in that handle, or most likely you're buying, actually probably a better thing is you're buying a little bit slightly up in the cup, or excuse me, a little bit slightly after the handle, because you want to have that uptrend definitely form. But if you think about the psychology of what's happening here, is that we've had this nice uptrend, and it's been going up. Well, we're going to start back on the left here, looking at the volume and stuff. A nice uptrend, steady uptrend, buyers are buying, and it's just kind of a steady uptrend. And then it loses steam, right? That's what happens to chart patterns. They lose steam, and it's either it's going to continue later, but it starts to go reverse the other way. And then so the prices go down when people are taking profits, and maybe that's what's happening. Prices are going down, but there's a low trading volume. It's not like there's a lot of excitement. It's not like there's something bad that's happened and the trading volume's high, driving the prices way down. It's just kind of like, it's just kind of really getting low volume, kind of boring, just kind of moving along. Moves along the bottom of that simple moving average. The cup is, in fact, above the simple moving average line, but this cup is forming. But again, it's nothing like exciting going on from volume. Then the volume starts to pick up, and people are like, oh, okay, well, maybe it's picking up again. And then what happens is those who didn't sell, towards the bottom of the cup might be selling now at the top of the cup or along the handle, right? They can't decide which way to go, the buy, sell. There's a little bit of movement, but now there's more trading volume coming in. And so that's starting to move that handle a little bit. It might actually, start ticking up a little bit just itself. It doesn't have to be a fully horizontal handle, but it's going to be, and it usually isn't, in real world. But it's what's going to happen is you're going to start to have this high volume, and you're going to have this upward trend. So that's kind of, and then people are like, oh, this was just a temporary setback. That cup part, maybe a pullback. If I held on, I'm just going to hold on and really now ride this upward trend. And other people are like, all right, they had this temporary pullback, handle formed, indecisiveness at the handle, definitely went into uptrend, and now I'm back in buying because I know that uptrend is going to keep rising above there. So that's kind of the psychology behind a cup and a handle. Also, one thing to consider too is the longer the U shape of the cup, the more it's more predictable than a V-shaped cup. So if you see that that we have this long U there in the example that we're showing here with this cup, it looks like a U, but it's really kind of flatter and longer than if it was a real sharp V type of a cup. Also, the cup shouldn't be overly deep. The idea is you've had some indecision, you have some profit taking, but it shouldn't be driven way down low. It shouldn't certainly not be driven below the simple moving average line. That's what helps us with our cup. So it should not be overly deep. If it was really a deep cup, then it might be people are not as incisive or taking profits. They might be an actual real trend reversal, and it's not really a cup and handle. It's actually something different going on. So look for U-shapes, longer U-shapes in the cups to be more confirming, and then also look that the cup is not overly deep on it, and that'll really help you well. So as you probably saw there, you're saying, well, that's a lot going on with a cup and handle. It looks nice, but I got to really wait for that pattern to develop. And that's true, and you have to let it develop. But as you can see, there's strong indicators and multiple indicators on top of indicators, so that it builds a great trading opportunity. So it might not be something you're trading every day, but if it kind of jumps out at you and slaps you in the face, like you might want to take notice of it, because could be a great trading opportunity, and to ride a long-term upward trend after a pause there in the cup. So chart patterns, as we know, are designed to tell you if either an established trend, that's key that there's an established trend either up or down, and will that trend either continue, a continuation pattern, keep going the same direction of the trend. Let's say it's an upward trend, it would keep going upward. Things like triangles, rectangles, dead cat bounces are continuation patterns. And in this upcoming lessons, we're going to talk about reversal patterns, where you're not going to continue that trend. In fact, the trend is now going to reverse. It's either going to go sideways, or it might completely reverse and go, let's say if it was an uptrend, it would go downward. And if it was a downtrend, it would reverse and go upward. Obviously, we can see that if there's a reversal pattern happening, we might be waiting for that trend to happen and for that reversal to happen. And then that might be a good opportunity to either buy in for a reversal that's going to lead to an upward trend, or maybe we're selling at more of a peak, let's say to when a downtrend or an uptrend is going to reverse to a downtrend. So either way, the idea of a predicting nature of an indicator is very, very powerful. So we're going to talk about in this section reversal patterns. The trend is going to reverse. So as we know, in an established trend, there may be a pause in buying and selling. That's the same with a continuation pattern or a reversal pattern. The trend is starting to lose steam. And when you see that reversal pattern, that is indicating the current trend will end and a new one is beginning. And so we take appropriate action based on that, depending on which way the trend was headed in the original direction of the trend, and then it's now going to reverse. So let's take a look at some of these different types of reversal patterns that we can be watching for. All right, let's get a little alphabetical, right? So one of the more popular, or common, I should say, and popular trade on patterns is a double bottom chart pattern. And they're more common than a lot of other types of chart patterns, and double bottoms and double tops. But let's talk about double bottom chart pattern. Basically, it's going to look like the letter W, right? And what's happening is you have a downward trend, and it's retesting of these lows at the bottom of the W. And the idea is it's going to predict a price breakout. It's going to break out of that trend or reverse out of the downward trend and going to break out to the upside. That's the idea, is under certain conditions, we're now going to break out to the upside. So let's look at that and how those form and how we can trade off of those. So if we look at this example, this is, all the prices high to low, made into a line chart here. And it looks like a W. Do you see the W there over on the left there? And the idea is that it's retesting of the lows is the idea. So, and then they will predict the price breakout to the upside under certain conditions, as we mentioned. So, look, if you see the double on the left, if not, here you go. You can kind of see how the W is forming. So you can see the prices were higher, they go down, then they bounce up, and they go down, and they bounce up again. So that's the idea of the W part of it. Now let's talk about how do we trade this. I mean, so we see a W, that's nice. But how does this really work, right? So if you see, we're starting with a downward trend. So over a double bottom, it's a downward trend and it's going to reverse is the idea. So you're going to hit bottom basically twice. Think of like those would be, we could have drawn a support line along the bottom, but you can see where the prices hit the first bottom, and then they back up into the middle of the W, and they reach a peak, and then they go back down to the bottom, forming the next side of the W. And then after that, they go back up. So that's our double bottom, right? Once we've hit the bottom twice, we've now formed our double bottom. And what we're looking for is now it's going to hit that confirmation point. You could also call that a resistance line. If this was a rectangle, it would bounce off that resistance point and keep going back down and kind of trade with a narrow channel. But when we have a double bottom, it's actually going to break through that point right there after the second bottom. And that's your confirmation point. Once it's broken through there, a new trend is forming, and you used your upward trend type analysis, in a second touch, or that you now have when we look at drawing trend lines. But the idea is that's your confirmation point that is broken through that top of the middle part of the W. You can see where I drew this line straight across, and then you're buying there after it's gone up above it a little bit, maybe over a period or 2 or 3, and you're now going to ride this uptrend. And it's very common for a pullback to happen then. So we've been on this long downtrend, hit bottom twice, broke through at the top, and now it's reversed from a downtrend to an uptrend. But there's a little bit of pullback, a little bit of profit taking, not unusual, actually very common, and it'll actually maybe dip below that confirmation point. But the idea is hang in there, because the idea is it's going to then continue with a double bottom. It's going to continue on that uptrend. It may just keep going on that uptrend, but having a pullback with profit taking is not unusual, and that's okay. Just be aware. So when we buy in there, we can then ride that uptrend up, and we can sell at the top there if we want to take a short-term profit. But the idea of a double bottom is we're maybe looking for that upward trend. So for a double bottom, there are some conditions to be met, some generally accepted conditions. And typically you're looking for a minimum of 10 days between the lows. Now it could be months, so this is a longer type of chart pattern. I suppose you could trade it over, shorter periods, but traditionally you're looking at days, so it's a day type trading over days. A minimum 10 days between the lows, so between those two bottoms. And it could be months if you're looking at longer patterns. And the variation between the lows is no more than 4%. They truly are within each other, very narrow, or very, like if you draw a line along the bottom there, they're very close to that support, it would be support line. So there isn't it actually looks like a W. It doesn't look like something, like a lightning bolt keeps going downward. It looks like a W that's formed there. And then that center up move, is a minimum of 10% from the lower of the two bottoms, right? If it just goes up a couple of percent, you got this really funky looking W. That's not it, right? So it needs to move up 10% from the bottom and really form, it may not be a perfect W. Nothing's, it's not going to look visually perfect, but it's going to look very clearly like a W is the idea. And then the price must move above the confirmation line. That's the important part of a double bottom chart pattern. It's got to break through that confirmation point to show a true reversal. Even though there might be a pullback later, it's got to break through significantly through that confirmation line. So you're looking for that as well. So when you're looking to trade on a double bottom, you need to make sure that these conditions are met along the way. But it can be a very powerful pattern to trade on. So if you took the letter W and you turned it upside down, you would have the letter M. And just like if you took a double bottom chart pattern and in effect turned it upside down, you would have a double top chart pattern. It would form the shape, instead of a W, it would form the shape of an M. And a double top chart pattern is a strong uptrend that's, because it's a reversal, these are all reversal patterns, is now going to reverse and become a downtrend. So it's a very much the mirror image of a double bottom, just we're looking at double top. And if you were to look at this, then you can kind of guess what might be the M here. And this chart here, you can, there's some yellow lines to kind of help you see the formation of that letter M, and we're going to trade around that letter M. So let's put some more stuff around this so we can see how we would trade that pattern. So with a double top, you can see we have a strong uptrend going up. There might have been a pause there like it's shown here with some profit taking, but either way, there's a strong uptrend that's very much established. And then it peaks out, and the first of the two double tops, the first one there, you reach a peak and it turns around and really starts to go significantly back down. And then once it goes back down, it reaches a point of the lowest price there that then turns back around and goes back up to a top, forming a double top as it turns back around again, forming the letter M. So what we're looking for is we're looking for an uptrend. We're looking for, to really stop at a top there, or a resistance line would be drawn, and then it's going to kind of come back down and form that letter M. And now our confirmation point is at the bottom of the, of the letter M, or in the middle part of the M at that low price there. And that's where if we had bought in before, we would be selling there. We would have confirmation that this is definitely a chart pattern that's a double top, and the double top is a reversal pattern. So maybe we had sold a little bit before, maybe taking our own profits, but if we want to hang in there, and once we see the double top form, then we definitely, and we break that confirmation point, you definitely want to sell at that point. Because now we're going not from an uptrend, we're going into a strong downtrend. There may be some retracement or some, go back up the opposite way where people are looking to, buy in. They may have thought, oh, it went down too far. We're going to buy back in and drive that up a little bit back up above the confirmation point. And what that does is it shakes out kind of the last hold-ons who see it, okay, it's gone back up a little bit. It's gone above that confirmation point. I'm just going to take my profit now because I just want to get out because I know a double top is formed and I want to get out. So if I didn't get out before at the confirmation point, now is the good time to get out. And there's no guarantee there's going to be a retracement either. It could have just kept going down from here. But that's not unusual to see either. So the key on this is that you've taken a strong uptrend. It's tried to go higher twice, didn't make it, went back down through the confirmation point of that middle part of the letter M, and then it's done a full reversal and continues on down. And so you want to have sold around that confirmation point. Same thing as far as some conditions to be met. Again, mirror image of the double bottoms, but now it's the double tops. Like 10 days between the lows. It could be months, but it could be, you're looking for at least 10 days between them. And the variation between the highs now is the no more than 4%. Again, it's not looking like something that's kind of the staggering steps upward or something like that. You're definitely forming that M, and so you want those tops to be within 4% of each other. So it really starts to look like that letter N. And the center move down, in this case, the center down move would be a minimum of 10% from the higher of the two tops. So think of whichever top was higher, you want, if they're not, they won't necessarily always be perfect, but they will be within 4% of each other. You want to be at least to have that middle part be 10% down. Then it's going to rebound back up to form the second top and then come back down. And then the price must move below the confirmation line to be a true double top chart pattern. So that confirmation line, and if you haven't sold and taken profits before that, you might not have, and that's okay. You want to really make sure if you're trading off this pattern, that the pattern fully develops. But once you see that confirmation part and breaks through, that's the time to sell at that point if you had bought into it and rode a nice uptrend yet and take your profits there. If it goes back and it goes above that confirmation line a little bit, then that might give you a second chance. But if it's a true double top chart pattern, it's a reversal pattern, and now the prices are reversing from upward trending to downward trending, and a very definite sell signal once you break that confirmation point. So if you like the idea of trading double tops, wouldn't a triple top be better? In many ways it is. So there is the thing called a triple top. In fact, it actually has its own name, which is a chart pattern that's called head and shoulders, because it looks like a person's head with their shoulders. It is what the pattern will look like. So it gets its own special name other than just triple top. It's a head and shoulders. And you'll see these support and resistance breaks here as far as with head and shoulders and how that forms. And you'll see the trends as far as how those develop. And again, head and shoulders is part of the reversal family of chart patterns. So instead of a continuation of the trend, you're looking for the trend to reverse and go in the opposite direction that it originally was headed before it headed into this head and shoulder patterns. So if we look at this pattern here of our prices, and do you see a head and shoulders? That's a little trickier, but do you think of the top part maybe as the head, where you might put a face, and then do you see a head and shoulders? In fact, let's put a face there. There we are. We're happy. There's our head, and then you can see the pointy tops. Those are the shoulders, right? So that's the head and the shoulders. So numbers 1 and 3 there are the shoulders, and number 2 is the head. And you basically got 3 tops rather than a double top, right? 1, 2, 3. They're not all equally. You know how the double tops, they had to be within 4% of each other? So 1 and 3 would be within 4% of each other, but you have this kind of middle one that forms an even peakier or head on the triple top. That's why it's a head and shoulders. And it's rarer than double tops too, by the way. So this is why when you see head and shoulder, it's a strong indicator, because it's a very rare type indicator. And you can see we're in an uptrend coming into the head and shoulders, by the way. So you'd have a strong uptrend moving into it, and then it forms this, movement. It's a head and shoulder pattern. So how do we look at this? How do we trade on this? So if you look at it, you can see we've got the uptrend, and the confirmation line is in the head and shoulders is called a neckline, because again, we're talking about body parts. So it's called a neckline. It also, in effect, is a support line, right? Our prices are going to bounce off it for a little bit before they break through. When the neckline is broken, that's when the pattern is completed. And you can see what's happening here is we have our uptrend, and we don't have a confirmation line yet, by the way, because we're just in this uptrend, but we reach this first part of the shoulder. In fact, that first shoulder on the left-hand side, if you're facing the person, you don't even know it's a shoulder yet, because the pattern hasn't fully developed, right? But you do know it's going down from that peak down a little bit. So it's gone down. A new trend hasn't formed, but it's definitely some temporary downward price movement. But then it bounces back up and goes past that first shoulder and goes right up. again, it's to what's later going to become the head. We don't know it's a head at this point either, because we might think, oh, it's just a continuation of the upward trend. We had a little pullback, now we're going back up, and maybe we'll keep going upwards. We don't know it's a head yet. But now it's reversed back down in forming this pattern, and it's come down and gotten within 4% of that neckline. So now we're looking at, and we might say, oh, we might have a double bottom here, right? Because it's approached and hit that support line twice. But it's a little bit odder because we have that peakiness. A double top, or excuse me, a double bottom, wouldn't be as peaky well, it would form a W, but you could say a double bottom is forming actually. But it doesn't go back up, it goes up to the shoulder part, and that's where you've got kind of this triple top part, right? It's looking at it, and you can see the head, you can see the two shoulders, and when it makes that turn at that second shoulder, now you can actually see the pattern, and that's where you're really watching that support line, that confirmation line, and you're watching for it to break through that pattern. That would be the pattern is completed. And so that's what completes the pattern. So you know to be really ready to sell in this case, because it's an upward trend. You bought, let's say, earlier in the trend, and now you want to sell and book the profits that you had earlier in the trend before it breaks through that confirmation line and goes back into a true downward trend and maybe starts eating away at all your profits. So that's when it's kind of fully formed on that, is the idea of a head and shoulder. It looks like a head and shoulders. You could do the opposite of that, which is called inverse head and shoulder. Maybe the person's like doing a handstand. But you can see on the far left, we're in a definite downtrend, and we can see how the shoulders and the head do the same thing where they form, but it's now the opposite way. So you have to kind of use your imagination to see that head, the peak there of the head and the two shoulders. And the idea of this pattern is this is a great buying opportunity because the neckline, which is your resistance line, has been broken, right? It's tried to break through at the shoulders before. It didn't. In fact, in the middle, it had a big, deep drop. So this maybe was showing a pretty strong downtrend, but those shoulders kept touching those peaks. And when it tries again for that third time, see, once it approaches the third time to that neckline or that confirmation line or that resistance line, that's basically your triple part of this inverse head and shoulder. Same thing with the head and shoulder. That's your triple part of it as well. And this time it's going to break through. And once we see that breakthrough, we're like, this is a true inverse head and shoulder, a rare pattern, but it happens. And once it breaks through, now we know we should maybe look at that. If an uptrend is fully forming, then we get in and we can now ride that uptrend going up. That's the idea of inverse head and shoulder. So you're trading the head and shoulder or inverse head and shoulder, depending on which way the reversal is going to happen, is the idea behind it. All right, let's talk about moving averages now. And I love moving averages. I think they're a real powerful and yet pretty simple way to apply some technical analysis easily and quickly and really get a good visual on that. And one thing we know is that, prices, you can probably see from all these price charts, they don't move in a nice straight line, right? And they don't move, real nicely. They are all these ups and downs and all that, and kind of, doing that. And a moving average helps to kind of smooth that out so we can kind of, a picture of what might be happening with the prices in an easier to identify manner. So in this section, we're all going to talk about moving averages and how we can apply them to our trading. So moving averages are also known as dynamic analysis. So if we think of what a moving average is, as far as just what is it, it's a key component of technical analysis for sure. I mean, it's one of the things that you see often used, often as a default on charts where you see these lines going across the chart. A lot of times those are a moving average line. Again, it's going to smooth out the pricing, so you're not going to have that choppy up and down. It's going to have a smooth kind of line. It's going to kind of smooth out those pricing depending on what moving average you use. And it can adjust for pricing outliers, right? Where you might see prices going up and down, so there's a big high and it comes down, and then there's a big low and it comes down. A moving average will smooth that out and basically account for those price outliers, either high or low. And they also work well with using them with other indicators, whether it's candlesticks or sentiment or volatility or momentum, whatever it might be. There's different types of indicators out there that we're learning about, and they pair well with moving averages, so they can be used with these other indicators. And they're very good at helping to identify trends and helping you to take certain actions around when you see something happens with a moving average indicator. What do you do next? Do you buy? Do you sell? It actually can be very, very apparent looking at these different trends and the ways that you can apply moving averages, which is what this section is all about. How can we apply that, and how can we be better traders around that? Now, a couple of things to understand about moving averages is one is they are a lagging indicator, right? They're looking at averages going back over a certain period of time that you decide how long you want to look back as far as that period of time. But it is, because it's looking backwards, it's a lagging indicator, so it's not a forecasting type tool, or a trend following tool. It's more like looking, a little bit backwards. So it's a lagging indicator that is still very helpful as far as what you might decide to do going forward, but it's not designed to look forward. So, and also you don't have to try and figure out, the start and end points of it, which is nice. When we were looking at like trend lines on, we had to figure out, well, where's the start? Where's the end? Then I got to draw my trend line. You don't have to do any of that. You don't have to do any hand-drawn trend line drawing or anything like that. It's all basically mathematical, and the trading platforms do this all automatically for you. You just set the parameters, how many days basically you want your moving average to look at, and the type of moving average you want to use, which we're going to learn about. And then it's all shown right on the chart, and then you can make decisions based on that. And so the subjective part is really just choosing that moving average you want to use and how many periods. The rest of it's mathematical and automatically done for you. So let's get into that a little bit and how that would really work. And some of the different types of moving averages that are out there. We're going to start with the simple moving average, really the most common one. So there are several different types of moving averages out there, and really the building block one is the simple moving average. It's the easiest to understand, and really the most common one that's used too. So let's look at that and how that's constructed and how we can apply that. So a simple moving average is basically looking at prices over a time period. So in this example, let's say we were looking at the price of a security over 20 days, and you can see the prices at 20 and 24 and 22, and you're going back, the most recent price would be 29 to the far right, and you go to the left, and the 10 days ago was at 20. So you do the average, where you basically, this is a basic math problem, right? You add up the numbers, you divide it by 10 periods there. The average is 24.5, right? And then that's your average based on that time frame. And then on the 11th day, you now drop, your day one figure, the 20 unit, and you add in whatever the current one is, the next day's one. So on the 11th day, which let's say, for example, was 32. And you can see we now recalculate our moving average, and it becomes 25.7 would now be our average over that 10-day period. And you keep repeating the process, dropping, adding, and that gives you this range of prices, right? And that's it's a simple way of doing it. It's a simple moving average, and you're going to basically show a line, how it's going to be graphically and visually represented, showing these prices over time and how they change, going like from 24, then to 25, then it might go down or up, in this example here. And so if we look at like a chart, how this might look is, here's our candlestick price chart here for Procter & Gamble, and you can see our candlesticks here, and the prices, they're going up and they're going down, looking from the far left for farther back in time to the far right to the more current time frames. And so let's say we want to see a simple moving average. What would that look like if we applied it to this price chart? So what you do is you input some data into your platform. Very easy. You just have to input, basically, one number basically, which is, you have to choose what moving average you want, and you have to input the time frame. So if we look in the upper left there, where I've inputted for a moving average or a simple moving average would be 50. That would be, let's say, 50 time periods. Let's say they're days. So that would be 50 days. And I put another one on the chart in pink for a moving average over 200 days, just to show the difference between them. So if we look at our price chart now, we see a blue line and a pink line going across it there. And you can see that the blue line, the more recent look back of only 50 days, is showing where it's actually crossing over some of the prices, where some of the prices, the most recent prices, are above or below the line. And you can see if we average it out over 200 days, that never happens to cross over. Sometimes it can, it's just in this example, it's not. So if I look at this moving average, if I look at this chart now, I would say, oh, to the far left, there's not really much change. It doesn't cross the line, and then it starts crossing the line for the blue line, the 50-day moving average, and the 200-day moving average is just kind of off by itself. Now let's change the numbers a little bit and see how that might look a little different. So let's say I go in and I input, and I change one of my moving averages to be only 10 days as far as a look back, and the other one, the pink one, to be only 30 days. What does that look like? And as you can see here, it looks quite a bit different, right? Now both lines are crossing over at points, crossing over where the price bars are, where the candlesticks are, and sometimes they cross over each other as well. And what does that mean? And that means something. We're going to learn about how we trade on whether these are crossing prices or crossing over each other is a key indicator we're going to learn about. But for right now, just think about when I change my inputs, what does that change to my simple moving average as far as the look on it? In addition, you can see how we were using candlesticks, but sometimes people like to look at moving averages with like a line chart. And here's an example here of the 50-day moving average over a line chart where the prices are more of lines as opposed to, candlesticks. Candlesticks can tell you a lot more, but sometimes a line chart is helpful just for you to see where the crossovers happen. So it can be visually kind of pleasing in that manner. And as you saw, we can decide to have more than one moving average on a chart. Usually folks will have one, sometimes they'll have two, but you can have more on there if you want as well. That's up to you as far as how many moving averages that you want to have. And that'll be impactful as far as when we get into how to really leverage this, which is with the crossover rule, which is our next lesson, when we're going to talk about, all right, this is great. We have these lines on this chart. Now, what does that mean and what do we do with them? And that's the next lesson. The crossover rule is a very well-established rule for decision-making, whether you want to buy or sell a particular security. And it involves moving averages and when they cross over things. So moving averages, lend themselves to really easily to understand and apply this trading rule called the crossover rule. So as prices move up and down, so does the moving average move up and down as well, and it lags a little bit behind it, but when they start crossing over, that means something's happening, and we want to make decisions around what might be happening around that. So let's talk about the crossover rule and how we can use these moving averages to help us make better decisions as far as traders. And the crossover rule is actually very simple to understand. So basically when you buy, when a price crosses above the moving average, so we have our moving average line, price crosses above it, that shows that that's a buying opportunity. Same thing with selling, where the price is going below the moving average, that's a selling opportunity as far as that. So let's look at that on an actual chart and let's see, well, what does that really mean? But really kind of remember when you're buying and when you're selling. So if we look at the chart here, we can see where the moving average, the blue line, happens to be a 50-day moving average, the one I happen to select. You can select different time frames, of course. And you can see where it crosses over the price line, the line price bar chart. Basically, you can see where it crosses over. And really what you're looking at is you're looking for how this interacting with the moving average. So when it crosses above the moving average line, that shows that the trend, that things might be changing, a trend might be continuing, and the prices are going to continue to rise. By the same token, when the price goes below the moving average line, then it's showing that it's going to maybe continue on that downtrend as far as staying, prices either staying or going lower, as you can see in here in this example. So basically, a simple rule would be, and they don't stay there necessarily for long periods of time. Sometimes they do, sometimes they don't. I mean, if you look at the lines to the left on the far left of the chart, you can see they're well above the blue line for quite some time. Before they cross below, and then you would sell, and then above and buy, and back and forth, and kind of an up and down thing in the middle there. And then to the far right, you would see where you'd buy back in again. So really, if you apply the simple rule is, if it crosses above the moving average line, I buy, and if it crosses below the moving average line, I sell, is the idea behind it. Now at this point, you might be thinking, yay, eureka! So simple. This is all I need to do. This is perfect. I just got to look at a line and whether it's going above and below the line. Okay, well, I'm glad you're happy. That's really good. Nothing's perfect, unfortunately, as far as within the technical analysis world. So don't rely on just one indicator, but it's a good, strong indicator, so you can be happy. Just don't be too overjoyous on it. So the crossover rule is really terrific. It's really easy to understand, and it's a really good, remarkably good predictable indicator, but it's not perfect. There are outliers, and you have data points that pull things far off of trend lines, and the more outliers you have, far ranges and prices, the less accurate your moving average might be because those outliers are impacting that moving average. So it can give a false signal at times and give you a false signal of a breakout but you can usually correct that quickly because your moving average is going to go back down a little bit too. You probably saw in that last chart where it looked like in the middle of there where there's a lot of up and down going above and below the moving average line. So it was a lot of buy, sell, buy, sell, buy, sell. And that's a challenge, and that's what's called a whipsaw, actually. And you can get with a moving average, and one of the downsides is you can get a lot of buy and sell signals with a frequent crossing period. Where traders are trying to make up their mind: do I keep buying, do I sell, as a massive group? And you can get these frequent buy and sell things, so you're doing more trading activity, which could potentially incur more costs as you keep buying and selling. And it can occur any time, but the most common time where you see a whipsaw is in what we call a sideways market. There's no definite uptrend, no definite downtrend. It's kind of trending in this kind of narrow band, and it's going above and below the line frequently, and that's causing this whipsawing effect of buying and selling. So it could lead to this frequent trading around that. So in the next lesson, we're going to talk about whipsaws a little bit more and how to kind of overcome that a little bit, but understand that can be a part of the crossover rule, but still a an excellent, very good rule as far as understanding when to buy and sell. So let's say we're experiencing these whipsaws with a particular moving average and a particular security we're looking at, and we want to try to reduce that a little bit. There's some things that we can do around that, and that's called we're going to talk about filtering and how to in other ways that we can overcome these whipsaws, and so you're making less trading as far as that might occur on these false signals going above and below the line, in a frequent manner. So let's take a look at that as far as overcoming whipsaws. And as I mentioned, you use filters basically to filter out, and get to valid buy and sell signals and filter out the valid signals from the false signals. That's what you're trying to filter out, right? You want to trade based on something that's a real signal versus something that might be false. And so here's some filters that you can use around that. One is time. So the price has to, you could say, and basically have a time rule that says the price has to remain above or below a crossover point for a certain number of periods. And you can decide, 2 periods, 3, 4, whatever it might be. So you can put that in as far as timing, so you're not as frequently trading because you've put in this rule that says, oh, okay, I've crossed the line, but I'm still going to wait 2 days to see, to make sure we don't have a whipsaw here, is the idea of putting in a time rule or a time filter. Another way you can do it is the extent, right? Looking at the price that's crossed that moving average line and say, okay, it's crossed it, that's great, but it needs to cross by a certain percentage. The price has to be either above or below the line by a certain percent, 2%, 5%, whatever the number you want it to be, as far as before I'll take action. Yes, the moving average crossing has given me an indicator. It's a strong indicator, but I don't have that whipsaw action, so I'm going to put in a rule as far as when I'm going to buy based on how far above or below the line. Also volume. As we know, volume can be a strong indicator on its own as far as really more of a confirming indicator, confirming what's happening. So you might say, okay, for the crossover, it has to be accompanied by a significant rise in volume. Again, higher volume, higher amounts of trading is more of a confirming indicator that what you're seeing is true. So if I see a crossover with very low or decrease in volume, I might ignore it. But if I see a crossover with a lot of associated volume coming with it, then I might use that filter and invoke it and say, okay, I'm going to do that. Or you could put in something like, I want to have extreme sentiment, right? There's an uptrend, and I want to really confirm that's an uptrend. So not only does the closing price have to surpass it, but the low actually of let's say a candlestick bar has to cross it too. So like the bottom of the wick, the low part of the range. So not only is the price crossed it as far as the price at the closing of a trading day, but also in the trading range, the very bottom of the wick on a candlestick, the low has to suppress it too. So I'm looking for extreme sentiment that we have crossed this price bar, and that's really a true filter, a true indicator, and we're using this filter to really make it kind of do extra work to prove that it's really true. And then a downtrend, the high would have to, the top part of the shadow, the upper shadow, the top part of the wick would have to cross under the moving average, not just close, but you're looking at the wick and you're looking for it to cross as well in that range in a candlestick too. So I've put some kind of rules around this with these filters, whether it's the time, the extent, the volume, or I'm looking for the whole trading range to cross over, not just the price, to put in more things to make me make a buy or sell a decision based on a trading rule in addition to the crossover to overcome these whipsaws. Now, you probably are already seeing, maybe a little bit of some of the downside of filters, right? So filters will help with accuracy. You'll do less trading, but they can, and they'll help reduce whipsaw losses, as far as, well, again, so you're not frequently trading or trading in the wrong way. You're putting these stronger rules. But filters also increase the lag to an already lagging indicator, which can reduce profits. So if I say I'm not going to buy into something until it's, let's say, 2%, not only cross the moving average, but it's got to be 2% above the moving average. Well, now I've added another maybe indicator or added more lag to it, where I could have bought in sooner, but I want to at least make sure it's above 2%. So I just cost myself 2% in that example. So you can apply these filters based on your trading style and your feelings around risk aversion too. Somebody who has very low risk aversion, really wants to take a lot of risks or whatever, they'll have very low, if any, filters. And others are like, no, I want a little bit more of a perfect setup. And so I'm gonna have maybe more than one filter, maybe another confirming indicator before I make a trade. I'll make less trades that way, but I know when I do, I'll feel a lot more confident on it. So if we look back at this chart again, you can kind of see where these whipsaws come. And you can see if I'm entering into this, or I start following this particular security, and I say, oh, okay, if I come in at any point and I'm above the crossover line, well, I could be buying, right? I might want to look at other indicators, look at trends, all that stuff. But right now I know, at least as far as in this case, a 50-day moving average, I've got that long stretch where I could have bought at any point of that. And if I bought at the beginning at the far left, boy, look at that nice run up I had in this security just by holding it over this period and then selling it once it came down to crossing below the moving average line. Then we enter into this period of whipsaws, right? You see the sell, buy signals again, going back and forth. We see us crossing below that last moving average line there where I have the red arrow, and you can see where we're definitely in more of a sell period or don't buy period, until at the very, very end you see it kind of cross above too as well. So you can see if we filter out these whipsaws more, then we would have less of that sell, buy, sell, buy, sell, buy. But we might also miss out on its potential opportunities too. So just a way to look at it, but understand that the moving average rule by itself is a very, very good and very strong indicator. Another rule that you could use with moving average lines is the moving average rule is what it's called. It's an alternative to the more popular crossover rule. So you're not looking for when it crosses over, you're basically looking for when the moving average starts to bend or change. So you would look at it to call an end to a trend when you have changes in actually the moving average line. Instead of uptrending or downtrending, it's starting to make that change either way. So if there's an uptrend, if the moving average is less than today's moving average is less than yesterday's, you could start calling an end to an uptrend with that. And the opposite, of course, would be in a downtrend. It's been downtrending if the moving average today is higher than yesterday. So you're basically your most recent data point, and then looking at your overall trend. And so the advantage of this is you're not looking at crossovers, you're just strictly looking at the moving average line over the period of time. And it helps as far as you can call an end to a trend faster than with a crossover rule. Moving averages always are a lagging indicator, but you're able to kind of see where that change is occurring on the line as opposed to waiting for crossovers and prices is what you're looking to do. It still suffers from lag, it still suffers from whipsaws, but it is an alternative, and you can use some of these filters we talked about as well to establish filters or rules around that as far as using this without the crossover of the price, but looking at when basically when the moving average itself starts making some changes. If we looked at this graphically, you could see here, you can see how it's kind of in this curve, right? It's this particular moving average, they can look different than this. But as you look along the curved line, you can see as it starts to flatten out over time, you can see that's when the moving average is starting to change. And you can see up in the upper left there what's a 50-day moving average, and the moving average is at $138.95 in this example. So when you start seeing things that are coming up less than that, then that might signal a change in that upward trend that we're generally seeing with this thing. If we start seeing that number going down, that might show a downtrend there. And as you can see, depending on the length of time here in this graphic that you choose, you have a 50-day moving average and a 200-day moving average. And of course, the longer the time period, the prices will differ too. But if you look at the curves, you can see where the top line at the far right, you might see it more of a downward trend on the far right of the blue, where the right is actually starting to trend upward, a little bit of an upward trend as they start to move towards each other. And so that's kind of giving you kind of conflicting messages, right? And that can happen. So, that time frame length can really impact that. The more time you have, the more the decision would be delayed as far as making a change. And you want to take that in consideration. And again, you can use this with other filters. You can use this with other indicators to decide what you want to do. Personally, I like the crossover rule. It's much more established. And also, it just seems to be easier to comprehend and easier to see too than just, but if you want to look at something where it might, indicate that the trend is changing sooner, you can use this moving average and just look at the moving average itself and not really looking at the prices. So with our discussion about moving averages, we've been talking about the simple moving average, sometimes shown as SMA on a chart, the simple moving average. And but there are other moving averages that you could use as well. And so there's a weighted, exponential, adaptive. These are the main categories of moving averages beyond the simple moving average. And they work in the same manner as far as like price crossovers and all that. But let's say you want a moving average that's more reflective of the most recent price. We know a simple moving average is an equal distribution between that price range. But it could make sense where you'd be like, I'm more interested in what's happening more closer, more weighted towards more recent pricing. So, you might think, well, I'm not buying 200 days ago. That's maybe too much of a lag. I'm looking for something a little bit more, and I want to use a weighting average that might take advantage of that. Now, a couple ways you could do it. One is you could just reduce the number of days in the simple moving average. That would give more weight to something that's a 10-day simple moving average gives more weight to 1/10 versus, let's say, a 50-day moving average where it's 1/50th. So you'd have more weight towards that more recent pricing, or more weighting really with all the pricing over that time frame. But you can also use moving averages that actually intentionally put more weight on more recent days. And that's what we're going to talk about here for some of the ways that you can do that, or basically moving averages that you can choose to use if you like to do that and want to put more weight on it, which makes sense as far as doing that. So the first one we'll look at is think of like a weighted average, right? And when we think about weighting averages, we could look at prices over, let's say, a period of time. Here's an example just from the math standpoint. This is over 5 days. You can see the prices. The furthest back price was $20 or rupees or whatever units you're using, and the most recent one is 31, and then there's a 33 there. So you can see, the more recent prices are much higher than the ones further back. Now the simple moving average, or the simple average on that, would be 26, right? You have your 130, add them up, divided by 5. Now a weighted average would put a weighting factor towards those numbers, basically. So the ones that are most recent would have a heavier weight to them than ones that are further back. So if we look at that first bullet point there, you can see the 20, say, dollars has a weight of 1, whereas the 31 has a weight of 5. And you do the math, 31 times 5, and you can see the math there, how that breaks out. And then you're going to divide that by you're going to break that out not by the number of days, but you're going to break that out by the weights, the number of weights. So it wouldn't be 5, because that would be a simple average, or you divide it by each of those weights, 1, 2, 3, 4, 5. If it was 20, it would go up to 20 different weights. And thus, mathematically, you would actually weight the more recent time by dividing 421 divided by 15. In this case, doing the simple math part, or the math part, would show that our weighted average would be equal to 28, 28.06 to be exact. Now here's the good news. You don't have to calculate any of that when you're trading or working with your trading platform. You just have to select that you want to use a weighted moving average as opposed to the simple moving average. But I thought it was important to understand that how it kind of works mathematically, that they are putting more weight on the more recent days when you do a weighted moving average. Another one that's very popular is an exponential moving average, where it puts even more weight to recent days. So the weighting given to the most recent price is greater for a shorter term extended moving average, or EMA, than for a longer period EMA. So for example, they might apply multipliers. So if, let's say, an 18.18% multiplier is applied to the most recent price data for a 10-day exponential moving average, Then for a 20-day EMA, that would be 9.52 as far as the multipliers that they're using. Again, you don't have to calculate any of this. This will all be done automatically for you, but think that simple moving average is an equal pattern, equal weighting. Weighted moving average weights the most recent days heavier. Exponential weights the most recent days even heavier still than a weighted moving average. So if we looked at this on a graph, for example, we'll take our graph we've been looking at, our chart we've been looking at, and you can see I've got the moving average over a 50-day period. That would be a simple moving average. And I have an exponential moving average of 50 on there. So it's the same time frame, but you can see how they might differ as far as, in this case, they only differ slightly in terms of the price. Sometimes, and especially if you use different time frames, it could weight it even higher. But this way you can see as far as, the different weighting, or you could use a different type of weighting around that and weighting more recent prices versus prices longer back. You can even see how they even cross over at times too. Another one is an adaptive moving average, which is kind of a push and pull aspect, where it's looking at a short time frame to identify the beginning of trends quickly, and as long as necessary, you want to kind of construct it to avoid constant buy and sell activity or whipsaws. That's where these adaptive moving averages came in. Because with any of the other ones we talk about, you can still have that frequently trading whipsaws. So sometimes you might want to adapt it to a smaller number of days, and then sometimes to a higher number of days, but you can kind of play around with it. But you don't want to force it because you're not sure which is right as far as the right days. So adapting moving averages uses, calculations, complex, and it's all automated calculations to do this by detrending the series to make the current price most important. So it's not so much weighting as it's actually detrending, whether it's up or downtrend. It's actually adjusting the trend in the series of numbers is what it's doing with an adaptive moving average. So there's some complexity behind that. What you'll see on trading platforms, and probably the most popular one of this, is the Kaufman Adaptive Moving Average, or you'll see it listed probably as KMA, named after a gentleman named Perry Kaufman. And what it'll do is it'll closely follow prices when the price swings are relatively small and the noise is low, right? So it's kind of adjusting for that. And it's got a complex formula, a lot of multiple layers on it, and they actually have some recommended settings. Sometimes you can change the settings, but they have recommendations around those settings. For 10 being the number of periods, 2 the number of periods for an EMA constant, and 30 the number of periods for a slower EMA constant. Those would be the traditional numbers you'd enter in, 10, 2, and 30. If you choose a Kaufman moving average in your platform, it'll actually prompt you for that. I have a link there if you want to really learn the whole math behind it. You can kind of find that out as well. So here's an image or a chart here where it's showing that the Kaufman moving average is looking that when prices spike there, it actually smooths it out even more, and you have that downtrend kind of coming down. And then when the prices turned up over 50%, then it really started to impact it more. I see is where it's weighting that more recent price changes versus an outlier. It's more weighting a little bit more of a longer part of that average with an adaptive measure is what it's doing. So with each of them, they all have their strengths and weaknesses. Simple moving averages would be the easiest to understand, and most commonly used. Weighted moving averages, they're weighting those most recent data. Exponential takes even more weight on them. Kaufman tries to use some more complex formulas around that, as far as, the different types of moving averages. So when you're looking at moving averages, that's one of the considerations you want to think about is which one you want to use. There's some other considerations too, which we're going to talk about in the next lesson. So many people in technical analysis love using moving averages, and they're very, very commonly used, but there's a lot of big debates around them. And one of the biggest debates around them in technical analysis is which one do you use? And they really kind of come around two big aspects of it, which is the aspects you need to choose when you're choosing to put a moving average on the chart or on the security you're looking to evaluate. And so you need to think about the type of moving average you want to use, simple or weighted or exponential or adaptive, whatever it might be. And then the length of time, the period of time, those are the two things that work together that you get to choose from. So let's talk about that a little bit more. So we think about it, what's most sensitive to recent price moves, if we were to kind of grade that. Simple moving average, or SMA, would be the least sensitive, and then weighting moving average, and then exponential, and then something like a Kaufman moving average would be more sensitive to recent price moves. So that's a way you can look at it. For one thing, how much you want to put most emphasis around recent price moves. The other would be the time frame. How long of a time frame do you choose? The shorter the time frame for your moving average, it's going to respond quicker to new conditions, right? But in a longer time frame will reduce errors, basically reducing whipsaws, right? Basically going in and out. So if you want something that responds, quickly and is very sensitive to prices, then you might use an EMA with a short time frame. If you want something that be less sensitive to most recent prices and over a longer period of time, then you might use a simple moving average with like a 20 or 50 or even a 200-day time frame. And they all kind of work, and they all work in their own ways. But that's the big thing you want to understand, is sensitive to recent prices in choosing the moving average, and the time frame as far as how quickly they're responding. Shorter time frames, more responsive, as far as that would go. Now here's the deal with moving averages. They have limitations. They're very useful, but they're not perfect. Nothing's perfect, right? But they can be used really in conjunction with other types of indicators as well, as far as a really good confirming type indicator or working as a pair. And some of these challenges, though, are harder to overcome than others. So let's take a moment to talk about some of the limitations of this. They're good, but let's talk about some of the limitations and some of the ways that we can overcome them. We talked a little bit about filters with the simple moving average. Let's talk about some other things we can look at as well. Now, one of the limitations of moving averages in general is when markets go sideways, right? There, you can almost see from the image there in the circle where it goes up and it goes down, up and down, and it's kind of going the sideways thing versus a definite upward trend or a definite downward trend. Moving averages are better that way. They struggle a little bit more when there's no trending or they're moving sideways. It makes it harder to predict the next move, and that's where our whipsaws come in, right? They're frequent price changes above and below the crossover line, giving us different, buy and sell signals constantly, so we might be, forced to trade more often unless we filter that. The value in a sideways movement is you can recognize that it's occurring and then adjust or wait for a trend to appear, or you can use other tools with the moving average to identify actions to take, like looking at support, resistance levels, different things of that nature. But understand that a moving average can be a little bit more limited in a more sideways market. If we look at this image here, you can see where there's a definite uptrend in the blue and a definite downtrend in the right. And then we see the sideways trend there in the middle where it kind of is bordered between the two, the top and the bottom on that. And then, using things like our chart analysis, we can identify that it's a channel, and we can sell near the tops of this channel, for example, or we could buy near the bottoms of the channel. This is our resistance and support lines that you see that we've driven over the top of it above these prices. And then if we look at the moving average overlaid on top of that, maybe we could also look at, to be even more comfortable, we could say, well, we're going to sell near the top of the channel, expecting it to come back down. And then when it comes back down, maybe we've sold at the top of the channel, but if we're not sure of the channel, we would certainly sell after it crosses that moving average line. And then as it gets more near the bottom of that support level, then we might buy near that bottom as opposed to buying, or we could wait until we bought, after it crossed the line again. So you can kind of see where, they can kind of work together, these different channels and moving averages. And there's different times when you'd be buying or selling, whether you're moving quicker on something like that or slower on something like that, depending on the channel and depending on the moving average. Another limitation dealing with moving averages is noise, right? If you have a disorderly chart, there's lots of outliers, right? So it's kind of noisy. You have real spikes, or you have high prices, low prices. It doesn't seem to be really, very organized as far as a chart, or a noisy chart. It can give off more false buy and sell signals, right? It's going above and below the line, whipsawing a lot. It just seems to be all over the place. And you can fix that by applying a moving average with more days in it. So things that are these big outliers can get smoothed out more and become less of an outlier, because a longer time frame will actually smooth that out more than a shorter time frame. However, a longer time frame will increase the lag a little bit more. It doesn't put as much emphasis on more recent prices. So it's with all these things, you have kind of a give and take around that too. But if you're dealing with a chart that seems just real confusing, highs, lows, all over the place, and you want to try to get a feel for that moving average, try a longer time frame to give you a little bit another way of looking at it, understanding though that it might increase the lag. And then if we look at lag itself, that can, of course, is a limitation. And you could see a dramatic price move, and you could see potential profits. Like, look at where it went. It went way down. There might be a way to buy in, and then there might be a good opportunity here. But you're, let's say you're a disciplined investor. Hopefully you are a disciplined investor, and you decide you want to wait a few days for that lagging moving average to catch up and then actually create the crossover. So you can see it kind of happening. You see it kind of moving towards the line. the moving average line, but you're waiting for the crossover to happen, which is your way of confirming and your way of making that decision around that. And if you put an extra filter on, like it needs to cross the line by, like, say 2% or 3% before you actually make a decision, let's say to buy, for example. Meanwhile, while you're waiting for that kind of leg, you could be losing out on profits waiting for that to happen. Now, the nice thing with technical analysis, you don't have to be perfect. You don't have to be perfect every time. But understand there's an opportunity cost, where you might be delaying to avoid the whipsaw and avoid frequent trading, but you're experiencing that lag. Now, you can fix that by applying a moving average with less days in it. So it'll be more sensitive to that recent price, or you put maybe more of a weighted moving average with less days, then it's doubly sensitive to a more recent price, and so you're trying to reduce that lag a little bit as far as your trading decisions go. But if we look at some of those things, you can see the conflict. I hope you saw the conflict there right away. If not, let's talk about that. You have noise and lag, right? And noise you fix by applying a moving average with more days in it. And then lag you fix by applying a moving average with less days in it. So you have to play around it, especially as you learn certain securities, what might work best for that particular security. But you can see there's a yin and yang here. You're by giving up one, you're getting more of another. So unfortunately, there's no magic number of days, right? I wish there was a magic number. I would say, well, the best number to reduce noise and lag at the same time is this number of days or number of periods, depending on could be hours or minutes, let's say, if you're a day trader. So there is no actual perfect one. Some are might work better than others, but there's no perfect one. You just have to adjust and understand noise and lag. Alternatively, what you could do is just focus on a security that's more orderly, or in effect less noisy, has less of these outliers and things, so it's a little bit more orderly. So if you have less noise, you can kind of work on that lag part a little bit more and use a moving average with less days, because the security is moving in a more orderly fashion. So that's another way you could do it. And then there's another option which you could use multiple moving averages as a strategy. And we're going to talk about that next here. And so we're going to talk about that strategy where you're not looking at when the price crosses over and dealing with that limitations. You're going to look at when moving averages cross over each other. So let's take a look at that here in the next lesson. Another effective strategy is not to really even look at the prices really at all. You're looking at the moving averages and how having more than one moving average and how it interacts with each other. So you're looking for price crossovers, you're actually looking at moving average crossovers. So how that kind of works is you have one chart, you have your chart of your candlesticks, your prices, whatever is going on there. And you're using, a moving average with different timelines. You could even have different types, or they could be the same type, but they definitely have to have different timelines as far as, days, minutes, hours, whatever your time frame is. And what you're looking for is not that the price is going to cross that moving average, but that a shorter timeline moving average is going to cross a longer timeline moving average. And we'll have some graphics here that'll show that in action and what to really look for. But think conceptually like not about price, two moving average lines, and then they're crossing over themselves is the idea. And then what do? Do you buy or sell based on that crossover is the idea. And we're going to talk about that. So for example, a real common way to do it, or combination, is have a 5-day moving average and a 20-day moving average is a common combination. You can see they're shorter time frames. And as an effect, you're comparing 1 week of prices, 5 trading days, and 1 month of trading prices, or 4 weeks times 5 is 20 days as far as being open, markets being open, closed 2 days a week, open 5 days a week. So that's a common way where you're looking at a week versus a month, and are they crossing over? However, you can choose and experiment with your own timelines, and that's perfectly okay. A lot of people use 50-day versus 200-day moving averages. There's lots of different ways you can do it. But a common one to get you started is like a 5-day and 20-day moving averages. So what you do is when you buy, when the shorter time frame moving average line crosses the longer moving average line on the upside. So you've got this longer moving average line, and the shorter one is crossed above that line. So by the same token, you sell when the shorter moving average line crosses the longer moving average on the downside. So it's going down below it, so you've got the shorter one is going to go below the longer one. And then the buy, of course, when the shorter one is going above the longer one. So let's look at this graphically so it makes a little more sense to us here. So if we look at this chart here, you can see we have a 5-day moving average in the blue and a 20-day moving average in the, we'll call it pink here. And you can see, let's go over to the far left. You can see how we have a real strong uptrend here on the far left. You can see that 5-day moving average prices, again, very sensitive because it's not a long time frame. Even though it's a simple moving average, it's not a weighted moving average, but you can see how it hugs to the prices. Versus the 20-day moving average, there's a kind of a gap between that blue and that pink line on the far left. And then you see them start to come together here in the middle where it's almost hard to see, but you'll see that blue line cross, a little bit or start to cross below that pink line. Those are sell indicators that, we might be a little bit of a downtrend or an opportunity to sell, that we've topped out, and we're actually in a more of a sideways market, and it's kind of whipsawing a little bit there. But that would be our sell signal that the blue line, the shorter time frame, is going to cross, above and go below. It's going to go below the pink line. And then as we go a little bit further on, you're going to see a definite uptrend come again where that blue line 5-day is going to cross that 20-day, definitely cross it and go above it, and then keep going above it, and that would be a buy sign. And then so on and so on as we go across the chart. You can see the lines crossing each other, and each time there's a cross, that means that there is either a buying time or a buying indicator or a selling indicator as you go through those. And I've highlighted those here. You can see, where there's a sell, a buy, sell, buy, sell, buy, as far as looking at those when they cross over and when they go back up again. Again, if you have longer, let's say instead of a 5-day, I was using maybe a 40-day or 50-day moving average for the pink line, there might be less times where they might be crossing. So that's where you can, adjust those to see what's comfortable for you. But this is a classic way to do it, is with a 5-day and a 20-day, and you're looking for when the lines cross over. And this has nothing to do with the prices. You're looking at just the blue line and the pink line. It should correlate a little bit together as far as with the prices, but you can kind of see you're really looking at the lines more so than prices by looking at moving average crossover versus price crossing over a moving average line. In addition, if you see more space or what you call daylight between the two lines, you'd have more confidence that the signal is correct. So if we look over in the far left, or you can see where the arrows point, and the other two areas as well, there's a lot of daylight, a lot of space in between the blue and the pink line. So that gives us a confidence that, okay, this is pretty strong. It's going to probably keep going on that uptrend there, for example, and the far left. And so we feel pretty good. Once there's less daylight, which you can see in the first sell box, it starts to get all kind of messy there, all close together. Then there's less confidence that that sell signal is correct. That's not just going to whipsaw and go back to a buy signal. And then after that second buy signal, we see another big gap come up, and so we have another run up in this particular security, where we can have confidence that that signal is correct, and then so on throughout the rest of the chart. So when you're looking for things with moving average crossovers, look for the crossover, but also look for how looking back over time, how wide that gap is, how much daylight is there between the two lines to give you another extra level of confidence that you're making, the correct move on that. If we were to, let's say, lay on 3 moving averages, and let's say we wanted to have this almost be a filter where we're like, yeah, 2 crossing is good, but we want to make sure that all 3 are crossing to be really extra sure, you could do that actually. You could say, okay, I want my shortest time frame. It'll always be the shortest time frame. And let's say I've got the blue in 5 days, the pink in 20 days on this chart. And then I've added a moving average, a simple moving average of 60 days, right? So you can see to the left how there's a lot of daylight between the blue and the pink. But if you look between the blue and the pink and the green, there's a lot of daylight in between them. And you can see how if we follow that green line going up and where that blue arrow is saying approached but did not cross, you can see we go all the way across that chart for a long time frame before we actually cross all 3 lines, really somewhat significantly where we're crossing all 3 lines where the blue line is in effect crossing the pink line and the green line, those longer moving averages that are telling us a real sell signal. So if we did it this way, you can see how it takes out all that whipsawing that occurred earlier, that above and below the line, took all that out, and we've been holding the security all the way until we get to that sell part, and then we sell from there. And then as we get to the far right of the chart, we're waiting for a buy sign where it looks like on this chart, the blue line, the short time frame, has crossed the pink already, but we're waiting for it to cross that green one. And once it crosses that green one, then we're looking at another buying opportunity. But right now on this chart, long time we've held this particular security, we've sold it, And then now we're kind of watching it to see if there's an opportunity using two moving averages crossing each other for another buy opportunity, or if we just should just stay out of it. Another thought too is if your trading platform or software allows, you can even put more than two moving averages on there, or three or four, or however many you want. You can even go up as high as 10. Depends on the trading platform. A lot of them top out at 10 or at 3. But if you can allow to put a whole bunch of them on there, then you'll get kind of this colored line effect that'll kind of create like a rainbow. So your shortest time frame is going to kind of move through the rainbow, and some people like that. But again, if you put on a lot of filters, you're going to have less trading opportunity, which might be good, certainly limiting whipsaws, but you might be giving up an opportunity when maybe you should have got out sooner, or you might miss a buying opportunity on the upside. So traditionally, it's two moving averages, the shortest one crossing the longer one, but going 3 adds another extra layer of filtering basically on that, and gives you a little bit more confidence. And don't forget that length between a daylight here to give you more confidence too between the lines. Another powerful tool that you can use in this whole moving average kind of section here is called the Moving Average Convergence Divergence, or MACD. Moving Average Convergence Divergence, and it's really widely used. A lot of people use this. In fact, a lot of times it's a default setting on a trading platform, which will automatically just kind of show you that, and we'll have a graphic here in a second so you can kind of see what it looks like too. But that's how popular it is. And the reason it's popular is it's trying to overcome that challenge that a good disciplined investor, we want to be good disciplined investors, and we have that challenge where we're waiting for the price to cross over a moving average, for example, or another moving average to cross over another. We're waiting for this crossover rule to happen, and we can see it forming. We can see it's coming. We're hoping it's going to come, but you wish you could take action now, right? You wish, like, could I just get in a little bit earlier? Do I have to wait for the crossing? Well, yeah, you're a disciplined investor. You got to wait. But with the moving average convergence divergence measure, this gives you an opportunity. Maybe you could, get in there a little bit early or out a little bit early, depending on whether it's converging or diverging. So let's take a look at that. But that's the whole idea, is it's overcoming that challenge of waiting for the crossover to happen. So if we look at it, with crossovers, you see them merge, right? You see them coming, and you see a turning point, and they're approaching, and then when that happens, then you're looking for a new direction to occur, is the idea. And by that time that crossover occurs, it's lagging indicator, right? So the absolute peak whether it's a peak or the absolute trough or bottom has already passed. So you can't buy at the absolute low, or you can't sell at the absolute high. You're waiting for that lagging indicator to catch up and really give you a good solid answer on it. And that's a good thing about moving averages, by the way, because it gives you some good solid indication, basically. But this is where the MACD comes in again, where you're going to visually see or quantify that there's an opportunity here, and you're going to try to get in at that, either in at that trough or out at that peak a little bit more. So when we think about convergence and divergence, convergence would be coming together, right? And then when you have convergence, it indicates a trend. We're looking for trends, that a trend may be coming to an end. It's kind of an early warning signal. So we've got a trend. It could be up, it could be down, but something's happening where there's a convergence, and that's a signal that the trend is going to come to an end here. And we'll see that graphically in a moment. A divergence, think of that as going apart, or more daylight. It might be a way to think of it. And so the current trend is safe from a crossover or a reversal. Remember, we were looking at those ones with that more daylight. We knew that on the far left of the graph, we had a lot of daylight, so it had to come really far to get to that moving average. We had a little bit of safety there. So divergence of more daylight or going apart, it really is an indicator that the trend is not going to reverse. If anything, it looks like the trend might be safer for a longer period of time. We will continue to ride that trend, at least for a few more periods maybe. However, normally wide divergences are not sustainable and can be a warning that prices may have started to reach an extreme. I mean, you think about it, if there's these wide price ranges, we might be really kind of approaching that peak. Or maybe we're going the opposite way, we're approaching that bottom. So it's another way that you can, where a convergence is really indicating a trend might be coming to an end. A divergence might be also a warning signal that, things could be good, but it could be a warning signal also that we might be hitting either that trough or that peak too. So we can use this MACD to kind of help us with that. So if we think about it, how it kind of is calculated is you take a long-term or a longer-term moving average prices, and they're subtracted from the short-term moving average prices, right? So it's kind of mathematical. The trading platform will do this automatically. You just choose that you want it, to indicate the MACD, and then it'll create a nice line on your chart, or it'll create some information there for you. It's created by George Appel, and he used exponential moving averages of 26 and 12 days. Although you can change the parameters if you want, but really what I see in the literature and everything, everybody's pretty solid on this 26 and 12 days, but you can adjust it. Though most people would recommend that you stick with it and just use what's been kind of tested and proven. So that's what we'll use here too. So if we look at our chart, here's our familiar chart again. We've got we put in a 12-day and a 26-day, simple moving averages, the blue line and the pink line, as you can see, and it moves across our prices there. But at the top, because we automatically defaulted, we selected these 12 and 26 periods for an MACD. You can see that you see some lines, kind of going together, a 12 and 26 line, looking at these convergences and divergences. So let's look at what this is telling us. So if you look at the far left, when you see the lines rising, or the two averages are, basically what's happening there is the two lines are diverging. And so that means the trend is going to continue. So, diverging means trend continues, right? Though we might be peaking or troughing, a trend is going to continue. So if we look at the top of our chart here, and we see these black and red lines kind of going up there, that's the lines are rising, and that's indicating that the trend's going to continue. And if we look down, if let's say we're way back in time on this, you can see how, yes, obviously that trend was continuing in this case. Once they start to flatten out at there at the top, and they start flattening out, and they start coming down, then when the MACD line falls, that means the trend is ending, right? So the two averages are starting to come closer together, and they're converging, and the MACD is going to represent that to us as far as that happening. And we can see it on the main chart too. You can just start seeing those moving average lines starting to come closer together, less daylight, and they're coming closer together. It's just that the MACD is going to give you a little bit of indication of that coming, maybe ahead of time. And then we go so on and so on throughout that. One thing too is on the far right there, you see where I have a note where histogram may be easier way to visualize. If you look at that those blue bars there, the histogram sometimes can be an easy way to visualize that. You can see where you might have peaks and valleys in the blue line, and where it gets really narrow to the main line, which is 0, how MACD would be +1, -1, and up and down from there. As it approaches that, that's when they're kind of converging together. You can see how close they are together, maybe easier with the blue part than you can with like the red and the blue crossing each other. But when they cross, that histogram should be basically almost 0, basically is what it would be. So this is interesting. This is great. You're saying like, okay, but I can kind of see it on the other chart too. Where is this helping me? Well, if you look closer at it, I'm going to put on some highlights here. The real advantage of this MACD is going to tell you earlier what is happening with the trend. That was our whole idea, right? And we want to see things happening a little bit sooner than waiting for the price line to cover. And so the gold circles, show the ending in this example of an upward trend, right? There's a sell signal going on, and you can see where where there's these, let's say the lines are crossing, and when it was first going down, as the blue line starts heading down and starts to cross for a little bit and then goes back up, or it's crossing over prices, crossing below, prices are crossing below, let's say the blue line, or crossing below, the longer line. If you look at vertically straight up between these two circles, you can see that the MACD is giving you an earlier sign, a few periods ahead of that something might be up and to be aware of. So that's where people use it, as far as I'm using my pricing, my moving averages to make buy and sell decisions, but I might be using that MACD to give me an earlier warning that something's happening, and I might be able to actually act before they actually do have a crossover period. So that's the whole idea behind MACDs. Again, nothing's perfect, but that's the idea behind them, is you're trying to get an indicator ahead of time than waiting for the prices to happen as far as crossing over. In addition, you can use other indicators in combination with these to try to get confirmation that that's truly what's happening as well too. So if you see lots of blue lines, or at the top of that MACD, you can kind of get a feel for what's happening, and then it's going to indicate what's happening below in your chart too, as another way of trying to maybe get ahead of a little bit. Or another thing that might indicate to you where you're looking at it and say, oh, I think a selling time is coming, oh, my MACD is kind of confirming this a couple days ahead of time. I really want to watch that. Or maybe I want to just get out now while I can, and then we'll see from there as far as whether you're going to go back in or not. So that's how the MACD is used as an early indicator on your moving average chart, moving average crossover chart. So are there some magic moving average numbers? Like when we talk about that, we're talking about time frame. Are there some magic ones or the right ones to use, so to speak, and or some better than others? And there may be some better than others, but there's no magic moving ones. Or moving average numbers. There's no magical numbers around that, or average or special time frame numbers. Someone says they know the best numbers or whatever, you might be, or they have a great system, you might want to be a little skeptical of that. But there are some common time frame numbers that are used a lot and are talked about in the media and all that too. So you will hear these over and over again, and there's one that really kind of stands out as far as something that's very commonly talked about. So it's good to understand what's going on with those. They're not magical, but understand that they're maybe highly publicized, and then how that can actually impact our investments, our securities that we're investing in. So if we think about the one that's really talked a lot is the 20-day moving average. And the 20-day moving average stands out because 20 days equals 1 month of trading days if you look at a trading period. Now a 20-day moving average, it could be a 20-minute moving average or a 20-hour moving average. Again, the time frames you can set based on your type of trading, how often you're trading. A day trader would have minutes and maybe an hour or hours versus somebody who's like me looking more at a month of trading days. But it's well known and it's observed by the trading community. So people know the 20-day moving average, and it's almost a self-fulfilling prophecy, right? So because everybody's talking about, oh, something's happening, it's coming close to the 20-day moving average. So when a security, let's say, is trending, it's common that the 20-day moving average will work like a support line. Sellers will stop selling it when it's reached. This is actually very common. It's like, oh, it's coming to the 20-day moving average. We don't think it's going to cross it. We think that's going to be more of a support line. So sellers will stop reaching and selling, and it'll actually intentionally bounce off the bottom of that support line and start going back up. That's actually very, pretty common. Less common is when the 20-day moving average, works like a resistance line at the top, where buyers stop buying when it's reached, whether they're waiting for it, to reach at that top, and they're like, oh, I don't think it's going to cross the 20-day moving average, so I'm going to now stop buying because we're coming up a resistance level. Now, if your charting and stuff has actual resistance and support levels, that's another thing, and maybe this is reinforced. But I think there's a little bit of self-fulfilling prophecy where people just believe these things, and they're like, well, okay, I'm not gonna sell when it gets down towards the 20-day moving average, but and I'm not going to buy when it gets to the top because I think it might break through that 20-day moving average. So not a magic number, but understand this is what you might hear in the media when they start talking about a security approaching the 20-day moving average. Now there are other moving average numbers too, and other popular moving average numbers includes a 5-day, which is like 1 week of trading, and 50-day, 100-day, 200-day, and why are these popular, right? Well, they're popular because they're round numbers. They're not magic numbers in any respect. At least the 5-day, you could say, well, equals 1 trading week or something. But they're not magical in any manner. But it does give the financial news something to talk about, and maybe make up. I don't want to say make up, but talk about things that when these things interact together with these kind of popular moving averages, like the dreaded, drum roll, dreaded death cross. Have you ever heard of the death cross? It's a real thing. And I don't know if it's not a real statistical thing, but it's certainly something they talk about in the media. So a death cross is simply when the 50-day moving average crosses below the 200-day moving average. That's the definition of a death cross, right? 50-day goes below a 200-day moving average. So we would know that would be kind of like a sell type pattern or a bearish pattern. Now, there's no statistical advantage over any other crossing pattern, and actually, since it's got longer time periods of 50 and 200 days, you actually are experiencing more lag, as we know from our previous lessons. But traders recognize a death cross. The media talks about a death cross, so it might be a self-fulfilling prophecy that, oh my gosh, a death cross is happening. We need to be aware of this, that prices are about to really go down because we're going to cross this death cross, or the death cross just happened. So this is a terrible thing. Same thing with a golden cross. So the opposite is when the 50-day moving average crosses above the 200-day moving average. That means prices are going to go up. So some would say a death cross means a wider bear market, and a golden cross means a wider bull market. It does mean that a shorter term moving average has crossed a longer term moving average, and we know that means something, and people trade on that, and we can trade on that. But there's no guarantee like, oh, okay, things are going to get bad or things are going to get really good, depending on your point of view. If we looked at it graphically, by the way, this is what it would be, right? You get your 200-day moving average, and you have your death cross when it goes, below, and you have your golden cross when it goes above, right? So that's kind of how that all kind of works. So it's the same thing. It's just the concept of, again, there's no magical numbers with moving averages, but it can be self-fulfilling as far as in the news media. But one thing with moving averages, to think about is they're really good, powerful indicating tools. And you can use them in different ways. You can use them as a primary indicator. You can use them to confirm another indicator. You can use them when prices cross above and below lines. You can use them when two moving averages cross each other. There are different ways to use them and different ways to incorporate them into our trading strategy. And they're very established, very well known. So that means lots of traders are using them, so it can be a little bit more predictive that way too as well. So use them with other indicators, but moving averages can be a really, really great way to enhance or be a big part of your strategy in terms of technical analysis. Now later we're going to talk about how to build these strategies and things together and how to pull these different things that you're learning about together into some coherent strategies and things, and also how to trade around these things as far as how much money to invest, all that. That's coming up towards the end. But for right now, understand that a moving average is an indicator, it's a tool, it's another tool in your toolbox, and it's a good tool to have, it's a good tool to use.